Hello there. Welcome to this course on financial accounting. This course is split into 12 parts or sessions. The objective of this course is to provide you with something that is highly structured and easy to follow without the need to memorize anything. Before we get started, let's look at why one should learn financial accounting other than for obvious career opportunities, right? First, for financial literacy. If you want to be able to read financial statements and interpret the financial information provided in those statements, you might want to learn financial accounting. Next, for investment analysis. If you want to read financial statements and look at how to assess the profitability or future growth opportunities or the financial position of a company, you might want to learn financial accounting. Next, for decision making. If you're a manager, you might want to learn and understand financial accounting so that you can assess the financial impact of your strategic initiatives. Next, for your own personal financial planning, it's essential that you understand financial accounting so that you can learn about budgeting or saving, investing, and also for retirement planning. Finally, if you're an aspiring entrepreneur, some knowledge of financial accounting can help you manage your business finances, can help you in the process of securing funding from investors, can also help you create financial statements that comply with certain regulations. A course on financial accounting can serve as a prerequisite for some other courses you might want to learn, right? In managerial accounting, you learn topics like budgeting and cost analysis, and you will end up relying on some of the topics you learned during the course of financial accounting, right? Next, if you're interested in doing a course on financial statement analysis, again, you will rely on some of the concepts you learned during a course on financial accounting. Or let's say you want to do a course on corporate finance where you will learn about financing decisions or you will learn about valuation. Again, you will build on some of the concepts you learned during financial accounting, right? Or if you want to study auditing, okay, where you want to evaluate internal controls of a company to understand compliance with regulations, for example. Or if you want to do a course on financial planning and analysis, better known as FP&A, again, you will be building on some of the fundamentals from financial accounting. Or if you want to do a course on taxation, where you might want to calculate taxable income and also work on your tax reporting, again, some knowledge of financial accounting can really help to keep things simple. Before we get started, let's check out the outline for the whole course and look at what has been planned for the 12 parts or the 12 sessions. Okay, the first part covers an introduction to financial accounting, where we'll look at what financial accounting is and we'll lay the fundamentals for the 4 financial statements. Okay, in part 2, we'll cover the accounting cycle, how to do journal entries and the process leading up to creating the financial statements, right? Part 3 will cover adjusting entries, okay? The various adjustments that have to be performed before the end of each time period, right? Okay. From part 4 until, let's say, part 10, we'll be focusing on different parts of these financial statements and look at in detail how to account for these sections, right? So for example, in part 4, we are looking at how to account for revenues and receivables. In part 5, we learn how to account for cost of goods sold and we look at the different inventory management techniques, right? And in part 6, we look at how to account for fixed assets or plant, property and equipment, and also how to account for intangible assets. In part 7, we look at how to account for current liabilities and long-term liabilities. Then in part 8, we focus on bonds. And in part 9, we learn how to account for equity. And in part 10, we look at how to account when you have debt or equity investments in other corporations, right? Finally, we get to part 11, where we look at exclusively on the statement of cash flows. And in part 12, using ratio analysis, we look at how to analyze different financial statements, how to compare different statements of different firms, and so on. Okay, let's get started with the first session, which is an introduction to financial accounting. In this session, we'll start with understanding what exactly is financial accounting, and then we'll focus on the 2 largest financial accounting standards, namely GAAP and IFRS, okay? And then we'll focus on who are the players, who are the most important players in financial accounting, okay? Then we'll move on to the differences between this course, which is financial accounting, versus what we learn in managerial accounting, for example. Okay. Finally, we will conclude with an introduction to the 4 basic financial statements: the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flows. Okay, we'll conclude with that because we have the next few sessions from session 2 until session 11, where we'll just be looking at these financial statements in a lot more detail. So what exactly is financial accounting? It's the process where you record, summarize, and present financial information. Okay, you provide relevant and reliable financial information to the various stakeholders using accounting standards such as GAAP or IFRS so that you can maintain some kind of consistency and comparability, right? Okay. Financial accounting, as we've seen, is much more than just bookkeeping. We've seen that it provides basic building blocks for understanding several other courses such as managerial accounting, corporate finance, financial statement analysis, taxation, and so on. Okay. Next, let's look at the differences between the 2 main sets of accounting standards that are used around the world. Okay, namely GAAP and IFRS. GAAP stands for Generally Accepted Accounting Principles, and IFRS stands for International Financial Reporting Standards. Okay. GAAP is rules based. Okay, you have a set of rules and regulations that you have to follow, whereas IFRS is principles based. Okay, so you are provided with a set of principles, but then you can choose how to apply them. GAAP applies to all US companies, whereas IFRS has been adopted worldwide. It's not mandatory, but more and more firms around the world have been using IFRS. GAAP rules are more detailed and prescriptive, which means it makes it easier for comparability, right? When you want to compare 2 or more firms, okay, you can see that when they use the same rules, it's easier to compare them, okay? But IFRS, because it's less detailed and more flexible, it's a little bit harder in comparison, right? Okay, when you compare 2 or more firms, they might have used the same principles, but the way they adapted it might be slightly different, right? So a direct comparison may not be feasible then. Moving on, let's look at who are the main players in financial accounting. First, we'll focus on the management. When I say management, I mean the CEO, the CFO, the various accounting staff, the board of directors. All these entities play a role in preparing financial statements and in certifying them. Okay. Then these financial statements are passed on to the external auditors, right? These external auditors can be any of the big 4 CPA firms or several other small independent firms. Okay. These auditors are responsible for checking the financial statements which they received from the management and to provide their opinion that everything is accurate and reliable, right? Okay. Once the auditors have checked the financial statements are then published and presented to the public, right? Okay. Then comes the role of the various information intermediaries, right? The information intermediaries consist of financial analysts, investment bankers, the various credit rating agencies, and information services such as Bloomberg or Yahoo Finance. Okay. Information passes on through these intermediaries to the final users, right? The final users are institutional investors, private investors, lenders, suppliers, customers, government regulators, for example, right? These users sometimes may not look at the financial statements directly, but get their information from these intermediaries, right? If you want to look up some kind of financial information trend over the past few months or few years, you're more likely to go to a service such as Bloomberg or Yahoo Finance rather than access these financial statements yourself, right? And by accessing this information, you can decide if you want to invest in any of these firms or if you want to do business with any of these firms, right? Before we look at the different financial statements, let's have a look at the differences between financial accounting and managerial accounting, right? In this course on financial accounting, we study about the different financial statements that are being created with a focus on external decision makers, right? These external decision makers might be potential creditors, lenders, government regulators, or any private investors, right? On the other hand, managerial accounting is used to prepare information for internal decision makers or managers within a firm, right? Okay. In financial accounting, we learn how to provide periodic aggregated information, right? Like a summary view of all the information being aggregated over a certain period of time, let's say for a fiscal year, right? Okay. But under managerial accounting, okay, the goal is to provide continuous detailed information to the managers, okay, with very specific information that is tailor-made for the purpose of planning, budgeting, and any kind of analysis that is necessary, right? The statements that are prepared using financial accounting are regulated for uniformity, right? We learned the two main accounting standards that are used globally, GAAP and IFRS, okay? Using them, we have to create the statements that are consistent and can be used to compare among the different firms, right? Under managerial accounting, you don't have any regulatory requirements per se, but you have flexibility among choosing the methods that work for you, right? In a typical course on managerial accounting, let's say you would encounter different methods in handling a certain process, and you can pick or choose whatever works for you, right? Okay, you have flexibility in that aspect. Okay, it's time to get introduced to the basic financial statements, right? Throughout the rest of the course, we'll be looking at these statements in detail, but in this first part, we're just going to have an introduction of these financial statements, okay? The four basic financial statements are the balance sheet, the income statement or the profit and loss statement, the statement of retained earnings, and the statement of cash flows. These four statements work together to provide a comprehensive view of a financial position and profitability of a firm, right? And to state the obvious again, these financial statements should be prepared in accordance with the accounting standards we've seen early, namely the GAAP or the IFRS, right? Okay, the first statement we'll look at is the balance sheet. It's a statement that shows the financial position of a firm at a particular point in time. What do I mean by that? Let's say consider your own bank account as an example, right? What's the balance in your account as of today? What's the balance in your account at the end of the year? This might change, right? The balance sheet literally shows the balances of all the accounts in the company at the end of a particular time period, okay? It reports an organization's assets, liabilities, and shareholders' equity at a specific point of time. For example, at the end of the year, you can see the balance of all the assets, the liabilities, and equity at that particular point in time. The balance sheet is governed by the accounting equation where the assets of a firm should be equal to the sum of their liabilities and stockholders' equity. To put it briefly, assets is everything a firm owns. Okay, what you see on the right is the sum of everything the firm owes to its lenders and investors, right? This accounting equation has to always stay in balance. We'll dive deeper into the different types of assets and liabilities and equity from session 2 onwards, right? Okay, for now, let's move on to the next statement, which is the income statement. It's also known as the profit and loss statement, okay? Because it reports the revenues, expenses, and the net income or loss of a firm over a specific period, right? Let's say for a particular fiscal year, right? And hence, the income statement can provide a snapshot of the profitability and performance of a firm, right? This information is very useful to the various stakeholders such as creditors and lenders, right? Next, let's move on to the statement of retained earnings. This statement is also known as the statement of owner's equity or the statement of accumulated earnings. Earnings, it's just a fancier word to denote profit, right? So when I say retained earnings, it refers to profits that have been retained by the firm, okay? So this statement shows how the company's retained earnings balance has changed from the beginning to the end of the period, okay? If you've retained more profits, then your retained earnings is obviously going to increase, right? So the statement shows how much profit has been made during a particular period and how much of that has been paid out as dividends. Whatever profits that have not been distributed as dividends are retained by the firm. Finally, we'll look at the statement of cash flows. Okay, this statement provides information about cash inflows and cash outflows, right, during a specific period. Okay, these cash flows are categorized conveniently into operating, investing, and financing activities, so we can get a clearer picture of how cash is generated and it's being utilized by the firm. This statement complements the income statement and the balance sheet because this gives a clearer picture about a firm's liquidity and solvency, for example. Okay, let's look at just a very simple example to see how these statements could be linked, right? Let's say at the beginning of a year, the balance in your account is $10,000, right? Okay. Let's assume that you make a salary of $5,000 during the month of January, and a summary of all your expenses accounts to $3,000 during that particular month. Okay. Which means now at the end of the month, you have 10,000 plus 5,000, 15,000 minus 3,000. You're left with 12,000 at the end of January. Now let's try to draw a comparison to see what is reflected in which financial statement, right? The bank balance at the end of December the previous year or the bank balance at the end of January, okay? It's similar to what a balance sheet represents, right? Okay, it shows the balance of all the different accounts, okay? What you see in between during the month of January, where you earned a salary of $5,000 and you had expenses of $3,000, okay? This is reflected in the profit and loss statement and also in the cash flow statement. But you can ask me, hey Joe, but what's the difference between an income statement and a cash flow statement if all it captures is what's happening during the month of January, right? No. The income statement captures everything from a business perspective, whereas the cash flow statement captures it from a cash perspective. I will introduce a new phrase in the next session known as accrual accounting, okay, where we will see the differences between what accrual accounting represents and what cash-based accounting represents, okay. This becomes the fundamentals to the difference between an income statement and a cash flow statement. Now let's look at how information flows among the different statements, right? In the income statement, revenue minus expenses gives you your net income. Net income is used in the statement of retained earnings to calculate your ending retained earnings, right? And this retained earnings becomes a part of stockholders' equity in the balance sheet, okay? Also, if you look at the statement of cash flows, for example, by putting together all the cash inflows and cash outflows, you can calculate how much cash is left at the end of each time period, right? And this cash balance is also shown under assets in the balance sheet, right? This is just to give you a simple example of how information can flow among the different financial statements. Finally, let's look at notes to financial statements, okay? These notes are simply just known as footnotes. They are used to provide any kind of additional information or disclosures, right? For example, they might provide a description of the various accounting rules applied, okay? Or they might also provide additional details about certain lines in the financial statements, right? They can provide some kind of explanation or breakdown for certain line items, right? Okay. They can also provide additional financial disclosures about items not listed. Maybe a firm is facing lawsuits or have some other arrangements with other stakeholders, okay? These can be discussed in the notes to financial statements. So this concludes the first session, the session on Introduction to Financial Statements. In session 2, we'll discuss the whole accounting cycle, where we learn about making journal entries and the whole process that is undertaken in preparing financial statements. Thank you for watching. See you in the next one. Cheers. Hello there. Welcome to part 2 or the second session in this course on financial accounting. In this session, we'll cover the entire accounting cycle. We'll start by learning how to make journal entries, and then I'll take you through the entire process on making financial statements. And eventually, we'll look at the closing process where we reset for the next time period. Okay. In this session, okay, we're going to start by looking at the various assumptions and principles that guide financial accounting. Okay. We'll look at the foundation or the framework on which financial accounting is based on. Okay. Next, we will revisit the various financial statements we looked at in part 1. Okay. We'll look at them in a bit more detail so it becomes easier to understand the entire accounting cycle. Okay. Then we'll move on to the meat of the session, which is guiding you through the accounting cycle. We'll use an example to understand the different steps in the accounting cycle. Okay. Just the second step, making adjustments, will be covered in a bit more detail in the next session. Okay. We are not going to be looking at that in this particular session because I feel like it requires its own session. Okay. Because there are so many different types of adjustments, and to have its own session makes more sense. Okay, let's get started with the assumptions and principles that form the framework for financial accounting. Be informed that this list is not exhaustive in any way. Okay, I've tried to put together the most important assumptions and principles, but this is just a list that has been put together for you to have a better understanding of financial accounting. Okay, we'll start first with the economic entity assumption. The financial statements of a company represent the activities of that company only. Okay. The statements do not represent the activities of the owner or his own personal financial transactions, right? Okay. They have to represent the activities of the company only. Next, we move on to the going concern assumption. What does that mean? The company will continue to operate for the foreseeable future. We assume that the company is not going to go bankrupt in the next few years, right? So we're going to assume that they will continue to operate in the near future. Next, the monetary unit assumption states that all financial transactions should be recorded in the same currency. Okay, when you have them all in the same currency, it's easier to put everything together and it's easy to understand, right? So if it's an American company, of course you expect them to report all the numbers in US dollars. Finally, the time period assumption states that financial statements should be prepared for a specific period of time, like a month or a quarter or a fiscal year, right? Depending on your reporting period. Okay. Then we'll look at some of the key principles that guide financial accounting. Okay. First, we start with the historical cost principle. Assets should be recorded at their original cost, and that this cost should not be adjusted for inflation or other factors, right? Okay. Assets have to be recorded in the cost in which they were acquired, right? That's what I mean by historical cost, right? And this cost should not be adjusted in any way. The revenue recognition principle states that revenue should be recognized when it is earned, not when it is received in the form of cash. Because cash could be paid in advance or cash could be paid later, it doesn't matter. Revenue should be recognized when it's being earned. To go along with the revenue recognition principle, we have the expenses matching principle, okay, which states that expenses should be matched with the revenue they generate, because expenses should be recognized in the same period as the revenue they help generate. Next, as per the full disclosure principle, all relevant information about a company's financial performance should be disclosed in its financial statements. So according to this principle, companies cannot hide very specific sensitive information that can be useful for investors, right? Full disclosure is key. Finally, we move on to conservatism principle. According to this principle, accountants should err on the side of caution when making estimates. When you make estimates, you have to be conservative. So when you estimate assets or revenues, you have to make sure that you don't overstate them in any way. Before we look at financial statements in detail, I would like to introduce to you what accrual accounting is. More precisely, we'd be looking at the differences between cash-based accounting and what accrual-based accounting is. In accounting that is cash-based, we record all kinds of revenues and expenses whenever cash is received or paid. But under accrual accounting, we record revenues and expenses whenever they are incurred, regardless of when cash is paid or received. We saw a few moments ago the revenue recognition principle, right? So accrual accounting is based on that particular principle, okay? Revenue and expenses are recorded whenever they are incurred. Obviously, cash accounting is simpler to understand and use because whenever cash is received or paid, a transaction is being recorded. But accrual accounting is a bit more complex, right? It requires sophisticated procedures to define when revenues or expenses are going to be recorded, okay? Cash-based accounting is often used by small businesses, right? If you're a small business, typically all your transactions are settled in cash immediately, right? If a customer buys a product or a service from your business, typically it's going to be settled in cash immediately, right? On the other hand, accrual accounting is often used by large businesses, right? Why might that be the case? Because cash accounting may not provide a clear financial picture, right? You might end up reporting profits when you're actually losing money, for example, right? So accrual accounting takes that into consideration. If you really think about it, in the long run, there shouldn't be any differences between whichever method you choose, right? But in the short run, accrual accounting really helps to provide you a clear picture of your financial health and performance and doesn't provide any misleading numbers to investors, okay? Okay, now we'll look at the different financial statements in a bit more detail. Okay, we'll start with the balance sheet. We've already been introduced to the balance sheet equation in session 1. Okay, we saw that the sum of your assets should be equal to the sum of your liabilities and stockholders' equity. Assets are all the resources a firm owns, like cash, inventory, machines, all these can be classified as assets. On the other side of the equation, liabilities and stockholders' equity are everything a firm owes to its creditors or its owners, right? Okay. Under liabilities, you find everything the firm owes to its creditors or suppliers, for example. Under stockholders' equity, you find everything that a firm owes its owners, right? Or stockholders if you're talking about a big public company, right? Okay. Okay, why do we expect this equation to always stay in balance? If you think about it, how does a firm initially raise funds? Either they can borrow some money from their creditors or the owners themselves can invest their own funds into the company, right? Okay. This initial capital can be used to buy assets for the firm. So it's easier to follow why the balance sheet equation stays in balance at the beginning, but as a company goes through its operations every year and starts generating a profit, this profit is eventually owed back to the owners. Okay. So whatever profit that is raised, which is in the form of cash, is owed back to the owners eventually, right? So this equation gets bigger on both sides as a firm becomes more profitable and starts growing more and more, okay? But it always stays in balance. It can be harder to visualize why it always stays in balance, but don't worry. I will take you through an example and you will see that how at every step of transactions, the balance sheet always stays in balance, okay? Okay, we'll look at some of the most common accounts that fall under assets, liabilities, or stockholders' equity, right? Remember, a balance sheet shows the balances of all these accounts at any point in time. It's similar to the bank balance in your own personal bank account, right? Okay. For example, cash shows you how much cash the firm has at the end of the reporting period. Okay, how do we identify which accounts are typically classified under assets? Assets or entities that are valuable right now or that can bring some kind of future benefit, right? So for example, accounts receivable is something that brings you a future benefit, right? Okay. You don't have that cash right now, but your customers are going to pay you later. Okay. So that's an asset. Inventory is an asset because you can sell it and convert into cash at some point, right? Prepaid expenses, for example, are an asset because you paid for an expense in advance and you would benefit from that in the near future. So for example, if you paid for insurance in advance, you benefit from using that insurance in the future. Okay. Any long-term investments or plant, property, and equipment are classified as assets because they can help you generate cash in the long run. Assets can also be intangibles, for example, patents, which can also help you generate cash in the long run. On the other side, liabilities are everything that you owe your creditors, right? For example, accounts payable. If you bought something from your suppliers and you haven't paid them yet, then that's classified as an accounts payable. That's a liability because you owe your suppliers in the near future. You're liable to pay to them in the near future. Okay. Accrued expenses are a liability because you've incurred certain expenses but you haven't paid for them yet. Okay. Unearned revenue is a liability because your revenue has not been earned yet. Okay. Your customer has paid you cash in advance, but in order to earn the revenue, you have to provide them with the service or product you promised to deliver, right? Until then, this revenue is unearned and hence it's a liability. It's a liability because for some reason, if you're unable to deliver this product or provide the service in the future, you might have to return the money that has been paid by your customer in advance. Finally, under stockholders' equity, you find everything that has been invested by your owners or shareholders, okay? And under retained earnings, you will find all the profit that has been generated and retained by the firm. Earnings is just another word to specify profits, right? Okay. So profits that have been retained by the firm, you will see under stockholders' equity. Because eventually stockholders' equity is everything that the firm owes its owners, right? So it's just a way of showing that the profit that has been retained by the firm is owed to the owners eventually. Okay, so what does a typical balance sheet look like? So let's say the fiscal year for a firm ends on December 31. A typical firm would report its assets in the order of its liquidity. Okay, for example, it would report its current assets first and then its non-current assets. Under current assets, you would find cash and every other asset that can be converted to cash within a 12-month period. Okay, for example, accounts receivable or inventory, all these are classified as current assets because they can be converted into cash in the near future. Under non-current assets, you would find any kind of machinery, for example, right? You bought those machines with the intention of producing something and generating cash in the long run, right? And hence they are classified under non-current assets. Under liabilities too, we find current liabilities and non-current liabilities, right? Okay. Current liabilities are liabilities that mature within a 12-month period. For example, what you owe your suppliers in the form of accounts payable would be classified under current liabilities. Okay. But if you have a long-term bank loan, okay, what you owe in the next 12 months would fall under current liabilities. Everything else would fall under non-current liabilities. We'll look at each section of the balance sheet in a lot more detail in the forthcoming sessions, right? So you don't really have to make an effort to memorize which accounts go under assets, which accounts go under liabilities, because as you follow the rest of this course, you see that these account names are repeated over and over and over again, and eventually you reach a point where you just know where each of these accounts belong to, okay? So there's really no incentive in trying to memorize these account names and trying to classify them, okay? Finally, you find stockholders' equity and the total of liabilities and stockholders' equity in the balance sheet, okay? And that total should match the total assets, okay? Because of the balance sheet equation. Next, we'll look at the income statement. A typical income statement lists all the revenues and all the expenses and eventually shows the calculations that lead up to the net profit generated by the firm. Then the statement of retained earnings takes the net income from the income statement, adds it to the beginning retained earnings for that time period, subtracts whatever dividends that have been paid, and calculates what's the retained earnings at the end of that time period, okay? This retained earnings at the end of the time period is reported in the balance sheet, okay? Under stockholders' equity, you would show retained earnings being reported. So ideally, you would want to do the income statement first, then the statement of retained earnings, and then follow it up with a balance sheet. Eventually, you'd also want to create the statement of cash flows. This statement classifies the cash transactions into three categories, okay? Under operating activities, under investing activities, and cash flows under financing activities. And then putting it all together with the balance they had at the beginning of the year, you can also calculate the cash that is left at the end of the year. Okay, this is also reported in the balance sheet under assets. Okay, this is how all the four financial statements somehow work together. Okay, now that we've laid all the groundwork, we can move on to what you came here for, to learn about the accounting cycle. In the rest of the session, I will take you through how to prepare journal entries, how to prepare your trial balance, how to prepare your financial statements, and then we'll conclude with the closing process, which helps you to reset for the next time period. Okay, just the second step, how to make adjustments at the end of each closing period, will be covered in the following session, which is session 3. Okay, let's get started with the first step on how to make journal entries. Okay, I will introduce you here to the double entry bookkeeping system of debit and credit. Okay, you'll have to put aside your real world understanding of what debit and credit means and just try to understand what I'm going to take you through right now. Okay, you can show journal entries in several ways. One of those ways is using a T account. Okay, you would write the name of the account on the top of the T, and if the account has to be debited, you would use the left hand side of the T to specify that, or if that particular account should be credited, you would specify that on the right hand side. Okay, so now we move on to the $1 million question for a beginner, right? How do we know which account to credit and which account to debit? Okay, a simple rule of thumb for a beginner to follow is to understand that a benefit is being provided from one account to the other. Okay, if you identify the source of this benefit, you would credit that account. And if you identify the destination of this benefit, you would debit that account. Okay, let me take you through that using an example. Okay, let's say you're spending some cash to buy some supplies. Okay, the cash you spend is the source of this benefit, right? So the cash account should be credited. Okay, on the other side, the supplies or the inventory account, which is the destination of this benefit, okay, that account would be debited. Okay, so if you're a beginner, this simple rule helps you not make mistakes in very simple transactions, right? You will see that this makes a lot of sense in several simple transactions, okay? But as you make more and more journal entries and you move on to more complex transactions, you will move to a larger framework that helps you identify which accounts should be debited or credited. This framework shown here should help you make journal entries for almost any type of transaction, okay? So we saw in the previous slide that if you spend some cash to buy some supplies, the cash account is going to be credited and the supplies or inventory account is going to be debited. Okay. you can see that cash and inventory are both assets. Okay, when the cash account is being credited or when the cash goes down, okay, your inventory goes up or your inventory account is being debited. Because both these accounts are assets, you can simplify it in a format to say that for any asset, if it goes up, you have to debit that account. Or if an asset goes down, you would have to credit that account. We'll keep this as a starting point and we move on to the other side of the equation. Okay, for liabilities, you're going to flip what you learned about assets. Okay, if a liability goes down, you would debit that account, or if a liability goes up, you would credit that account. Okay, for example, if your accounts payable, which is a liability, if it increases, it means you should credit that account. Staying on with what you learned about liabilities, you would follow the same for stockholders' equity. Okay, so for any type of stockholders' equity, okay, if the account has to go down, you would debit that account, or if the account goes up, you would credit that account. Under stockholders' equity, it is important to include revenues and expenses as part of the framework because you will go through a lot of journal entries that fall under the category of revenues or expenses, right? Deducting expenses from revenue eventually gives you your net income, and after deducting dividends from that, you would end up with your retained earnings. Okay, so the higher the revenue, the more retained earnings would be reported under stockholders' equity, and hence revenues follow the same sign of debit and credit as stockholders' equity. Okay, so when your revenue goes down or if there is a revenue reversal, you would debit that account. Okay, or if your revenue goes up, you would credit that account. Okay, because expenses are inversely proportional to retained earnings. What do I mean by that? When expenses go up, retained earnings go down. So if you'd like to record an expense, you would have to debit it, okay? Or if you would like to reverse an expense for whatever reason, you would have to credit that account. So if you're somewhere in the beginner to intermediate stage on your financial accounting understanding journey, okay, then this framework can be considered a good starting point in helping you make these journal entries. Okay, now let's look at how to actually show these journal entries, right? Okay, we already saw how a T account works, okay? You write the name of the account at the top, and if you're going to debit that account, you would write that on the left-hand side, or if you're going to credit that account, you would write that or show that on the right-hand side, okay? You can also show journal entries in the following manner, okay? You can first show the accounts that have to be debited and follow that by the accounts that have to be credited, okay? But when you show the accounts that are to be credited, you should indent those account names a bit so it's obvious that those accounts have been credited, okay? This practice also helps you verify if the sum of the debits is equal to the sum of the credits, okay? The reason I specify here accounts in the plural form is because you will see later that maybe there are cases that more than one accounts are debited or credited, okay? So it doesn't have to always be one account that is debited and one account that is credited. So enough talk about how to do debits and credits. We're going to dive into actually doing them using an example, okay? I'm using a fictitious example here where I take you through the setup of a company, okay, and all the transactions in a single month, okay? And in the closing process, we will see how the temporary accounts are being reset at the end of the month of January so that they can be used for February, for example, okay? Okay, let's look at transaction A. On the 1st of January, Joe, who is the founder of the business, okay, Joe invests $5,000 of his own funds to set up a retail business. So Joe is investing 5,000 of his own funds, right? Okay, so stockholders' equity should obviously go up by 5,000, and the business now is in possession of $5,000 of cash. Okay, so cash should also go up by $5,000. Okay, so if you go back to the framework, cash goes under assets. Okay, so the cash account should be debited by $5,000, and stockholders' equity, okay, should be credited $5,000. Okay. So cash, which is an asset, will be debited by $5,000, okay? And under stockholders' equity, we're going to call the account contributed capital to denote the capital that has been contributed by the owner, right? Joe is the owner who is investing 5,000 of his own funds. So for now, we're just going to call it contributed capital. So if you go back to the balance sheet equation, okay, you can see that on the left side, assets goes up, okay? On the right side, stockholders' equity goes up, okay? So the equation stays in balance, okay? 5,000 on the left side and 5,000 on the right side. Okay. You can also make the journal entries using the T account. Okay. Cash is being debited. Okay. And contributed capital, which goes under stockholders' equity, is being credited. Okay. I've used a color coding to make you visualize this easier. Okay. For assets, I'm using this kind of a greenish color. Okay. So for any accounts that fall under liabilities or stockholders' equity, okay, I show them using this kind of orangish brown color, whatever you want to call it. Okay. Let's go on to transaction B. Okay. On the same day, which is the 1st of January, Joe rents an office space for $650 by paying cash. Okay. So the same day, he's paying $650 cash. Okay. Okay, we go back to the framework. We can see that cash has to be credited. Okay, we are paying cash of $650. Okay, so that account has to be credited. Renting an office space is an expense, right? You're using that space to conduct your business, right? Okay, so that rent should be an expense. Rent expense is a type of expense which decreases your stockholders' equity. Okay, what I show here in the bracket for you as a beginner, it's easier to comprehend what's going on in the overall process, right? Okay, you can visualize that, okay, there is an expense which goes on the right side under stockholders' equity, but stockholders' equity actually goes down because of this expense. Okay, so rent expense would be $650, okay, while cash is being credited $650. Okay, you can stop me here and ask me, okay, how did you really know that it's an expense, right? Okay, I would like to set up a couple of guidelines for you to visualize what accounts are going to be debited or credited, right? Okay, every time you see a transaction, first you would ideally have to visualize whether this could be a revenue or an expense. Okay, in this case, you're actually spending money into renting an office space, which is an operational expense, right? So this becomes an expense. So the first step is to see whether there is a revenue or an expense as part of this transaction. But if you identified that the transaction is neither a revenue or expense, okay, now you've simplified it. The journal entry can neither be a revenue and expense, okay, so now your choices are limited and it's easier to make the journal entry. The second guideline is much simpler, that you always look at whether a cash transaction has happened, okay. Try to follow if you received or paid cash, okay, and make this as part of your journal entry, okay. If no cash has exchanged hands, it's fine, right? Okay, but make sure that you always look for this at the beginning to keep things simpler. Moving on to transaction C, on the 5th of January, Joe buys 50 football shirts for $70 each by paying cash. He's still paying for everything almost exclusively by cash, right? Okay, 50 shirts for $70, so that's $3,500, okay? He's paying cash of $3,500. So cash has to be credited by $3,500 because it's an asset that is going down. His intention is to sell these 50 shirts later, okay? So that goes under assets as part of the inventory, okay? So inventory as an asset goes up, okay? And that would be debited by $3,500. And cash, which is an asset that goes down, that would be credited $3,500. Again, inventory is debited $3,500 and cash is credited $3,500. This is an example of a transaction that in a balance sheet equation, both the accounts that are affected belong to the left side of the equation. Okay, inventory and cash are both assets. One goes up and the other goes down, and the equation still stays in balance. Okay, so you don't have to always look for either side of the equation. It can so happen that they belong to the same side of the equation and the equation still stays in balance. Okay, moving on to transaction D, on the 7th of January, Joe borrows $1,500 from a local bank. He's been using up all his cash, so he feels like he needs to borrow some money. Okay, so when he borrows $1,500 from a bank, okay, it creates a liability that he owes this bank. Okay, the most obvious journal entry is that he receives a cash of $1,500. So cash is an asset that would be debited by $1,500. Okay, he owes the bank $1,500. Okay, so that's a liability. We're going to call it note payable. Okay, when you borrow money from a bank, it's in the form of a very formal note, right? You promise to pay back later. So you have to make a journal entry for a note payable. Okay, it's a liability and you're going to credit that account by $1,500. So again, on the balance sheet, you see that the assets go up by $1,500, okay, and the liabilities go up by $1,500. So the equation stays in balance. Looking at the T accounts, cash will be debited $1,500, so it goes on the left, and note payable would be credited, so it goes on the right. Okay, moving on to transaction E. On the 16th of January, Joe fulfills an order from a customer, okay, fixed ports, for 30 shirts at a price of $100 each. Okay, the customer pays $700 in cash and promises to pay what is owed later. Okay, by later, he could pay any time later in the same month or the next month or whatever has been agreed upon. So let's try to break down the numbers. Okay, he sells 30 shirts for $100. Okay, so 30 times 100 is 3,000. Okay, so now going back to the first guideline I gave you, you start thinking of whether there is a revenue or expense involved in this transaction. Okay, you're selling 30 shirts for $100 each to a customer. That can be identified as revenue, right? You make a revenue of $3,000. Okay, but are you collecting cash for the entire $3,000? You're not, right? The customer pays only $700 in cash. Okay, so the remaining $2,300 will be paid later. Or for you as a company, it's a receivable. Okay, so cash would be debited $700 because your asset goes up by $700. You have an accounts receivable for the remaining amount, right, which is $2,300. Okay, that's also an asset which will be converted into cash in the future. On the other side, you have a sales revenue, okay, which increases your stockholders' equity by $3,000. That account would be credited because it's a revenue account. Okay, so putting them in the form of T accounts, cash goes up $700, debited. Accounts receivable goes up by $2,300, hence it's debited. Sales revenue on the other side, which falls under shareholders' equity, is being credited by $3,000. Okay, everything stays in balance. The total of the debits is equal to the total of credits. Okay, but I would like you to think if we are done here. Think about the 30 shirts that have left your premises and have been delivered to the customer. In the previous step, when you bought them, they were part of your inventory. Okay, now out of the 50 shirts, 30 shirts have left your inventory and have been delivered to the customer. And this has to be shown in the form of a journal entry. How do we show that? So your inventory has to be reduced by the value of those 30 shirts. Okay, how do I define value? These shirts were bought for $70 each and were sold for $100 each. Okay, the way your inventory is valued is always at cost, the cost at which you purchased it, right? At $70 per shirt. Okay, so your inventory here would be reduced by the value of 30 shirts multiplied by 70, 2,100. Okay, so your inventory would be credited by $2,100. To specify that you've sold 30 shirts and your inventory value has gone down by that much. Okay, so how do we identify what account has to be debited? When you sell 30 shirts which were valued at $70 in your inventory, okay, that becomes the cost of your goods sold. Cost of goods sold is an expense that goes under stockholders' equity. Okay, an expense decreases the stockholders' equity. Okay, that account would be debited. If you go back to the framework, okay, you can see that an expense account is always debited. Now let's try to visualize the whole transaction together. You have a sales revenue of $3,000. Okay, you also have a cost of goods sold of $2,100. Okay, both of these go under the income statement. Okay, you have a revenue of $3,000 and the next line is the cost of goods sold of $2,100. Okay, the profit you generated in this transaction is $3,000 minus $2,100, which is $900. You sold 30 shirts at $100 each. The cost of each was $70. Okay, so you generated a profit of $30 per shirt for 30 shirts. So the overall profit is 30 times 30. That's $900. Okay, so if you'd like to remember this as another guideline, that's fine too. So anytime you sell something, that particular item leaves the inventory and is reported under cost of goods sold in the income statement. Okay, let's go on to transaction F. On January 25, Fixed Ports, the customer who bought from you earlier, he pays cash of $1,100. Okay, he owed you $2,300. So out of that, he's paying you $1,100. Okay, now things get a lot simpler, right? So you get cash of $1,100. Okay, So cash is debited 1,100. Okay. Out of the 2,300 accounts receivable, you have to deduct that by $1,100. Okay. So accounts receivable is reduced by $1,100. Okay. So you have a receivable of 2,300 and I'm removing 1,100 from that. Okay. So you still have some accounts receivable left. Cash is debited 1,100 and accounts receivable is credited 1,100. The next transaction, transaction G, on the 29th of January, Joe hires a designer to perform a task for $150. Okay. He promises to pay the designer in the following month. Okay. He's going to pay the designer in February. Again, going back to the guidelines I specified earlier, okay, try to think of whether this could be a revenue or an expense, right? You're hiring a designer to perform a task for you. Okay, so obviously it's an expense because they are providing you with a service. Okay, so that expense, let's call it design expense, is going to be debited by $150. Okay, because you're not paying cash, you're promising to pay them later. Okay, you have an accounts payable, which is a liability. Okay, because you owe the designer and you will pay them in the future. Okay, so that account would be credited by $150. Okay. So the design expense, which is an expense, would be debited 150 and accounts payable, which goes under liability, would be credited 150. So once all the journal entries have been done, we can observe them in the general ledger and we can calculate their balances before we create the trial balance. Okay. If you look at the cash account, it was debited in the first transaction, then it was credited, then it was credited again, then it was debited furthermore. Okay. So you can find the balance by adding up all the debits and adding up all the credits, okay, and finding the difference. If the debit balance is higher, you would show the balance on the debit side. Debit accounts like assets typically have a debit balance, right? Okay. So for example, inventory can never have a negative balance, right? It cannot have a credit balance. Okay. So you have an inventory of 3,500 which was debited, and then when you sold goods which were worth 2,100, you're left with goods which are worth 1,400. So you will try to calculate and identify the balances of all these accounts in the general ledger. At this point, I have to state that the trial balance can be created at this step, okay, to ensure that the sum of the debits is equal to the sum of the credits, okay, before making any adjustments, okay. After the adjustments are made at the end of each fiscal period, okay, you update the trial balance so that the adjustments are reflected. And again, you can verify that the sum of the debits is equal to the sum of the credits. The second step, which is making adjustments, will be covered in a lot more detail, okay, in the next session. Okay, in part 3, we will look at them in a lot more detail. But just briefly, why do we make adjustments? Okay, because we want to ensure that the revenues are recorded when they are earned and expenses are also recorded when they are incurred. Okay, so we have to ensure that adjustments are made at the end of each period, okay, to get the revenues and expenses in the right period. Okay, we have the entire third session dedicated just to adjustments. So we're going to look at step 2 in a lot more detail later. Okay, so for now, we're just going to skip the step and assume that this company doesn't have any adjustments to make, and we're going to move on to how to make a trial balance. Okay, so how do we prepare a trial balance? We use the general ledger balances, which I showed earlier, okay, and we organize them based on the statements they will eventually end up in. You're going to arrange the accounts so that all the balance sheet accounts are together, all the income statement accounts are together. Okay, we'll see how to do that. Okay, and then you show the debit and credit balances of these accounts so you can verify once again if the sum of all the debits and the credits are the same. Let's see how to do this for our example. Okay, so we organize it in a way where we show all the balance sheet accounts first. Okay, cash, accounts receivable, inventory. So these are all the assets which have a debit balance. Okay, then we have the liabilities which have a credit balance. Okay, contributed capital, shareholders, it goes under shareholders equity. Okay, then we have all the revenues and expenses clubbed together. Okay, we know that these accounts go into the income statement. Okay, so we show their credit and debit balances too. Okay, once we've organized them in this format, we can see that the total sum of the debits is equal to the total sum of the credits. Okay, where did I get all these numbers from? From my general ledger. The final balances of each of these accounts are being reflected in the trial balance. Once the trial balance has been created, the next step is to create the financial statements. So how do we prepare the financial statements? We match the accounts from the trial balance to the respective financial statements and prepare them in the following order. Okay. First, you prepare the income statement. Okay. So you have the revenue and the expenses information provided in the trial balance. You would use that to prepare the income statement. Okay. Why do you do that first? Because using the net income you calculate in the income statement, you can use that information for creating the statement of retained earnings. Okay. Once you have the retained earnings balance, you can use that in creating the balance sheet. Okay. Let's see how to do that in our example. First, for the income statement, we have a sales revenue of 3,000. Okay. We have our cost of goods sold, which has to be deducted, which is an expense. We have a rent expense and design expense. They're all expenses and they are deducted from the revenue. Okay. And so you have a total profit of $100 for the month of January. Keep in mind that for now, we've ignored any kind of tax implications. So you have a net income of $100 for the month of January. Then we go on to the statement of retained earnings. Okay, because this is a newly set up company, the beginning retained earnings is 0. Okay, the net income of $100 was obtained from the income statement. Okay, and the dividends paid is 0. Okay, there has been no mention of any dividends. Okay, so the ending retained earnings is 0 plus the 100 minus that 0. So you have a ending retained earnings of $100. Okay, that goes into the balance sheet. Okay, looking at the balance sheet, okay, again we get the balances of all these accounts from the trial balance we saw earlier, right? Okay, so we have the trial balance, we have these balances, so we organize them under the balance sheet. So cash, accounts receivable and inventory go under assets. Okay, accounts payable and notes payable go under liabilities. Okay, under equity you have contributed capital 5,000 and retained earnings of the 100 we just calculated in the statement of retained earnings. Okay, so together shareholders equity is calculated as 5,100 and liabilities and equity together add up to the same as your total assets. Okay, so in the balance sheet you have to see that the total assets is always equal to the sum of the liabilities and shareholders equity. If you are a beginner, this is something you can always struggle with, right? Balancing the total of assets with the total of liabilities and shareholders equity, and then trying to go back and debug where you might have made a mistake, right? What I would like to show you now is the balance sheet after each transaction so that you can really try to visualize that it's being balanced at each step, right? This can help you in the debugging process whenever you run into a balance sheet that is not balanced, right? Okay, so for example, let's see after transaction A, okay, where Joe invested 5,000 of his own funds, you can see that at the end of transaction A, the balance sheet is balanced, right? So there's 5,000 under assets and 5,000 under equity. Okay. After transaction B, okay, cash went down by $650 and there was an expense of $650. Okay. Remember I told you revenue minus expenses leads to net income. After deducting any dividends paid, what is left is the profit that is retained by the firm. Okay. Hence retained earnings right now is negative 650 because you only have an expense. You don't have any revenue yet. Okay. I'm just trying to show you in a simplified format what the balance sheet looks like at the end of transaction B. Okay. If my month had ended at the end of transaction B, my balance sheet at the end of the month would have been exactly what you're seeing on the screen right now. Let's see what it looks like at the end of transaction C. Okay. You're buying 50 shirts for $70 each. Okay. So your cash went down even further, your inventory went up. Okay. No change on the other side. Okay. And hence it stays in balance. Okay. After transaction D, your liabilities go up. Your cash went up by 1,500. Again, it stays in balance. Transaction E, you're selling shirts, 30 shirts for $100 each. So now you can see you're already making some revenue, right? So you're adding a revenue of $3,000 and you're subtracting the cost of goods sold. You can already see your retained earnings is starting to be positive, right? Your cash went up, also your accounts receivable went up and your inventory went down. Okay, you can pause the video at any time and do the math yourself to see if everything matches what you see. Okay. After transaction F, you can see that cash went up and receivables went down. Okay, and the final transaction. So now you would see that the balance sheet matches what we saw earlier, right? Okay. So as you do more and more transactions, you're able to visualize this change happening in the balance sheet. That's why it's important as a beginner that you always see how this affects the balance sheet equation, right? How every single transaction affects the balance sheet equation, and at the end, it still stays in balance. Next, we'll look at how to create the statement of cash flows. Okay, we'll look at it in a lot more detail in the 11th session of this financial accounting course. But for now, let's see how to calculate the cash flow from operating activities. Okay, everything was operations except probably how much cash was contributed by the owner and how much cash was borrowed from the creditors, right, from the bank. Okay, except for that, all the other cash flows should be from operating activities. Okay, no investments were made, so cash flow from investing activities is 0. Cash flow from financing activities, okay, that's the 5,000 plus the 1,500 that had been borrowed. Okay, so change in cash is overall 4,150. Because it's a newly set up business, cash at the beginning was 0 and cash at the ending of the period is $4,150. You can try to do the cash flow from operating activities yourself to see if you get a negative $2,350. Okay. The final step in the whole accounting cycle is the closing process. Why do we need a closing process if we've already created the financial statements? We just created the income statement for the month of January, right? Using our example, we just created all these statements for the month of January. Okay. When we move on to creating the income statement for the month of February, we want the revenues and expenses accounts to be reset to 0 because what we sold in January should not be reflected in the income statement for February, right? So at the end of January, we have to reset all the income statement accounts, or we can call them temporary accounts. We have to reset them to 0 so that they can be ready for the next month. Okay. But balance sheet accounts should not be reset, right? The cash balance should not be reset to 0. Okay. The cash balance is carried forward from one period to the other. Okay. These are permanent accounts. Okay. So you don't have to do any changes for balance sheet accounts. Let's get back to our example and see what we'll have to do during the closing process. Okay. First, we are going to close all the revenue accounts, okay, into another temporary account. We're going to call it income summary. Okay. So sales revenue, we had a revenue of $3,000 during the month of January. Okay. Remember, revenue is a credit account. Okay. By debiting the revenue account, I'm reversing the revenue that was earned in January. Okay. Or in other words, I'm removing the revenue account and I'm resetting it to 0. Okay. So I would credit the income summary account to store my revenue of $3,000 in that particular account. Okay. So income summary is being credited and sales revenue is being debited. Okay. Next, I would close all my expense accounts and transfer it into income summary again. Okay. Expense accounts are typically debited, right? Okay. But when I'm reversing them or resetting them to 0, I'm going to credit all these expense accounts. Okay. And I'm going to make them to 0 and I'm going to transfer them into the income summary account. Okay. Now I'm debiting the income summary account. Okay. All the expense accounts would be closed and they would be transferred to the income summary account. Okay. Once that process is done, okay, the income summary account, okay, you see that it was credited 3,000 in the first step and was debited 2,900 in the second step. Okay. So it has a credit balance of 100. That credit balance of 100 is reversed by debiting. Okay. By debiting the income summary account by $100, I'm also closing the income summary account. Okay. And I'm transferring the 100 to the retained earnings account by crediting that by $100. But retained earnings account is a permanent account. Okay. This stays under shareholders' equity in the balance sheet. So we closed all the revenue accounts, all the expense accounts and transferred them into the income summary account. Okay. Then retained earnings absorbed all this. Okay. And all the other temporary accounts have been closed. And retained earnings is an account which can absorb all the profits that are generated in the future periods too, right? So here we transferred the $100 profit into retained earnings for the month of January. And then whatever profits are generated in the month of February will also be absorbed into the retained earnings account. And now we can see the trial balance which has been updated after closing, right? We can see that all these temporary accounts are closed, okay, and they are being transferred to the retained earnings account, which shows a balance of $100. Okay. With this, we conclude this session on the accounting cycle. In the next session, we'll look at making adjustments in a lot more detail. Thank you for watching. Cheers. Hello there. Welcome to session 3 in this course on financial accounting. In this session, we'll be looking at how to make adjustment entries at the end of each reporting period. In the previous session, we looked at the entire accounting cycle. We just skipped this part on adjustment entries so that we can look at it in a bit more detail in a separate session. In this session, we'll start by looking at why adjustments are necessary and why they are made, okay? And then we'll look at the different types of adjustments, namely deferred or unearned revenue, accrued revenue, deferred or prepaid expenses, and accrued expenses. Finally, we'll look at these 4 categories using an example. Okay, to begin with, why make adjustments? Because cash may not be received or paid whenever revenue is earned or expenses are incurred, right? Okay, cash can sometimes be received before the revenue is earned, or it can be paid before expenses are incurred. This situation results in a deferred revenue or expense. Deferred means postponed, right? Okay, which means cash has been collected or paid earlier. Okay, revenues and expenses have been deferred. Cash can also be received when revenue is earned, and cash can also be paid when expenses are incurred. Okay, in this case, you don't need to make any adjustments because as and when revenues and expenses are recorded, okay, cash is being recorded at the same time. Cash can also be received after revenue is earned, or cash can also be paid after expenses are incurred. The word accrued means accumulated. So in this category, revenue or expenses are being accumulated and cash is paid or received later on. Okay, in the previous session, we looked at some of the principles that guide financial accounting. Okay, one such principle is the revenue recognition principle. Okay, according to this principle, we stated that revenues should be recorded when they are earned. So regardless of when cash is collected, revenues have to be recorded as and when they are earned. Sometimes revenues can be earned in multiple time periods, right? So at the end of each time period, you have to make sure that you record the revenues that have been earned in that particular time period. Another principle we saw earlier was the matching principle or the expenses matching principle. Expenses are recorded when they are incurred to generate revenue. So whatever expenses are incurred to generate revenue should be matched in that same time period along with the revenue. In the accounting cycle, one of the steps was to create the trial balance, right? Okay. Before you make any end of the period adjustments, the trial balance you have is called as an unadjusted trial balance. And then after you make the adjustments, the new trial balance you have is the final adjusted trial balance. Using that, you can go on to create your financial statements and then go ahead with the closing process. If you'd like to review the accounting cycle again, you can go back to my video on session 2, where I take you through the entire process of creating journal entries and then creating the trial balance and preparing financial statements and so on. Okay, now we'll look at the 4 types of adjustments you'll see in the session. Deferred or unearned revenue. In this case, revenue is deferred, which means cash is received before revenue is earned. Accrued revenue. In this case, cash is received after revenue is earned. Okay. Deferred or prepaid expense. In this case, cash is paid before the expenses are incurred. Okay. And finally, accrued expense. In this case, cash is paid after the expense is incurred. We look at it using a timeline where it's easier to understand. When cash is collected before revenue is earned, okay, this falls under the category of deferred revenue. Okay, when cash is collected after revenue is earned, this category is accrued revenue. I want to bring to your attention that even though revenue is earned across multiple periods or expenses are incurred across multiple periods, okay, you always make an adjustment at the end of each time period. By making an adjustment at the end of this time period, you can ensure that all the revenue that has been earned up until that point is being reflected in the financial statements of that particular time period. Everything else that would be earned later would be reflected in the financial statements of the following time period. So you always make adjustments at the end of each time period so you can correctly capture the revenue earned and the expenses incurred up until that point. Okay, now we'll look at the 4 categories in a bit more detail. Okay, we'll start with the first one, deferred or unearned revenue. Okay, as the title states, the revenue has been deferred or postponed, right? Okay, or it hasn't been earned yet. Okay, when the cash is being collected, the revenue hasn't been earned yet. But with time, you start earning your revenue. But if you earn your revenue across multiple time periods, okay, you would have to make an adjustment at the end of each time period to make sure that it captures the revenue that has been earned in that particular time period. Let's look at how to make journal entries in the case of unearned revenue. First, when cash is received at this point, okay, when you collect your cash, you would want to debit your cash account. Let's just stick to a standard amount of, let's say, $100, okay? So cash would be debited by $100, okay? Because revenue hasn't been earned yet at this point when cash is being collected, okay? You would credit your unearned revenue account, okay, by that $100, okay? Why is unearned revenue a liability account? Because cash has been collected in advance for a service that hasn't been provided. If it so happens that in the future you're not able to provide the service, you might have to return the cash which you had collected earlier. Okay, and hence unearned revenue is a liability. Then when revenue is earned later on, okay, unearned revenue would be reversed, right? Whatever you credited, now you're going to debit unearned revenue account by $100, and then you would credit your revenue accounts by $100. So you're basically just reversing your unearned revenue entry, okay? And now you're transferring it to your revenue account. Eventually, by looking at them together, you would see that you have just debited your cash account and you credited your revenue account. So these are the standard journal entries you would make whenever you encounter deferred or unearned revenue. Okay. Next, we'll look at accrued revenue. Accrued means accumulated, right? In this case, revenue is being accumulated or earned with time, okay? But cash collection happens much later. But again, as in the previous case, if the revenue earned is spread across multiple time periods, you would have to make an adjustment that records the revenue earned in that particular time period, and whatever was earned later would be recorded in the following time period. Let's look at the journal entries for accrued revenue. First, when revenue is earned, you would credit your revenue account by $100, okay? Because cash for that revenue earned hasn't been collected yet, it would be recorded as a accounts receivable for $100, okay? So you would debit your accounts receivable account, okay, which is an asset because you would be able to collect this cash later on. So finally, when cash is received, you would obviously debit your cash account, okay? And by doing that, you should also reverse your accounts receivable because you don't have any more receivables, right? Okay. So you would credit your accounts receivable account by $100. So these are the standard journal entries you would be making in case of an accrued revenue. Okay. Next, we'll look at the two types of expenses adjustments. Okay. The first one is the deferred or prepaid expense. Okay. Cash is being paid before expenses are being incurred. Okay. Cash is paid in advance and hence they are referred to as prepaid expenses, right? And then the actual expense is incurred later. But as we've seen earlier, if this expense incurred is spread across multiple time periods, you will have to make an adjustment to capture the expense that has been incurred in this particular time period. So to be consistent with the other categories you've seen earlier, you would be making a journal entry at the end of each time period. Now let's see how to make the journal entries in this case. So when cash is paid in advance, you would credit your cash account, okay, and you would debit your prepaid expenses account. Prepaid expenses is an asset. Why is that? Because you're paying for something in advance and you will realize the benefit for this in the future. So because this brings you benefit in the future, this account is classified under assets, okay? And then later when you actually incur the expense, okay, you would debit your expense account to show that expenses have been incurred, and then you would credit your prepaid expense account in order to reverse the journal entry you made earlier, okay? Because now you've incurred that expense, okay? It's no longer prepaid. So this is the standard journal entries you would make in the case of a deferred or prepaid expense, okay? Finally, the fourth category is accrued expenses, where expenses are incurred and cash is paid later. Similar to the previous cases, if the expenses incurred are spread across multiple time periods, you will have to make adjustments at the end of each time period. By making these adjustments at the end of each time period, you can make sure that you're following the revenue recognition principle and the expenses matching principle. Okay, now let's look at the journal entry for accrued expense. Okay, when expense is incurred, obviously you would debit your expense account. Okay, but because you still have to pay for these expenses, you would credit your accounts payable account. Accounts payable is a liability account because you're liable to pay this later on. Okay. And finally, when you pay cash, you would reverse this accounts payable because you no longer have a payable. Okay. So you would debit your accounts payable account and you would credit your cash account. So these are the standard journal entries you would be making in the case of an accrued expense. Okay, so we've looked at the 4 types of adjustments so far separately. So the best way to make sure that you understand clearly and you remember these journal entries going forward is by putting them side by side and doing a comparison analysis. First, let's just focus on revenues. Okay, I've categorized them based on when cash is received. Okay, cash can either be received in advance, or cash can be received on time when revenue is earned, or cash can be received later after revenue has been earned. Okay, if cash is received on time, okay, you would debit your cash account and you would credit your revenue account. Okay, that's quite simple, right? Okay, if cash is received in advance, we know that it falls under the deferred revenue category. When cash is collected, the cash account is debited and you would credit an unearned revenue account, which is a liability. Okay, and later when revenue is actually earned, you would reverse the unearned revenue account, or you would debit that liability, and then you would credit your revenue account. Okay, we've seen this example earlier. Okay, when cash is received later, we saw that it falls under the accrued revenue account. Okay, so you would debit your accounts receivable account to show that you would collect this money later. Okay, and you would credit your revenue account. This is the journal entry you make when the revenue has been earned. Okay, later when cash is collected, okay, you would debit your cash account and you would reverse your accounts receivable to show that you don't have a receivable anymore. Okay, so you would credit that account. The advantage of putting these 3 cases side by side is that it helps you visualize these journal entries. So eventually, when revenue has been earned and cash has been collected, you can see that the journal entries made are not that different, right? Okay, here unearned revenue has been credited in the first step when cash is collected, and it's being debited in the next step. Okay, so that cancels out. So overall, you have a cash account that's being debited and you have a revenue account that's being credited. That's the journal entry you make when cash is received on time, right? Cash is being debited and revenue is being credited. Okay, under accrued revenue, okay, accounts receivable was debited in the first step, okay, and later when cash was collected, it was reversed, right? So that account is being cancelled out. Okay, you can see that cash is debited and revenue is credited. Again, it's consistent with what we saw in the previous 2 cases. So the only difference comes with the timing of when revenue is earned, right? If revenue is earned across multiple time periods, you will have to ensure that you make these adjustments. Looking at the expenses again from the same cash timing perspective, okay, if cash is paid on time, okay, you would debit an expense account and you would credit a cash account. But if cash is paid in advance, as in the deferred expense case, okay, when cash is paid, you would credit your cash account, okay, and you would debit a prepaid expense account, which is an asset. Okay, and later when you actually incur that expense, okay, you would debit the expense account and you would reverse the prepaid expense by crediting it. We can see that the prepaid expense account was debited in the first step and is credited in the second step. So by removing them, we can see that the final journal entry, which is debiting expense account and crediting cash account, it's very similar to the scenario as if cash was paid on time. If you look at the scenario where cash is paid later under the accrued expense category, okay, when expense is incurred, you debit the expense account and you credit the accounts payable account. And later, when cash is paid, you would reverse the accounts payable, or you would remove it because you no longer have a payable, okay? And then you would credit your cash account, okay, because you're paying cash. Again, we see that the accounts payable account, which was credited in the previous step, was reversed by debiting it, okay? So by removing them, we can see that the overall journal entry is again the same as before, which is debiting an expense account and crediting a cash account. It's even easier to remember if you look at the revenue and expenses categories put together. Visualize it like this. Okay, let's say there are 2 firms, firm A and firm B. Firm A provides services to firm B. Okay, so firm A earns revenues. Okay, so the journal entries for firm A are at the top, and firm B, which receives these services from firm A, okay, their expenses are shown in the bottom. So if when firm A provided the service to firm B, and if firm B paid the cash on time, then firm A's journal entries would be debiting a cash account and crediting a revenue account. And firm B's journal entry would be debiting an expense account and crediting a cash account. Now let's consider a scenario where firm B pays cash in advance to firm A for a service they would provide later. Okay, then firm A in their books would show a debit to a cash account, okay, showing that cash has been collected. And then they would credit their unearned revenue account to show that cash has been collected, but revenue hasn't been earned yet. On the other side, moving on to firm B, okay, they would show a debit to their prepaid expense account, showing that they've paid in advance, and there would be a credit to their cash account. Later, when firm A actually provides the service, okay, they would reverse their unearned revenue account, okay, and they would credit the revenue, okay. And for firm B, okay, they would debit their expense account and they would credit their prepaid expense account by reversing it. So as we've seen earlier, the unearned revenue journal entry is just being reversed in the next step. So by removing them, it helps to visualize that regardless of whichever scenarios, when cash is collected in advance or on time or later, okay, the overall journal entries should always match. It has to show that cash has been collected and revenue has been earned. Okay, cash has been collected and revenue has been earned. For firm B, when they've received the service, okay, they would debit their expense account to show that expenses have been incurred, and they would credit their prepaid expense account to reverse what was debited earlier. Moving on to a scenario where firm A would provide services to firm B and firm B would pay cash for this later, okay. When the service is being provided, firm A would record an accounts receivable, okay. They would debit their accounts receivable to show that cash would be collected later, and they would credit their revenue account. On the other hand, firm B would debit their expense account to show that expenses have indeed been incurred, okay, and they would credit their accounts payable account to show that they still owe money to firm A. Later, when cash is being paid, firm A would debit cash account and they would reverse their accounts receivable by crediting it to show that it's no longer a receivable. Firm B would reverse their accounts payable by debiting it, okay, and they would credit their cash account. This is the benefit of looking at it together, right? Firm A first debits its receivable and then credits it, okay. Firm B first credits its payable and then debits it to reverse it. So if we try to hide all these journal entries and their reversals, okay, we can see that the final journal entries are always the same regardless of when cash is paid. Overall for firm A, okay, all that you're doing is debiting a cash account and crediting a revenue account. And for firm B, you're debiting an expense account, okay, and you're crediting a cash account. Visualizing everything like this together ensures that you don't make any mistakes during your journal entries. And it also helps you in a way that you don't have to memorize anything. After you make a lot of these adjustment entries and you see that the final result is not what you expected, okay, then it's easier for you to go back and debug. So my recommendation would be this, that when you study these 4 categories of adjustments, that you always look at them together, you look at their journal entries together, you put them side by side and you start comparing them. By comparing them, you can actually see that they're very, very, very similar. Okay, now let's look at an example where we'll have to show the relevant adjustments at the end of the fiscal year, which is as of December 31. Let's look at transaction A. On the 1st of July, Joe agreed to provide consulting services to client A for a fixed fee of $9,000 for a total period of 9 months, okay, which is $1,000 per month. The client pays the entire fee in advance on the same day. Okay, let's look at what's happening on the 1st of July. Okay, Joe agreed to provide consulting services to the client. Okay, the client pays the entire fee in advance on the same day. Okay, so Joe is actually receiving cash of $9,000 from the client. Okay, so the cash account is being debited. Okay, but the revenue hasn't been earned yet. Okay, the revenue would be earned over the next 9 months. Okay, so there is an unearned revenue of $9,000. Okay, so that revenue has not been earned yet and hence it's a liability. Why is it a liability? Because if it so happens that Joe is not able to provide these services later on, he might have to return this cash. Okay, let's see if there is an adjustment entry to be made on the 31st of December. Okay, so from the 1st of July to the 31st of December, 6 months have passed. So Joe would have provided consulting services for 6 months as of December 31. So he would have earned 6 months of revenue. So he would credit a consulting revenue account, okay, to show that $6,000, okay, and $6,000 out of the unearned revenue should be reversed, okay. 6,000 out of the 9,000 is not unearned anymore, okay. So Joe has earned 6,000, only 3,000 remains unearned, okay. So by debiting unearned revenue account by $6,000, okay, Joe can show that he has earned $6,000 out of that $9,000. And then in the next time period, Joe would earn the remaining $3,000 by providing his consulting services, right? The journal entry for that would be made in the next time period. Okay, you would reverse the remaining 3,000 of the unearned revenue and you would book it as consulting revenue for that time period. Moving on to transaction B, on the 1st of September, Joe takes on a project for client B for a fee of $500 per month. Okay, the project lasts a total of 6 months. The client agrees to pay in full upon completion of the project. Okay, so the 1st of September, Joe takes on a project, okay, which will pay him $500 per month, but he will only get paid at the end of the project. Okay, let's see if there are journal entries on the 1st of September. As of the 1st of September, no cash has exchanged hands and no work has been done. Okay, on the 1st of September, there will not be any journal entries made. Okay, let's see if there's an adjustment that has to be made on the 31st of December. As of the 31st of December, Joe would have worked on the project for 4 months, okay, September, October, November, and December, okay, and for these 4 months, he would have earned a revenue of 500 times 4, $2,000, okay. On the 31st of December, he would credit his revenue account and show that a revenue of $2,000 has been earned. But cash has not been collected yet, okay. So he would debit his accounts receivable account to show that he will be paid later, okay, but he would show only the $2,000 that will be collected. So upon completion of the project at the end of February next year, okay, Joe would receive payment of 500 times 6, okay, he would get cash for $3,000, okay. He would book the remaining revenue for January and February, okay. So he would book a revenue of $1,000. He would say cash has been debited $3,000 because he's collecting cash, and he would reverse the accounts receivable, which is shown on the 31st of December. Okay, this accounts receivable will not exist at the end of February when cash is actually being collected. Moving on to transaction C, on the 1st of October, Joe paid $2,400 for insurance for 2 years. Okay, the insurance will go into effect on the same day. Okay, Joe is paying $2,400 for 2 years of worth of insurance. Okay, so that's 24 months. So that amounts to $100 per month. Okay, on the 1st of October, because he's paying $2,400, you would credit his cash account, okay, by $2,400. Okay, insurance has not been used yet. Because he's paying in advance, he would debit his prepaid insurance account to show that he has paid in advance $2,400. As of the 31st of December, 3 months have passed. Okay, so Joe would have used up 3 months of that insurance. Okay, 100 times 3, $300. So he would incur an insurance expense of $300. Okay, so he has used up $300 out of that $2,400 of insurance. And he would reverse his prepaid insurance for the same amount. Okay, so he would credit his prepaid insurance account by $300. Moving on to transaction D, on the 1st of December, Joe contracts a local maintenance firm to carry out maintenance of the office premises for a period of 4 months for $200 per month. Joe was able to negotiate a deal where payment will be made on March 31st the following year. So December 1st to March 31st the next year, that's 4 months, okay? So Joe contracts this firm for 4 months and he would pay them at the end of those 4 months. So on the 1st of December, no cash has exchanged hands and the maintenance firm hasn't done any work. Okay, so there are no journal entries on the 1st of December. But as of the 31st of December, the maintenance firm has already worked for 1 month. Okay, so they've earned that $200. Okay, so Joe incurs an expense of $200 by the end of December. Okay. So Joe would debit a maintenance expense account for $200, okay? But because he still hasn't paid any money yet, so he would credit his accounts payable account by $200 to show that as of the 31st of December, he owes this firm $200. But he will be making his payment on the 31st of March, once the maintenance firm has completed all 4 months of work, okay? Okay, so in this session, we've seen the 4 categories of adjustments, which is deferred or accrued revenues and deferred or accrued expenses. Okay. In some of the future sessions, we'll look at more practical scenarios of these adjustments. For example, in part 4, we'll look at how to make an adjustment for an allowance for bad debt. And in part 6, we'll look at making adjustments for depreciation and amortization expenses. Okay. And in part 7, when you take a loan, we'll look at how to make an adjustment for accrued interest. In the next session, we'll be looking at how to account for revenues and receivables in a lot more detail. Thank you for watching. Cheers. Hello there. Welcome to the fourth session in this course on financial accounting. In this session, we'll be covering accounting for revenue and receivables. So far, we've been looking at everything through a generic lens. We've been looking at the accounting cycle and also how to make end of period adjustments. From this session on, we're going to be focusing on the most important accounts in a bit more detail. We might also sometimes look at a few accounts together in ways that they make sense. So let's get started. In this session, we're going to be looking at accounting for sales revenue, Particularly, we're going to be looking at how to deal with credit card discounts, how to make journal entries when we have to pay credit card discounts, and also when we encounter sales discounts or sales returns. Eventually, we're going to be looking at how to account for bad debt. Whenever we make sales on credit, it is possible that sometimes some customers may not pay us, So we look at how to deal for that from an accounting perspective. So how is sales revenue actually reported in your income statement? Credit card discounts and sales discounts and all kind of sales returns and allowances are deducted from the revenue, and eventually only the net revenue that has been earned is reported in the income statement. So you might ask me why these discounts are not categorized as expenses, for example, right? The net revenue after making all these deductions shows a snapshot of what you actually sold to the customers, Hence it makes sense to deduct all these in your revenue part rather than showing them as expenses. Let's get started with how to do journal entries when you have to deal with a credit card discount. Let's look at that using an example. On the 4th of January, Joe sells 20 bottles for $10 each. The customer pays with credit card, and the credit card company, it charges a fee of 3% on every transaction. So when Joe sells 20 bottles for $10 each, he earns a revenue of $200. So revenue has to be credited for $200. So how much is the cash that is actually collected by Joe? Because the customer pays with his credit card, during the transaction, the credit card firm charges 3%, right? So 3% on the $200 transaction is $6. So the credit card firm takes away $6. So Joe receives a cash of only the rest, which is $194. So you debit the cash account, which is an asset, by $194. So what happens to the $6 that is charged by the credit card firm? It's being recorded as a contra revenue. We're going to call this account credit card discounts, which is a contra revenue account. What do I mean by a contra revenue account? It's an account that sits under revenues but reduces your revenue. Hence the X in front of R, to denote contra revenue. Credit card discounts is a contra revenue account, and hence it behaves the exact opposite of revenue when you do your journal entries. So when you have to book a contra revenue, you have to debit that account. So you debit this contra revenue account by $6, which brings down the overall revenue by $6, and in turn, the stockholders' equity goes down by $6. Next, let's look at how to deal with sales discounts that are offered to businesses. We'll look at how to make journal entries in the case of sales discounts very soon. But first, I would like to introduce you to a notation that is very commonly used between businesses. This notation shows how much of a discount a customer can claim by making payments early. For example, look at this particular notation, which can be read as 2, 10 and net 30. What does that refer to? If the customer pays within the first 10 days of receiving the invoice, the customer gets a 2% discount on the overall billable amount. But if the customer pays beyond that 10 days, then he has up to 30 days to pay that invoice. In that case, he would be paying the whole billable amount. So the notation is just a shorthand way of referring to everything we've just discussed. Now let's look at the journal entry in the case of when a sales discount is being used by the customer. On the 5th of January, Joe sells 30 bottles for $10 each with terms of 2, 10 and net 30. The customer pays on the 13th of January. On the 5th of January, when Joe sells 30 bottles, he earns a revenue of $300. So on the 5th of January, you would credit your sales revenue account by $300. Because the customer is yet to pay, he would debit his accounts receivable account by the same $300. Okay, so accounts receivable, which is an asset, would be debited by $300. Okay, because the customer pays on the 13th of January, it falls within the first 10 days. Okay, so if the customer had paid within the first 10 days, he would get a discount of 2% on the whole $300. Okay, 2% of $300 is $6. Okay, so the customer would pay only $294 because he's paying on the 13th of January. Okay, so Joe collects cash of $294 and hence cash is being debited by $294. And the $6 which is given as a sales discount should be recorded as a contra revenue account. Okay, sales discount is a contra revenue account. Okay, that is going to be debited $6. When you earn revenue, you credit that account. So when you have a contra revenue, you would debit that account. Finally, you have to reverse your accounts receivable transaction. Okay, hence you would credit the accounts receivable account by the $300 to show that you no longer have a receivable. So this is the journal entry you would make on the 13th of January. If the customer had paid outside of those first 10 days, then the journal entry is quite straightforward. Okay, when he finally pays, cash collected would be shown as $300. So cash would be debited $300 and accounts receivable would be credited $300. From a customer's perspective, when you look at such discount terms, should you take that discount? How do you come to the decision whether to take that discount or not? Okay, for a $100 purchase, a customer saves $2. Okay, so that's the 2%, right? By paying on the 10th day instead of paying on the 30th day. Okay, so for that extra 20 days, okay, the customer pays an additional $2 on every $98 he pays. Okay, so if he had paid in the first 10 days, the customer would have paid only $98. But because he's paying on the 30th day, he would have to pay that extra $2. We've assumed here that the customer would choose to pay on the 10th day or on the 30th day rather than on any other days. Because by holding on to that cash as long as you can until you really have to pay, okay, you can earn interest on that cash which is sitting in your bank account. So the comparison boils down to whether you make the payment on the 10th day or on the 30th day. So the interest rate you pay for that additional 20 days, okay, is that you're paying that extra $2 for every $98 you pay. So you're paying an interest rate of 2.04% for that additional 20 days. So if 2.04% is the interest rate for 20 days, then the annual interest rate is 365 days divided by 20 days multiplied by 2.04% is 37.23%. That's a very high annual interest rate. Usually when you borrow money from a bank, you could get it for way cheaper than 37%, right? Let's say you could borrow money for 5% or 10% from a bank, okay, which is way less than 37.23%. So for the customer, it definitely makes sense to take the discount and pay within the first 10 days. But then why would any seller offer you such payment terms with huge discounts? Because when a producer or seller is able to collect cash quickly, he can fund the next production process using that, and this can speed up the overall production cycle. So the seller doesn't have to wait these extra days to collect cash from the customer in order to fund the next cycle in their production process. Next, let's look at how to deal with sales returns. A customer might return goods for a variety of reasons. One, the goods might be damaged either before sending or in transit. Okay, so the customer cannot really use it, so he would return it. Okay. Or the customer could simply return the goods because it didn't meet his expectations, right? Okay, maybe he just didn't like any of the characteristics of the product, or maybe he ordered too much for whatever reason, he could return it. Okay, if the goods were damaged, you cannot resell it. Okay, but on the other hand, if the goods were returned for any other reasons, okay, you could put it back in your inventory and sell it again to other customers. So we'll look at how to make journal entries in either of these cases. Okay. For this, let's use an example. Okay, on the 7th of January, Joe sells 50 bottles for $10 each. Okay, on the 10th of January, the customer returns 8 bottles because they were damaged. On the 12th of January, the customer returns a further 12 bottles because he realized he had ordered in excess of his requirements. Okay, so these 12 bottles can be resold because they're not damaged, right? Okay. Joe had paid $7 per bottle initially with the intention of reselling them. So that's the cost he paid to procure each bottle. Okay. The customer pays his dues on the 15th of January. Okay. Let's look at the journal entry for each day. Okay. On the 7th of January, because Joe sells 50 bottles for $10 each, he makes a revenue of $500. Okay, so revenue is being credited by $500. Okay, because he sells on credit and the customer hasn't paid yet. Okay, he would debit his accounts receivable account by $500. Okay, the cost of procuring each bottle was $7, right? So 7 times 50 is $350. Okay, so Joe has to credit his inventory by $350. Okay, so he has to remove those 50 bottles from the inventory. Okay, and he has to transfer it to cost of goods sold. Okay, cost of goods sold is an expense and hence that would be debited. Okay, so you debit cost of goods sold by $350 and you credit your inventory account by $350. Okay, then on the 10th of January, okay, the customer returns 8 bottles because they were damaged. So for this, we're going to debit a contra revenue account. We did the same in the case of credit card discounts or sales discounts. Okay, in this case, we're going to call the account sales returns and allowances. Okay, and we're going to debit this contra revenue account, which brings down the total revenue by $80. Okay, we're also going to credit the accounts receivable account to show that this is no longer receivable, right? Okay, you cannot expect the customer to pay this $80 later on. Okay, so we're going to credit the accounts receivable account by $80 on the 10th of January. Then on the 12th of January, okay, the customer returns another 12 bottles. Okay, but this is because he had ordered in excess. Okay, so these 12 bottles can be resold. Okay, so on the 12th of January, okay, you're going to do the same as before. Okay, you're going to debit your sales returns and allowances account, okay, for $120, and you're going to credit your accounts receivable account by $120. Okay, but in addition to that, you're also going to put back these 12 bottles in your inventory. Okay, so you're going to debit your inventory account by $84. Okay, 12 times 7 is 84. Okay, and you're going to credit your cost of goods sold account by that $84. Okay, so you're removing it from your cost of goods sold and putting it back in your inventory. In the previous case where the bottles were damaged, we did not remove it from the cost of goods sold account. Okay, so the damaged bottles will still continue to be part of cost of goods sold, but would not earn any revenue in return. Okay, that's the cost Joe has to live with because his bottles were damaged. Okay, then finally on the 15th of January, when the customer pays the dues, okay, cash is being debited by $300 and accounts receivable is being credited by $300. Okay, initially the customer owed $500. Okay, but because later 8 bottles and 12 bottles, so a total of 20 bottles were returned. Okay, so now the customer has to pay you just for 30 bottles. Okay, so cash is debited for $300 and accounts receivable is credited by $300. Last but not the least, we look at how to account for bad debt. Okay, whenever you sell to a customer on credit, you always assume a risk that the customer may not pay you. So let's say in the first time period, you sell a certain amount of goods on credit. Okay, so what would you do as part of your journal entry? You would credit your sales revenue and you would debit your accounts receivable. But if you know that the accounts receivable you've stated as per your journal entry is not really feasible, okay, then you might want to reduce that accounts receivable to show what is practically achievable, so that you're conservative and you don't overstate your assets. Okay, you don't want to overstate your accounts receivable. And you can't simply wait for your customers to not pay and then write it off as bad debt. What you have to do is to be proactive and specify what you think is going to be your accounts receivable. You're expected to make an estimation of what amount of this accounts receivable is not collectible and already deduct that from your accounts receivable in the same time period. By doing this, you're in line with the matching principle because now your bad debt is matched with the revenue that has been earned in the same time period. And you're not waiting for the bad debt to be written off in a different time period. Now that you've already estimated bad debt in the current time period and made the appropriate journal entries, in the future, whenever your customers do not pay, you can write them off as bad debt as and when they happen. We'll look at this in a lot more detail by using an example and showing how to do the journal entries. Okay. On the 27th of December, Joe sells a bottle each for $10 to 20 different customers on credit. From past experiences, he believes that it is uncertain that he'll be able to collect the money from 5 of those customers. Okay. On the 10th of January, the following year, he realizes that he certainly won't be able to collect the money from 3 of those customers. On the 21st of January, one of the customers who Joe had earlier assumed that would never pay, pays for his bottle. Let's consider each of these days in isolation and look at how to perform the journal entries. First, on the 27th of December, Joe sells a bottle each for $10 to 20 customers. So Joe earns a revenue of $200. So you would credit your revenue account by $200, okay? And you would debit your accounts receivable of $200 because cash hasn't been paid yet. So let's look at how that looks on the financial statements, okay? On the 27th of December, okay, if you look at the balance sheet, it would show an accounts receivable of $200 under assets, okay? And on the income statement, Joe would show a sales revenue of $200 for the 20 bottles, okay? He would also show the corresponding cost of goods sold for the 20 bottles. But I haven't shown that here because we've already seen how to do that, right? You would debit your cost of goods sold and you would credit your inventory. Okay, from past experiences, he believes that it's uncertain he'll be able to collect the money from 5 of those customers. Okay, so Joe believes that he won't be able to collect $50 out of the whole $200. Okay, if on the 31st of December, if Joe is preparing his financial statements at the end of the year, by showing his accounts receivable as $200, he would be overstating his assets. And by stating that his sales revenue is $200, he would also be overstating his revenue. Hence, on the 31st of December, Joe would have to make an adjusting entry before preparing his financial statements to show that realistically he expects to collect only $150. On the 31st of December, Joe would record the following journal entry. First, he would credit a contra asset account called allowance for doubtful accounts. Okay, he believes that it is uncertain that he'll be able to collect $50. So for that, he creates an allowance account, okay, which shows that the accounts receivable has to be deducted by 50. So what is the purpose of creating this contra asset account instead of directly deducting it from the accounts receivable account? He cannot deduct $50 from the accounts receivable account yet, okay, because this is just an approximation, right? He estimates that $50 may be uncollectible. Okay, so we're going to use the temporary account, okay, which is a contra asset account, okay. Allowance for doubtful accounts, which is a contra asset account, okay. If you credit that by $50, this $50 is deducted from the $200 and the balance of $150 is shown as a net realizable accounts receivable, and this balance is shown under assets in the balance sheet. Okay, so crediting the allowance account takes care of assets, okay. Assets are not overstated anymore. On the other hand, revenues and profits are still overstated, right? Hence, we debit a bad debt expense account, which is an expense which brings down stockholders' equity, okay? By debiting that account by $50, okay, we don't overstate the profits in the income statement, okay? So now if we look at the balance sheet and the income statement, okay, under balance sheet, the allowance for doubtful accounts, as we said, is a contra asset account. It sits under accounts receivable and deducts the net realizable accounts receivable. Okay, now the accounts receivable is only $150 as shown in the balance sheet. And under the income statement, okay, now you have an expense called the bad debt expense for $50, which brings down the net income. So this $50 is just an estimation. Okay, Joe estimated that 5 of the customers may not be able to pay. Okay, but on the 10th of January, the following year, he realizes that he'll never be able to recover the money from 3 of the customers. Okay, so 3 of the customers, for whatever reason, he realizes may not be able to pay him. So whatever was an estimation in the previous step is becoming a reality now. So now the reality is that 3 of the customers will definitely not be able to pay him, and he realizes that on the 10th of January. Okay, so how do we write off something that is definitely uncollectible? In the previous step, when we had an estimation, okay, we created this allowance account to take care of that estimation. Okay, now we know for sure that 3 of the customers may not be able to pay us. Okay, 3 customers, which is $30. Okay, so now we remove that $30 from the estimated allowance account and we directly remove it from the accounts receivable. Okay, so you would debit the allowance account for $30, okay, and you would credit the accounts receivable account by $30. Okay, I would like you to pay attention to the accounts that are affected here. Okay, accounts receivable goes down, allowance goes down. Okay, both are under assets. One is an asset, one is a contra asset. Okay, so the net realizable accounts receivable is unchanged. So the overall effect on assets in the balance sheet is unchanged. And writing off an uncollectible does not affect the income statement either. So if we look at the financial statements under balance sheet, okay, $30 is removed from accounts receivable and $30 is removed from the allowance account. And the net accounts receivable is still the same, $150. And no changes happen in the income statement. So whenever you write off uncollectibles, okay, finally it has no impact on the total assets on the balance sheet or no impact on the income statement either. On the 21st of January, one of the customers who Joe had earlier assumed that would never pay, pays for his bottle. Okay, now we'll look at how to make a journal entry to reverse a write-off. Okay, this customer had already been written off in the previous step. Okay, now we're going to look at how to make the journal entries to reverse this write-off. The first step in reversing this write-off to actually reverse the journal entry you made in the previous step. In the previous step, you debited your allowance account and you credited your accounts receivable account. Okay, you're going to reverse that. So you're going to debit your accounts receivable by $10 and you're going to credit your allowance account by $10. Okay, because it's just one customer, right? Hence you do it for just $10. Okay, once that step is completed, you've shown that this $10 is back in the accounts receivable account. It is back to being shown as money being owed to you. Okay, in the next step, because this customer pays, cash is debited and accounts receivable is credited. This journal entry step is similar to what you would do anytime a customer pays you, right? Now let's look at the financial statements. Okay, in the first step, you would have increased your accounts receivable by 10, so 170 would have become 180, and the allowance from 20 would have become 30, right? Okay, you see in the previous step it was 170 and 20. Okay, that would have become 180 and 30. Okay, but in the second step, the customer pays you cash, so your cash increases by 10, and that 10 is deducted from your receivables. Okay, so you can see that overall your assets would be 10 plus the 140, it would still be 150. On the income statement, no changes at all, right? Okay, anytime you write off or reverse a write-off, okay, there is no change in the income statement. Okay, so in this example, okay, Joe estimated that 5 of his customers out of the 20 customers will not be able to pay him. How did he come up with that estimate? We're going to look at two methods on how to estimate bad debt. Okay, the first method is called percentage of sales method. Okay, that's quite straightforward. Whatever credit sales you make, a percent of that you estimate to be uncollectible all the time. So how do you estimate this percentage? You look at your past experiences, right? You look at any kind of trends that can give you a clue in estimating this percentage. Okay, the second method is known as the aging of accounts receivable method. In this method, you classify all your accounts receivable based on how much time has passed since the invoices were due. Based on this categorization and an estimation of what percentage of receivable is deemed uncollectible in each of those categories, okay, you look at the overall aging schedule and you estimate the total bad debt. Let's first look at the percentage of sales method using an example. Joe had credit sales of $2,000 during the current year. From past experiences, he realizes that bad debts are usually 3% of the total credit sales. Prepare the adjusting journal entry for the end of the year. Okay, so $2,000 of credit sales, usually 3% is uncollectible. Okay, 3% of $2,000 is $60. Okay, so Joe would make a journal entry where he credits an allowance of doubtful accounts for $60. Okay, that's a contra asset. Okay, and he would debit the bad debt expense for $60. Okay, we've seen how to make this journal entry already. Okay, in this example, we're just learning how to use the percentage of sales method to estimate this bad debt. Now let's look at an example for the aging of accounts receivable method. Okay, Joe uses the aging approach to estimate his bad debt expense. Okay, the balance of each account receivable is aged on the basis of 4 time periods and is shown in the table below. Experience has shown for each age group, the average uncollectible rate on the amounts receivable at year end is as shown in the table below. Okay, on the 31st of December, end of current year, the allowance for doubtful accounts balance is $300. It's a credit balance. Okay, before the adjusting entry is made. Prepare the adjusting entry for the end of the year. Okay, let's look at what's shown in the table. Okay, so there are 4 time periods based on which the balance of each accounts receivable is classified. So 60,000 of accounts receivable is not yet due. Okay, what does that mean? The customer still has time to pay that money. Okay, and for $40,000, the customers are past due. Okay, but they are within 30 days beyond which they had to pay. And this $25,000 is past due by 30 to 90 days. Okay, and another $10,000 of receivable is past due by more than 90 days. Okay, which means more than 90 days have passed since the customer owed us that money. Okay, on the table, okay, Joe also shows the average uncollectible rate on the amounts of receivable, okay, as per the age group. So for money typically that is not yet due, Joe estimates that 2% of that is uncollectible. But for money that is past due but still less than 30 days, okay, Joe estimates 5% is uncollectible. For money that is 30 to 90 days past due, he estimates 10% is uncollectible on average, okay. And for receivables that are past due by greater than 90 days, okay, he estimates 30% is uncollectible. You can already see that this follows a pattern, right? The more time has passed since it's due, the less likely you'll be able to collect it. Hence, the estimated percentage of uncollectible keeps increasing the more time has passed since it's due. Okay, first let's calculate how much do you estimate to be uncollectible in each of those categories. Okay, for receivables that are not yet due, okay, the total receivables is $60,000, out of which Joe thinks 2% is uncollectible. Okay, so 2% of 60,000, he estimates he'll not be able to collect $1,200. Okay, in the next category for 40,000, he estimates 5% is uncollectible. Okay, so that's $2,000. 5% of 40,000 is $2,000. In the next category, 10% of 25,000 is $2,500. Okay, and 30% of $10,000 is $3,000. So in total, he estimates $8,700 to be uncollectible. So normally he would make a journal entry to show this $8,700. So he would debit his bad debt expense account by $8,700 and he would credit his allowance for doubtful accounts account by $8,700. But in this case, we've been provided some additional information. On the 31st of December, the allowance for doubtful accounts balance is $300. Okay, so the allowance account has a $300 credit balance before the adjusting entry is made. So when would you have a credit balance for your allowance for doubtful accounts account? If you had overestimated your bad debt in your previous period, okay, then you would be left with a credit balance. Okay, so your allowance account still has a balance of $300, which is an estimate. Okay, your new estimate should be $8,700. Okay, so your allowance account should reflect this new balance. Okay, because you already have a $300 balance in your allowance account. Okay, by crediting just $8,400, okay, you would reach that balance of $8,700. So the account already has $300 in there. By crediting another $8,400, the total credit balance becomes $8,700. On the other hand, what if you had underestimated your allowance in the previous time period? Okay, in that case, you would have had a debit balance to start with. So if you start with a debit balance, okay, the journal entry you make should clear that debit balance, and on top of that should make sure that you end with a credit balance of $8,700. Okay, so let's say if you had a debit balance of $200, okay, then you need to clear that $200 and then you still have to finish with a credit balance of $8,700. Okay, so your journal entry would have been made for $8,900, which takes care of the $200 plus the $8,700 which is required. Estimations are not always perfect, right? Companies look at trends and they learn from their past estimations. Okay, they can always make corrections in the forthcoming years, right? Okay, so regardless of whether the allowance account was left with a credit or a debit balance, now we know what journal entry has to be made in order to finish with a desirable balance. This concludes our session on accounting for revenues and receivables. Okay, in the next session, we'll be looking at accounting for cost of goods sold and inventory. Thank you for watching. Cheers. Hello there. In this session, we're going to look at how to account for cost of goods sold and inventory. We're going to start by looking at the nature of inventory and cost of goods sold from the perspective of financial statements. Okay. Then we're going to look at the various inventory costing methods such as specific identification, FIFO, LIFO, weighted average. And then we're going to look at the effect on different financial statements when we choose these various inventory costing methods. Finally, we're going to look at how to update your inventory valuation at the end of each time period based on lower of cost or market, or it's also known as the LCM method. First, let's get started with understanding the nature of inventory and cost of goods sold. Inventory is considered a current asset because you typically expect to sell your inventory within a period of 12 months. Okay. It is also typically valued at the cost of acquisition or the cost of purchase, right? But we'll see at the end of this session where we learn about the LCM method that at the end of each time period, we'll have to check for this valuation of inventory to see that if it can still hold. We've already seen how to do journal entries for when goods are sold. Okay, depending on whether cash has been collected or not, you would debit your accounts receivable or cash account, okay, and you would credit your revenue account. In addition to that, you would also credit your inventory account because the goods leave the inventory and they are being sold to the customer, right? So you would credit your inventory account and you would debit your cost of goods sold account, which is an expense. If you typically consider a production company, okay, they would hold inventory in the form of either raw materials or work in progress or even finished goods, right? On the other hand, if you consider a merchandising company which just buys and sells products, okay, they would hold these merchandise goods as part of their inventory. All these goods stay in the inventory until they are being sold to the customer. Now let's look at the math behind calculating your inventory or cost of goods sold for each time period. Okay, for a particular time period, let's say you begin with a certain amount of inventory and that's classified as beginning inventory. During that time period, if you're a production company, you might produce a certain amount of goods, or if you're a merchandising company, you might purchase a certain amount of goods. Okay, together with the beginning inventory, what you have is the goods available for sale. And out of the goods available for sale, whatever is sold during that period is classified as cost of goods sold under the income statement, and whatever is not sold during that period still remains as part of your inventory and can be called as your ending inventory. So at the end of this particular time period, this is shown as inventory under assets in your balance sheet. If you'd like to formulate this relationship mathematically, okay, you can say beginning inventory plus either purchases or production, okay, minus your cost of goods sold. Okay, once you deduct that, whatever is left is your ending inventory. Let's look at the different inventory costing methods that are commonly used. Okay, the first method is known as specific identification method. The second one is the first in, first out method, or it's commonly known as FIFO. The third one, which is the last in, first out method, is also known as LIFO. And finally, the average costing method or the weighted average costing method is also known as AVCO. Let's look at the specific identification method first. In this method, you're able to identify specifically which unit of your inventory has been sold. For example, let's say you are in the business of buying and selling real estate. Let's say you acquired 3 units to be sold later, one for $50,000, the second one for $70,000, and the third one for $30,000. Let's say you sold the second unit, okay, which is valued at $70,000, okay. Then you would credit your inventory by $70,000 and you would debit your cost of goods sold by $70,000. You don't have to do any complex math in this case because you are able to identify specifically which house has been sold and that value is deducted from your inventory. Let's look at a visual comparison between FIFO, which is first in, first out, and LIFO, which is last in, first out. FIFO works similar to a queue. Okay, whoever entered the queue first is the first one who is being served. So from a production perspective, the unit that was produced first will be the unit that is being sold first. Okay. Even if the units are not produced and sold in that particular order, okay, for the purpose of inventory valuation, we are going to assume that it's always first in, first out. Okay, so under FIFO valuation, we are going to assume that the products that were produced first were always the ones that were sold first. Moving on to LIFO valuation, okay, LIFO mirrors something like a stack. A stack can be used to visually represent LIFO valuation. Okay, it's something like a stack of plates. Okay. Let's say a company produces a certain number of products and stacks them. Okay, the last one that was in would be the first one that is being out and being sold. Okay, so in LIFO valuation, we are always going to consider that the last product that was produced will be the first one that is being sold. Let's better understand FIFO and LIFO and also the average costing method using an exercise. Okay, Joe had a beginning inventory as of the 1st of January of 50 bottles valued at $10 each. Okay. During the year, he made the following purchases. On the 20th of January, 20 bottles at $11 each were purchased. Okay. On the 15th of March, 45 bottles at $12 each were purchased. Okay. And on the 2nd of July, 60 bottles at $12.5 were purchased. And finally, on the 14th of November, 30 bottles at $13 each were purchased. You can see that with time, the cost of each bottle has been going up, right? Okay. Finally, he sold 125 bottles over the course of the year. Okay. Calculate the cost of goods sold and the valuation of ending inventory using the FIFO, LIFO and the average costing methods. Let's tabulate this information first. So the beginning inventory, he had 50 bottles at the beginning of the year, okay, and each one was valued at $10 each, okay. And then he made a series of purchases during the year. Overall, he had 205 bottles that were available for sale during the course of the year. Let's look at how to calculate the ending inventory and cost of goods sold using the FIFO method, okay. In the FIFO method, we are going to assume first in, first out, okay. So whatever units were available first are going to be considered as the first ones that are being sold, okay. What was available first was the beginning inventory of 50 units which was available at the beginning of the year. So how many bottles did he sell during the year? Was 125 bottles. So these 50 bottles will be considered to be the first bottles to be sold in the FIFO valuation process, okay. So these 50 bottles will be sold. So that's 50 out of 125 bottles taken care of. We still have to account for 75 bottles that were sold, okay. So then we move on to the first set of purchases, which was done on the 20th of January, okay. That set had 20 bottles, okay. Because we still have to account for 75 bottles, okay, we're going to sell all 20 of these bottles, okay. So units sold from this category is all 20 bottles. So out of the 75 bottles, we've accounted for 20 bottles now. We still have to account for 55 more bottles, okay. So then we move on to the next set of purchases, okay, which was done on the 15th of March. Okay, that set had 45 bottles. Okay, so again, we're going to account for all 45 bottles and consider them as sold. Okay, so out of the remaining 55, we've accounted for 45 bottles now. Okay, so then we move on to the next set of purchases. This set had 60 bottles. Because we still have to account for only 10 bottles, okay, we are only going to consider a part of this set of purchases as being sold, okay. We're going to consider 10 units out of the 60 as being sold, okay. So to calculate the cost of goods sold, okay, 50 times 10, which is $500, okay, 20 times 11, which is $220, 45 times 12, which is $540, and 10 units, okay, out of the 60 units, okay, 10 times 12.5, which was $125. Together, when you add them up, this gives you the cost of goods sold under first in, first out method. I've also highlighted here how to visualize this FIFO. Okay, you start from the top and you go on until you sell your first 125 bottles. Okay, so everything that is left unsold remains as part of your inventory. Okay, so that becomes your ending inventory or simply inventory at the end of the period. Okay, so the remaining 50 bottles out of this set of 60 and all 30 bottles which were purchased on the 14th of November will remain as part of your inventory. Okay, so the ending inventory can be calculated by 50 times 12.5 plus 30 times 13. Another way to calculate your ending inventory is to simply subtract your cost of goods sold from your goods available for sale. Okay, that has been shown here. Okay, $2,400 is your goods available for sale minus your cost of goods sold should give your ending inventory valuation. Okay, under LIFO methodology, we do the same, but we start from the last purchase. So let's look at the calculations using LIFO methodology. Okay, because 125 units were sold, we start from the last set of purchases now, okay, which was done on the 14th of November. Okay, so that's 30 bottles. Okay, 30 times 13 is $390. Okay, so that's 30 out of 125 accounted for. Okay, then we move to the next batch, which is 60 bottles. Okay, so 60 times 12.5 is $750. So now totally we've accounted for 90 bottles out of 125 bottles. Okay, we still have to account for 35 more bottles. So then we move on to the next earlier purchase made, which was on the 15th of March, okay, which was a set of 45 bottles. Okay, we're going to consider only 35 out of those bottles to be sold, okay, because that would give us a total of 125 bottles. Okay, so 35 times 12 gives you $420. Okay, together the cost of goods sold for those 125 units is $1,560. The ending inventory under LIFO is the remaining 10 bottles from this batch plus this 20 bottles and the 50 bottles from the beginning inventory. Okay, so that can be calculated as 10 times 12 plus 20 times 11 plus 50 times 10, or simply you can subtract the cost of goods sold from your goods available for sale. Okay, so your ending inventory valuation would be $840. Next, under the average costing method, first we calculate the unit cost of all the goods that were available for sale during that particular period. So the beginning inventory, which was valued at $10 per unit, and all the purchases which were made during the year for varying costs, okay, you find the average, or to be rather more precise, okay, you find the weighted average for all these costs, okay. So how do you do that? 50 times 10, that's 500, 20 times 11, so that batch of purchases is valued at $220, okay. So you repeat that for all the batches that were being purchased during the year along with the beginning inventory, okay. So totally the goods available for sale is $2,400, and how many units did you have available for sale during that period is 205 units or 205 bottles. So when you divide 2,400 by 205, you get $11.71. That's the average unit cost for all the bottles that were available for sale during that year. Okay. Now we use this $11.71 to value your cost of goods sold and also your ending inventory. Okay. So to calculate the cost of goods sold, you take $11.71 and you multiply it by the number of units that were sold during the year. That is 125. Then to calculate the ending inventory, you can follow the same process as before. Okay, you subtract the cost of goods sold from your goods available for sale, or you can also do 11.71 multiplied by the remaining goods that were not sold and are still part of the inventory. That is 205 minus 125, that's 80 units. Okay, 80 times 11.71 should give you the same answer. Okay, in this example, we considered a scenario where costs were rising with time. Okay, so the beginning inventory was valued at $10 per unit, and with time, you can see that the costs are rising. Okay, how does this impact the various financial statements? Okay, here I've just tabulated the results of the previous exercise. Okay, under FIFO, this is the cost of goods sold, and this is the value of your ending inventory, and under LIFO, and also using the average costing method. So when costs are increasing, we can see that the cost of goods sold under FIFO is lower than the cost of goods sold under LIFO. And for the ending inventory valuation, it's vice versa, right? Okay, the valuation of the inventory under FIFO is higher than the valuation under LIFO. You can also see that when you use the weighted average method, okay, the valuation of your cost of goods sold and inventory is in between what you would obtain when you use the FIFO or LIFO method. Okay, 1463 is in between 1365 and 1560, and 936 is in between 840 and 1035. So when costs are increasing, we can see that the cost of goods sold is higher under the LIFO methodology, because under LIFO we are selling the most recently purchased product first. So when costs are increasing, they would also be the units with the highest cost. Okay, hence the cost of goods sold is higher under LIFO than under FIFO. So if cost of goods sold, which is an expense, is higher under LIFO, it means under LIFO you would end up with a lower pre-tax income in comparison to FIFO. Okay, so if your pre-tax income is lower, it means you pay a lower income tax under LIFO, and you would also end up with a lower net income. Okay, because your pre-tax income was lower, which means you would also end up with your lower net income under LIFO methodology. And looking at the valuation of the ending inventory, we can see that under FIFO, it's greater than under LIFO. Because under FIFO, you're still left with the most recently purchased units in your inventory, which are also the units with the highest costs. So the ending inventory valuation under FIFO would be higher than as compared to the ending inventory you would get using the LIFO methodology. On the other hand, when costs are decreasing, which is very rarely the case, okay, you can reach your conclusions by flipping this table around. Okay, you can see in the other table when costs are decreasing, that cost of goods sold is higher under FIFO methodology. Okay, but income taxes, net income, and the ending inventory valuation are all higher under the LIFO methodology. Finally, we're going to look at scenarios like drop in inventory value or damaged goods or stolen goods. Okay, and we're going to look at how to recalculate the value of the inventory. Okay, based on the valuation of lower or cost of market method, okay, or it's also known as the LCM method. Typically, you measure your inventory at the cost of purchase, right? But at the end of the period, okay, if you realize that the inventory that you hold could be replaced at a lower cost, okay, then that new replacement cost should be considered as the value of your inventory. Doing this agrees with the conservatism principle where you don't overvalue your assets when they can be replaced at a lower cost today. Further, if your goods were damaged or stolen, you need to update your inventory value with the net realizable value of the actual goods. The journal entry you would use to update the inventory value in these scenarios, is you would credit your inventory account by the value that was lost, and you would debit your cost of goods sold account and you would consider them as an expense in your income statement. Let's understand this LCM method using an example, Joe is preparing his annual financial statements. Ending inventory information about his major products are shown as below in the table. Compute his ending inventory valuation using the LCM rule, So Joe has 3 products, product A, B, and C, and you have the quantity on hand for each of those products, and you also provided with the unit cost when acquired, and you also have the replacement cost or the market cost at the end of the year. So for product A, you can see that the replacement cost or the current market value is lower than the cost of acquisition, So you need to update your inventory using the $8 instead of the $10, For product B, the replacement cost is actually higher, so you don't have to do any changes, For product C again, the replacement cost is lower than the cost of acquisition, so you will have to make the necessary adjustments. Let's see how to calculate this new updated inventory valuation, So for product A, the 30 units on hand, originally the valuation would have been 30 times 10, 300, but the new valuation should be 30 times 8, which is 240, So the valuation of the inventory has to be lowered by $60, So going back to the journal entry, you would debit your cost of goods sold by $60 for product A, and you would credit your inventory by $60, And then for product B, you don't have to do any changes, because the replacement cost is higher than the acquisition cost. Hence, the value of the inventory for product B would remain at 40 times 12, which is $480, For product C, again, the replacement cost is lower than the cost of acquisition. So you have to change the ending inventory valuation from 25 times 20, which is 500, to 20 times 21, which is 420. So the new valuation is lower by $80. So the journal entry would have been debiting cost of goods sold by $80 and crediting inventory by $80 for product C. So for products A and C, the inventory valuation should be updated, but for product B, you don't have to make any changes. This concludes the session on accounting for cost of goods sold and inventory, In the next session, we're going to look at how to account for long-term assets, Particularly, we're going to look at plant, property, and equipment, and we're going to learn about depreciation, And we're also going to look at how to account for intangible assets. Thank you for watching. Cheers. Hello there. In this session, we are going to look at how to account for long-term assets, particularly plant, property, and equipment, also known as PPE, and also later we're going to look at intangible assets. We're going to start by looking at the different types of long-term assets, and then we're going to look at what happens during the acquisition and maintenance of plant, property, and equipment. We're also going to look at the journal entries during this acquisition or maintenance process, And then we are going to learn about the different depreciation methods that are used for plant, property, and equipment. The 3 methods we'll be focusing on are straight line method, units of production method, and the third method, which is an accelerated depreciation method known as the declining balance method. Further, we'll be looking at how to deal with impairment and disposal of plant, property, and equipment. Finally, we'll be looking at how to account for natural resources and intangible assets. We'll start by classifying long-term assets into tangible assets and intangible assets. Tangible assets are assets which have any kind of form or physical substance, such as land, equipment, or natural resources, right? Anything you can touch and feel is tangible. On the other hand, intangible assets are assets which do not have any physical substance, such as goodwill or patents or franchises, etc. First, we'll start with what happens when a firm acquires an asset. When a firm acquires a PPE or plant, property, and equipment, from here on, we're going to just refer to it as PPE. The acquisition cost of the asset is calculated as the sum of the purchase price and all other expenses until the asset is ready to use. Expenses such as shipping, installation costs, or taxes, all these can be considered expenses until the asset is ready to use. Okay. When you purchase an asset, what is the journal entry you would do? Okay. Assuming that you're paying with cash to buy this asset, okay, you would debit your PPE account, okay, which increases your asset, okay, and you would credit your cash account, which decreases your assets, so it stays balanced. So this is the journal entry you would make when the asset is being purchased. Later in this session, we'll look at depreciation to see what kind of journal entries you would make in the following time periods, okay. Once the asset has been acquired, you can still spend on maintenance in the following time periods. What you spend on maintenance can be something major that improves the lifetime of that asset, or something that is minor like repair work that is just necessary to keep functioning. These major expenses are typically capitalized while the minor expenses are expensed. Okay, let's look into detail at what this means. Okay, what type of expenses are capitalized? Expenses that provide benefit beyond the current life period. Okay, may improve efficiency and extend its useful life. Okay, and it also occurs infrequently. If you do any kind of upgrade work, okay, it occurs infrequently and it involves large amounts of money. When you make such major investments, okay, these expenses are typically reported on the balance sheet as an asset, okay, and then they are depreciated in future time periods. It's almost like you just bought a new asset. Upgrading an asset to improve its lifespan is treated like you almost bought a new asset. On the other side, what kind of maintenance work is expensed? Okay, any minor work like repairs and normal maintenance is expensed. These expenses do not improve the productivity or efficiency or extend the lifetime beyond the original estimated usage of that asset. Okay, they are also recurring in nature. Usually, small amounts of expenses are typically expensed right away. Okay, these expenses are reported on the income statement in the current period. So you don't capitalize them as an asset, but rather you expense them straight away in the income statement. Later in this session, we'll be looking into depreciation in detail, which is basically capitalizing an asset and then expensing it in the future periods. So understanding depreciation will help you go a long way in distinguishing what capitalizing and what expensing is. So how do you make the journal entries in either of these cases? When you capitalize any kind of maintenance work, you treat it like an asset. Okay, if you're paying cash, you would credit cash, okay, but you would debit your PPE account. So this kind of emphasizes that this investment is made on that asset to improve the quality of the asset and the lifetime of the asset. Then what does the journal entry look like when you typically expense any kind of repair work? Okay, if you're paying with cash, then you would credit cash again, but you would debit your expense account, okay, which brings down your stockholders' equity. So instead of capitalizing it and expensing in the future time periods, you're already going to expense it in the current time period. Now, as a firm starts using its long-term assets, these assets start depreciating in value. Okay, so for example, tangible assets like machines depreciate in value the more you use them. Except land, all other tangible assets are expected to lose their value the more and more you use them, right? Regarding intangible assets of limited life, such as patents, okay, these patents are worth less and less with passage of time, right? Okay, so these intangible assets have to be amortized. The same goes with natural resources. These resources get depleted with time. The more you mine a mineral from its field, okay, you are depleting that field of that mineral, right? Hence, the field loses its value over time. From an accounting perspective, these three terms can be used interchangeably. In a typical financial statement, you're more likely to encounter the term depreciation because depreciation can be solely used to represent all these terms put together. Now let's try to visualize what depreciation is from an accounting perspective. Okay, let's assume that a certain asset has been purchased right now, okay, for a price of $4,000, and this asset has a lifetime of 4 years. When you see the cash flow statement, you can see there is a cash outflow of $4,000 right now and no further cash flows in the remaining time periods. Okay, so what we've done here is we've capitalized this asset, which is worth $4,000 at the time of purchase. But because this asset has a lifetime of 4 years and it helps to generate revenue over these 4 years, it makes sense to somehow expense this purchase of the asset over the period of 4 years. So if this $4,000 was shown as an expense for that particular time period, even though it is being used for 4 time periods, okay, then in that particular time period, you would be overstating your expenses and hence you would be understating your profits. It would somehow make sense if you were able to split this $4,000 over the period of 4 years, maybe even equally, right? Okay. So in a way, through depreciation, what we do is we capitalize this asset worth $4,000 and then we depreciate this asset by $1,000 every year. And this $1,000 is removed from the assets and it's transferred to the income statement as an expense. So if we look at the journal entry for every year where we are depreciating the asset by $1,000, okay, we would have to debit an expense account. Okay, and we're going to call this a depreciation expense. Okay, this expense account is being debited by that $1,000. And we would also have to reduce the value of this asset. Okay, the asset which was valued at $4,000 when it was purchased. Okay, we would have to reduce the value of this asset by $1,000 every year. So instead of crediting this $1,000 directly from the PPE account, what we're going to do is we're going to create a contra asset account. Okay, we're going to call this accumulated depreciation. In this account, as the name suggests, okay, we're going to use this to accumulate the depreciation for our PPE. So what exactly is a contra asset? A contra asset is something that sits under assets, okay, but it decreases the value of assets. In this case, accumulated depreciation is a contra asset which sits along with PPE, okay, but it's used to reduce the value of our PPE. So if the asset had been originally bought for $4,000, so with an accumulated depreciation of $1,000 at the end of the first year, together the net value of our PPE is $4,000 minus $1,000, which is $3,000. Okay, so the book value of our asset at the end of the first year is $3,000. Okay, and then at the end of the second year, it would be $2,000. Okay, and so on. And finally, at the end of 4 years, okay, the net value of the asset would be 0. So you would be repeating this at the end of each year for a period of 4 years. What we've seen so far is an example of a method called straight line depreciation, okay, where we have a constant depreciation every year. Other methods of depreciation that can be used are units of production method. In this method, you would depreciate an asset based on how much it has been used. Another method of depreciation that's available and that can be used is the declining balance method. Okay, this method is an accelerated depreciation method, and we can use this whenever we would like to depreciate an asset much quicker in the earlier years of its lifetime. In reality though, most firms typically just use the straight line method because it's really simple to be followed. We'll look at the math behind each of these methods and then we'll look into them into a bit more detail using an example. How do we calculate the depreciation expense every year using the straight line method? Okay, you subtract the residual value of the asset, okay, from the cost at which it was purchased. And then you divide this by the usage life in years. Okay, in our previous example, okay, the cost was $4,000. The residual value was 0 at the end of 4 years. Okay, so 4,000 minus 0, okay, divided by 4 years of useful life. So 4,000 by 4 is $1,000 per year. Okay, so that's the depreciation expense per year using the straight line method. In the units of production method, the asset is depreciated based on how much it has been used. So in this method, first you calculate the depreciation rate. Okay, that helps you estimate how much the asset has depreciated for every unit that has been produced. So if you're a company that manufactures pens, okay, the depreciation rate would give you the depreciation of the machine that produces the pens for every pen that has been produced. Or if the asset is a car, then the depreciation rate would be the depreciation of the value of the car for every kilometer or mile that it has been driven. So once you've estimated the depreciation rate, you can use it to calculate the depreciation expense every year. Depending on how many units were produced each year, the depreciation expense is going to vary from year to year. In the third and final method, known as the declining balance method, okay, depreciation expense for each time period is calculated by multiplying the net book value of the asset at the beginning of that particular time period, okay, with a factor called N, and then dividing it by usage life in years. N is a factor that is used in this declining balance method. Okay, it represents the declining balance rate. So for example, if we'd like to use the double declining balance method, then N would take a value of 2 to denote that we would like to accelerate our depreciation with a factor of 2. Or in other words, we would like to depreciate our asset twice as fast. Also, how do you calculate the net book value of the asset at the beginning of each time period? You take the cost of the asset, okay, which refers to the price at which it was purchased. Okay, from the cost, you subtract all the depreciation that has been accumulated so far. Just looking at these expressions may seem a bit vague, okay, but we're using an example. We'll try to calculate the depreciation expense using these three methods, and then it gets a lot clearer. Okay, so let's jump into an example. Okay, at the beginning of the year, Joe purchased tech equipment for $5,000. Okay, the equipment has an estimated useful life of 4 years and an estimated residual value of $200. Okay, so at the end of 4 years, it has a residual value to be estimated at $200. The estimated useful life can also be classified in terms of number of hours of usage as 1,000 hours. Joe ended up using the equipment for 300 hours in year 1, 250 hours in year 2, 400 hours in the third year, okay, and 150 hours in year 4. Calculate the depreciation expense each year using the straight line, units of production, and double declining balance methods. Okay, let's look at the straight line method first. Okay, the first step would be to calculate the depreciation expense every year. Okay, so the cost of the tech equipment which was purchased is $5,000. Okay, minus the residual value at the end of 4 years. Okay, the residual or salvage value at the end of 4 years is $200. Okay, so 5,000 minus 200 is $4,800. $4,800 represent the value that has been lost by purchasing and using this equipment over a period of 4 years. Okay, so when you divide that by 4 years, you get a depreciation expense of $1,200. Okay, so $1,200 represents the depreciation every year for a period of 4 years using the straight line method. We can create a table like the one shown below here to understand depreciation a lot better. So when the equipment was purchased, okay, it had a value of $5,000. Okay, so at the beginning, it was worth $5,000. In year 1, the depreciation expense was $1,200. Okay, so the total accumulated depreciation is also $1,200. Now the book value at the end of year 1 is $3,800, which is 5,000 minus $1,200, which is $3,800. In year 2, the tech equipment undergoes further depreciation expense of $1,200. Okay, now the accumulated depreciation is $2,400 because $1,200 for year 1 and a further $1,200 for year 2. Now the book value of the equipment at the end of year 2 is 5,000 minus 2,400. So the equipment is worth only $2,600 as per our books at the end of year 2. Hence the phrase net book value, right? Okay, because the value of $2,600 is as per our books. So at this moment, at the end of year 2, if you looked at Joe's financial statements, okay, it would show that he has equipment, okay, which is worth $2,600 at this point in time. We can continue further. Year 3 also has a depreciation expense of $1,200 because we are still with the straight line method. Okay, so the accumulated depreciation is year 1, 2, and 3 put together, which is $3,600. Okay, now the net book value is $2,600 minus $1,200, which is $1,400. In the final year or year 4, okay, there is a further depreciation expense of $1,200, okay, which takes the overall accumulated depreciation to $4,800. Okay, this leaves us with a book value of $200 at the end of year 4. It's by design that we've reached the residual or salvage value of this particular equipment, right? We had initially used this $200 in the calculation of depreciation expense, which resulted in $1,200 per year. So it's not really a coincidence that we ended up with $200 as the book value at the end of 4 years. Next, we move on to the units of production method. Okay, in this method, first we have to calculate the depreciation expense per unit that is produced, or in our case, the depreciation expense is calculated per hour of estimated usage of this particular equipment. Okay, again, the cost of the equipment is $5,000. The residual or salvage value is $200. Okay, the estimated usage life is 1,000 hours. So if you subtract 200 from 5,000, that's $4,800. Okay, divided by 1,000 hours, that gives us a depreciation of $4.8 per hour of usage. So this is the rate of depreciation per hour. Okay. Now if we create a table like in the previous case, okay, we'll have to use the actual hours of usage that were provided to you in the question, right? Okay. The actual hours of usage were 300 hours in year 1 and 250 hours in year 2, for example. Okay. This is going to be used in the table now. Okay. So in the first year, the equipment was used for 300 hours. Okay. Every hour of usage depreciates the equipment by $4.8. So 4.8 multiplied by 300 hours gives us $1,440. Okay, so that's the depreciation in year 1. Okay, that leaves us with a net book value of $3,560 at the end of year 1. In year 2, the equipment was used for 250 hours. Okay, so the depreciation for 250 hours multiplied by 4.8 is $1,200. Okay, so the total accumulated depreciation so far for year 1 and 2 together is $2,640, which leaves us with a net book value of $2,360 at the end of year 2. Okay, now at year 3, the equipment was used for 400 hours. So 400 times 4.8, okay, so the depreciation for that particular year is 1,920. Okay, so the accumulated depreciation so far is 4560, which leaves us with a net book value at the end of year 3 for $440. If we continue for year 4, okay, the equipment was used for 150 hours. 150 multiplied by 4.8 is 720. Okay, if we use the depreciation expense of 720 here, okay, the net book value at the beginning of year 4 was $440. Okay, so a depreciation expense of $720 wouldn't make sense. In fact, we would have to end up with a net book value at the end of year 4 for exactly $200 because that was the estimated residual or salvage value at the beginning. So the correct amount of depreciation expense that would end up leading to a residual value of $200 is $240. Okay, so if we use the depreciation of $240 for year 4, okay, that brings the overall accumulated depreciation to $4,800 and a residual value of $200. Hence, wherever it's necessary, whenever you're using these different depreciation methods, you might have to make some adjustments to match the residual value that had been estimated. Moving on to the double declining balance method. In this method, we'll start by calculating the depreciation expense for year 1. Okay, so the net book value at the beginning of year 1 is the cost at which it was purchased. Okay, so $5,000 multiplied by n, okay, because this is the double declining balance method, n is equal to 2, divided by the total useful life in years. Okay, so 5,000 times 2 divided by 4. Okay, so the depreciation for year 1 is $2,500. So this results in a net book value at the end of year 1 as 5,000 minus 2,500, okay, which is $2,500 again. Now, how do we calculate the depreciation expense for year 2? Okay, we take the net book value at the end of year 1 or at the beginning of year 2. So this $2,500 will also be the book value at the beginning of year 2. Okay, we take that and again we multiply it by the factor of 2 divided by 4. Okay, this gives us $1,250. So this is the depreciation for year 2. Okay, so the accumulated depreciation for 2 years is year 1 plus year 2, that is $3,750. Okay, so the net book value now at the end of year 2 is only $1,250. We repeat this process again to calculate the depreciation for year 3. Okay, so $1,250 multiplied by 2 divided by 4, that's $625. Okay, so that's the depreciation for year 3. So that leads us to an accumulated depreciation of 4,375, okay, which leaves a net book value of only $625 at the end of year 3. Finally, for year 4, to calculate the depreciation expense, okay, 625 multiplied by 2 divided by 4. So that's $312.5. If we use $312.5 as our depreciation expense, we wouldn't end up with a residual value of 200 at the end of year 4. Okay, so like in the previous case with the units of production method, okay, we'll again make an adjustment. Okay, how do you calculate this adjustment? You find out the depreciation expense that will lead to a residual value of 200 at the end of 4 years. Okay, in this case, a depreciation of 425 in year 4 would lead to a total accumulated depreciation of 4,800, and hence it would lead to a residual value of $200 at the end of year 4. So in this double declining balance depreciation method, you can see that the depreciation expense is going down with time. Hence, this is a type of accelerated depreciation, okay, because we are depreciating a lot of the asset's value in the first few years of its life. Now let's look at a side-by-side comparison between the straight line method and the declining balance depreciation method. I plotted the depreciation expense for each year using the two methods. Okay? In the straight line method, you can see that it's $1,200 every year, whereas in the double declining balance method, the depreciation expense has been steadily going down with time. Now let's consider the financial statement implications of choosing either method. If you were to choose the double declining balance method here, okay, you would show a higher expense earlier on in the life of the asset. A higher expense leads to lower pre-tax profits, okay, which results in lower taxes to be paid in that earlier period. But that also means you would report lower profits. But if you're a manager whose incentives are tied to firm performance, lower profits aren't exactly the ideal situation for you. On the other hand, if you are the owners of the firm, you would ideally prefer to pay lower taxes earlier on and accumulate more and more taxes to be paid later. So it can really be advantageous to choose the straight line depreciation method, okay, for financial reporting purposes, and choose the double declining balance method for tax reporting purposes. Within the scope of the US GAAP or IFRS principles, okay, there is some room to choose either method for different purposes. So you can ideally end up reaping the benefits of both these methods. Okay, now let's look at some specific cases that might arise once you've started depreciating an asset. One situation that might arise that there might be a change in the depreciation estimates you made at the beginning. It could either be a change in the lifetime of the asset or it could be a change in the residual value of the asset. Okay, let's look at an example on how to address these changes. Let's stick to the previous example we've been following. Okay, Joe has been using straight line depreciation for his reporting purposes. At the end of year 2, he estimates the total lifetime of the equipment is 6 years. And now the new residual value is $600. Recalculate the new depreciation expense. Originally, the equipment was supposed to be useful for only 4 years. Okay, but now the new useful life is 6 years. Also, the residual value, which used to be $200, is now $600. Because 2 years have already passed, okay, so at the end of 2 years, the net book value of the asset is $2,600 as per your books, okay, because using the straight line method, which we saw earlier, okay, the depreciation expense is $1,200 per year, okay. So we've depreciated for 2 years, okay, the accumulated depreciation is $2,400 and the net book value is $2,600, okay. We still have 4 more years to go and the new residual value is $600, okay. So from 2,600, we have to reach a residual value of $600 through a period of 4 years, okay. So the new depreciation expense every year is 2,600 minus 600, which is $2,000 divided by 4 years, which gives us $500 every year. Okay, so the new depreciation expense per year is $500. Okay, so for year 3, depreciation is $500. The accumulated depreciation we carry on as before. Okay, so 2,400 plus 500 is 2,900. Okay, and the new net book value is $2,100, which is 2,600 minus 500. Okay, we carry on the same process using $500 for the remaining 4 years. Okay, that would result in a final net book value at the end of year 6 for $600. So what other complex situations might arise as Joe is using his equipment over time? Sometimes he might want to sell the asset before its useful life has expired. Let's look at that with an example. Joe has been using straight line depreciation for his reporting purposes. He decides to sell his equipment at the end of year 2. He finds a buyer who pays him $3,000 in cash. Prepare journal entries to record the sale. Okay, so this is at the end of year 2 when he decides to sell his equipment for $3,000. The equipment was originally bought for $5,000. Okay, so he has depreciated for 2 years for $1,200 each, and the net book value at the end of year 2 is $2,600. Okay, whereas the sale price, okay, is $3,000. So on this particular sale, Joe makes a gain of $400. Let's look at how to make the journal entry for this sale. It's easier to understand the journal entry for the sale if we are able to readily refer to the journal entries that had been made until that point in time. Okay, so for example, when the equipment was bought, the journal entry that was made at that point in time was a debit to the PPE account for $5,000. Okay, and considering Joe paid cash, okay, a credit to the cash account for $5,000. Every year, Joe records a depreciation of $1,200. Okay, so he would debit a depreciation expense account for $1,200 and he would credit accumulated depreciation for $1,200. And he would repeat that also for the end of year 2. Now it is at this point that he decides to sell his equipment for $3,000. Anytime you sell an asset, the first thing you have to remember is to get rid of the PPE and accumulated depreciation accounts for that particular asset. Okay, so I'm going to reverse all my accumulated depreciation up until this point, and I'm also going to reverse the journal entry that I made in the PPE account when I purchased this asset. So when I bought the asset, I had debited my PPE account for $5,000. When I sell this asset, I'm going to credit my PPE account for $5,000. Okay, so the first step is to credit PPE by $5,000 during the sale of this asset. Okay, accumulated depreciation. So far, I had credited this account by $2,400. Now, I'm going to debit this accumulated depreciation account by $2,400 to reverse all the depreciation that has been accumulated so far. So I would debit my accumulated depreciation account by $2,400. By looking at these two entries together, we can see that an asset which had a net book value of $2,600 has been sold. It originally had a value of $5,000 and its value had dropped by $2,400 to reach a net book value of $2,600. At this point, it has been sold. Okay, that's the idea we get by looking at these two lines of the journal entry. Okay, but we also received cash of $3,000 on the sale, so I would debit my cash account by $3,000. We can see that now the sum of the debits does not balance with the credit value here. So the sum of debits is $5,400 and we've only credited $5,000. So the remaining $400 that has to be credited is credited on an account called gain on sale. Because the book value of the asset was only $2,600, but Joe received cash of $3,000 while selling this asset, he actually made a gain as per his books. So this gain is recorded as a credit in order to balance the overall journal entry. If Joe had realized a loss on sale of this asset, okay, he would have to record this loss on the debit side of the transaction. Let's look at another specific case where a particular asset might be impaired or might even be lost under certain circumstances. For example, Joe has been using straight line depreciation for his reporting purposes. He accidentally loses his equipment at the end of year 2. Prepare journal entries to record this loss. So the book value at the end of year 2 is the same as in the previous case, which is $2,600. When he loses his equipment, okay, he'll have to record a loss of $2,600 in his books. The easiest way to visualize this journal entry is by assuming that you're actually selling this equipment for a net value of $0. Okay, so as in the previous case, you will have to reverse your PPE journal entry. Okay, so you would credit your PPE account by $5,000 and you will also reverse your accumulated depreciation. Okay, so you would debit your accumulated depreciation for a net total of $2,400. Okay, and the remaining $2,600, okay, you would record it as a loss. Okay, because it's a loss, you would have to show it on the debit side in order to balance the transaction. So technically, a loss is considered an expense, whereas a gain is considered a revenue. And together, they have a net effect on the stockholders' equity. Okay, that sums up depreciation. But what about natural resources? Okay, the depletion of natural resources is very similar to the depreciation of tangible assets. You would debit a depletion expense account, okay, and you would credit an accumulated depletion account. Okay, instead of depreciation, we just call it depletion. If you think about it, depletion is very similar to the units of production depreciation method, right? The more natural resources you extract from a particular asset, okay, the more you're depleting it. And hence, it's similar to the units of production depreciation method. All other complications remain very similar to the depreciation examples we've seen so far. So we can move on to intangible assets now. Intangible assets can be broadly categorized into two: assets of definite life and assets of indefinite life. The ones which have a definite life are amortized over its useful life. Okay, amortization is similar to depreciation. So for intangible assets, we use the term amortization. Okay, and we would amortize intangible assets of definite life over its useful life. But intangible assets which have an indefinite life, they are not amortized. But every year, they'll have to be assessed for impairment. What do I mean by assessed for impairment? You will have to check if the assets hold the same value as per what was recorded in the books earlier. If the asset had lost its value in some aspects, okay, you will have to reduce the value of this asset in your books. Some examples of intangible assets with a definite life are patents, copyrights, certain computer software with estimated useful life, for example. Some examples of intangible assets with indefinite life are goodwill, trademarks, brand name, franchises, for example. From an accounting perspective, how can you differentiate whether you develop an intangible asset within your company or whether you chose to purchase this intangible asset from outside the company? If you're developing an intangible asset within the company, it means you're spending a lot on research and development. R&D expenses result in a lot more failures than successes. Okay, so from an accounting perspective, any type of research and development expenses are typically expensed in that period. They are not capitalized to be expensed in a future period unless a clear revenue generating asset has been developed. In this case, you can choose to capitalize it. On the other hand, if you purchase an intangible asset from outside the company, you're going to record this as an asset in your books and capitalize it. Now let's look into detail as to what goodwill refers to. Okay, we're going to understand this using an example. Okay, let's say company A pays $2 million in cash to acquire all of company B's assets, okay, which were appraised at a fair value of $700,000 and liabilities of company B were $200,000. Calculate the goodwill and prepare journal entries to show this acquisition. Okay, so company B's assets were appraised at $700,000 and their liabilities at $200,000. So the net valuation of company B is 700,000 minus 200,000, which is $500,000. Okay, but for this, company A pays $2 million in cash. So why would a company pay $2 million to buy another company which is valued at only $500,000? This $500,000 valuation is only considering the tangible assets of company B. Okay, company A pays a premium, this $1.5 million in excess, to acquire company B. Okay, this excess $1.5 million that is paid to acquire company B is paid for its intangible assets. This could be for the brand name or other trademarks which company B possesses. Okay, and this excess $1.5 million is known as goodwill. So how do you do the journal entry for goodwill? Okay, when you buy company B's assets, okay, the assets were valued at $700,000. They now become your assets. Okay, so you would debit your assets, whatever they might be, inventory or accounts receivable or cash, whatever they are, you would debit all the assets by $700,000 and you would also credit your liabilities by $200,000. Because you're paying cash of $2 million to buy company B, you would credit your cash account by $2 million. Okay. Finally, you would debit your goodwill account, which is an asset, for $1.5 million in order to balance the transaction. This brings us to the end of this session on accounting for long-term assets. In the next session, we are going to look at how to account for liabilities. And in the session after that, we are going to look at how to account for bonds in particular. Thank you for watching. See you in the next one. Cheers. Hello there. In this session, we are diving into the world of accounting for liabilities. Liabilities are a crucial aspect of financial reporting, representing obligations a company owes to external parties. Throughout this session, we'll explore the various types of liabilities, their accounting treatment, and their impact on financial statements. Let's preview the key areas we'll be covering today in our exploration of accounting for liabilities. We'll begin by discussing salary expenses, focusing on accrued wages and how they become a liability until they are paid. Next, we'll address how the portion of long-term debt due within a year shifts into a current liability and the accounting implications of doing that. We'll also learn how to calculate interest expenses here. Next, we'll examine contingent liabilities, those that are potential obligations dependent on future events, and how accounting standards dictate their treatment. Finally, we'll also touch on lease liabilities, distinguishing between operating leases and capital leases, and also we'll discuss their accounting treatment. Here, we'll introduce the concept of present value and discuss its vital role in determining the true value of liabilities over time. Before we delve into the specific types of liabilities, let's clarify a fundamental distinction within how companies acquire capital: debt financing versus equity financing. With debt financing, you retain full ownership of your business. You're essentially borrowing money that must be repaid. Equity financing means you sell a portion of your business ownership. Investors become shareholders. Debt has strict repayment schedules with principal amounts and interest. This creates a predictable financial obligation. There's no repayment obligation in the traditional sense for equity, but investors hope for business growth and profits, leading to increased share value or dividends. Debt lenders usually have limited say in how you run your business outside of certain loan terms, whereas equity investors gain voting rights based on their ownership stake, potentially influencing business decisions. Interest represents the cost of debt, a fixed expense. If you can't pay, there is the risk of default and potential seizure of assets. The cost of equity is tied to company performance. The greater the profit or share value increase, the higher the cost to the original business owner. Interest payment on debt is usually tax deductible, while dividends paid to shareholders are not tax deductible. Understanding these differences helps businesses choose the right financing. Debt is often used by established businesses with stable cash flow, while equity might be favored by high-growth startups. At their core, liabilities represent obligations a company has to outside parties. These obligations can be financial, such as debts or unpaid bills, or involve promises to deliver goods or services in the future. A critical factor in accounting for liabilities is the time frame in which these obligations must be met. This leads us to the distinction between current and non-current liabilities. Current liabilities are those due within the company's operating cycle, typically within a year. Think of them as short-term financial obligations. Examples include accounts payable, such as money owed to suppliers, accrued expenses like unpaid utility bills, for example, and the short-term portion of any long-term debt. We've already discussed accrued expenses in detail in the third session, if you remember that. Non-current liabilities, on the other hand, are due beyond the typical operating cycle, usually extending over a year. They are our long-term obligations. These may include long-term loans, bonds payable, pension liabilities, and deferred income taxes, for example. Next, let's discuss salary expenses. These are a significant component of liabilities for most businesses. When we think of salaries, we often focus on the net salary, or it's also known as the take-home pay an employee receives. However, from an accounting perspective, there's much more to the story. Let's examine the graphic on the slide. It breaks down the different components contributing to the actual salary expense a company incurs. Gross salary is the total agreed upon amount before any deductions. It includes the employee's net salary and their mandated contributions such as income tax or social security. Note that these employee contributions, which are part of the gross salary, are withheld by the employer and paid directly to the relevant authorities. But companies often bear their own payroll costs on top of gross salary. This employer contribution includes things like matching social security payments, pension contributions, or healthcare benefits, for example. Similar to employee contributions, the employer portion is temporarily held and then paid out to the respective agencies or benefit providers. The key takeaway is that a company's true liability is the salary expense, is the sum of the gross salary plus the employer contributions. But once the net salary has been paid to the employee, whatever is owed to the relevant authorities is the amount that is recorded as liabilities on their financial statements. So the employer contribution and the employee contribution together would be still recorded as a liability in the financial statement. Let's break down some of the most typical components we find within employee contributions and employer contributions related to salaries. Employee deductions and contributions include, for example, income tax. Almost everywhere, income tax is withheld directly from an employee's paycheck as a prepayment of their annual tax obligation. Next, medical or health insurance. If the company provides health insurance, employees usually share part of the premium cost through payroll deductions. Next is pension fund. In pension plans where employees contribute, a portion of their salary is regularly set aside for retirement. And finally, social security. Social security systems vary by country, but this deduction typically funds government programs like retirement benefits or disability insurance. Moving on to employer contributions, first we look at pension fund. Many employers offer matching contributions to pension plans, incentivizing saving and providing additional retirement benefits. And finally, unemployment insurance. Employers typically pay into unemployment insurance funds, which provide support to workers who lose their jobs. Remember that specific types and amounts of contributions will depend on location, government regulations, and company benefit packages. This list isn't exhaustive by any means, and there may be other types of deductions or contributions in certain specific circumstances. Now let's see how the concepts we've discussed translate into actual accounting journal entries through a real-world example. Joe earns a gross salary of $10,000 for the month of January to be paid on the 31st of January. Joe and his employer each contribute an amount equal to 6% of Joe's gross salary to Social Security. Joe contributes $200 from his gross salary to his pension program, and the employer contributes an additional $400. Joe's employer also withholds $2,000 for income taxes. Show the journal entries made by Joe's employer on the 31st of January. Joe and his employer each contribute 6% of Joe's gross salary to Social Security. 6% of $10,000 is $600. So Joe contributes $600 and Joe's employer also contributes $600. Further, Joe contributes $200 from his gross salary to his pension program, and the employer contributes an additional $400. The employer also withholds $2,000 for income taxes. This $2,000 is being withheld from Joe's gross salary. So Joe's net salary or his take-home pay is calculated by deducting his contributions and taxes. So Joe's net salary after deductions is $10,000 minus $600 minus $200 minus $2,000. That's $7,200. Critically, the employer's salary expense extends beyond Joe's gross salary. We must factor in all employer contributions as well. The total salary expense for the employer is the $10,000, which is the gross salary of Joe, plus $600, which is the contribution from the employer for Social Security, plus $400, which is the contribution from the employer for pension plan. Okay, so the total salary expense is $11,000. Now let's record these transactions in the journal entries for the employer. First, we debit the salary expense account for $11,000. That's an expense that brings down your stockholders' equity. Then we credit cash account for Joe's net salary of $7,200 to reflect cash that has been paid to Joe. Next, we credit income tax payable account for the withheld income taxes of $2,000. So this will be a liability that will be paid later. Then we credit Social Security payable account for the Social Security contributions of $1,200. This is $600 from Joe and another $600 from the employer. Finally, we credit the pension plan payable account for the pension contributions of $600. Okay, so that's $200 from Joe and $400 from the employer. All these payables are liabilities for the employer as they have to be paid to the concerned authorities or agencies. Only the net salary had been paid already and hence cash has been credited, but the rest are liabilities that are yet to be paid. Moving on, typically companies raise capital through various debt instruments. Let's examine three common types of these debt instruments, namely loans, notes, and bonds. Loans represent the most familiar type of borrowing, a direct agreement with the lender, usually a bank. They are suitable for short-term needs and they often have maturities under 5 years. Further, loans are frequently secured by a collateral to reduce the risk for the lender. Moving on to notes, think of a note as a more formal IOU, outlining the terms of borrowing, and they are less complex than bonds. Notes are suitable for short to intermediate term needs, usually under 10 years. They typically have fixed interest rates and can either be secured or unsecured. Finally, bonds differ from the other two instruments in that a company borrows directly from many investors in the public market. They are designed for long-term financing. Maturities generally exceed 10 years. Bonds involve detailed legal contracts outlining terms, interest, and any security offered. Bonds are issued by larger companies or government entities. We'll discuss bonds in a lot more detail in the next session, where we have the entire session dedicated to just accounting for bonds. We've discussed the differences between loans, notes, and bonds, especially considering whether they're short-term or long-term. Well, how we classify long-term debt on financial statements depends on its repayment schedule. Let's look at the concept of the current portion of long-term debt. The current portion of long-term debt is the principal amount of a loan scheduled for repayment within the next 12 months or the company's operating cycle. Separating the current portion of long-term debt highlights a company's immediate financial obligations, which is critical for assessing its liquidity and solvency. Let's explore this concept with an example. Joe signs a note to borrow $5 million on the 1st of January for a period of 5 years. The note will be repaid as an annuity of $1 million every year. Show the classification of current and long-term liabilities at the end of the year. Okay, now at the end of the first year, Joe makes the first annuity payment of $1 million. And the next $1 million which is due becomes a current liability because now this is due within the next 12 months. Okay, the remaining $3 million on the note remains classified as long-term debt as it's not yet due. With each passing year, another $1 million will shift from the long-term to current liabilities until the entire loan is repaid. Whenever a company takes on debt, there's a cost associated with it beyond just the repayment of the principal. This cost is known as interest expense. Calculating interest expense is relatively straightforward. Let's break down the formula. Principal, shown here, is the amount of the outstanding loan balance on which interest is calculated. Time represents the period for which interest is being calculated, usually expressed in fractions of a year. So for example, 6 months would be 0.5. Rate, the interest rate is stated as an annual percentage, which is then converted into a decimal for calculation purposes. So for example, 12% would be 0.12 when it's being used for calculation. Accurately calculating interest expense ensures that a company's financial statements reflect the true cost of its liabilities. This impacts profitability and also decision making. Let's apply the interest expense formula we just learned to a real-world example. Below is an excerpt from Joe's balance sheet on the 31st of December. The reimbursement of the current portion of the long-term note takes place on the 30th of June. If the interest rate of the note is 4%, how much is the interest expense for the year? The key is to recognize that interest accrues over time. The current portion is due in 6 months or half a year, while the long-term portion has a full year here. So the outstanding current portion is only $80,000. So 80,000 multiplied by half because it's being accrued for just half a year. Okay, multiplying that with the interest rate, which is 4%. That would give you the interest expense for this 80,000. But what about the 250,000 that is a long-term note payable? So 250,000 for the whole year multiplied by 4%, that gives you 10,000. So 80,000 times half times 4% is 1,600 plus the 10,000 gives you 11,600 is the interest expense for the whole year. Now, let's follow a borrowing scenario step by step, examining how transactions are recorded through journal entries. Joe borrows $100,000 for 1 year on the 1st of July. The note carries a 4% interest rate. Joe closes his accounts on the 31st of December every year. The principal and interest will be paid upon maturity the following year. Record the necessary journal entries. So let's see. On the 1st of July, Joe receives 100,000 cash, an increase in assets, creating a 100,000 note payable representing the new liability. Hence, we debit the cash account for 100,000 and we credit the note payable account for 100,000. Even though payment isn't due yet, accrual accounting requires us to recognize interest expense as it builds up. So 100,000 times 4% for half a year. So from July 1st to the 31st of December is 6 months, right? So 100,000 multiplied by 4%, which is the interest rate, multiplied by half gives you $2,000 of interest for the half year. Hence, at the end of the year, on December 31, before we close our books for the year, we debit the interest expense account for $2,000 and we credit interest payable by $2,000. This shows that the expense has been incurred but hasn't been paid yet. On the 30th of June in the following year, the note along with the appropriate interest has to be repaid. Hence, a further 6 months has passed by now. Another 6 months of interest, which is $2,000, is recorded as an expense. So you see an interest expense of $2,000 has been debited. We debit interest payable by $2,000 in order to eliminate the liability that had previously been recorded on the 31st of December. And we also debit note payable for the original loan amount, that is $100,000, in order to reflect that the note has been repaid and it is not a liability anymore. Finally, we credit cash representing the $104,000 repayment, which includes the $100,000 note and the $4,000 interest payment for the whole period of 12 months. Okay, not all liabilities are certain. Contingent liabilities or potential obligations depending on future events that may or may not happen. Think of pending lawsuits, product warranties, or environmental cleanup obligations where the outcome is unknown. Accounting principles such as US GAAP and IFRS provide specific guidelines on how companies should handle contingent liabilities. Decision making relies on two things. First, the probability of an economic loss, and second, whether that loss can be reasonably estimated. If a loss is both probable and can be estimated, it's recorded on the balance sheet as an actual liability. If a potential loss exists, even if less likely or if it cannot be easily estimated, it must be disclosed in the notes to the financial statements. Only true remote contingencies may not require specific mention at all. The bottom line is that how a company handles contingent liabilities reveals its potential financial risks, making this a crucial area for stakeholders to really understand. Moving on, lease agreements. Lease agreements provide a way to acquire assets without an upfront purchase. However, the accounting treatment of leases can be very complex. Let's focus on capital leases under US GAAP. The key concept is that capital leases are in essence treated like a financed purchase. This triggers specific accounting requirements. US GAAP defines 4 specific criteria that must be analyzed to determine if a lease qualifies as a capital lease. We look at each one of them by turn. Ownership transfer. If the lease effectively hands over ownership by the end, it's treated as a purchase. Next, bargain purchase option. If the buyout option is far below the market value, it suggests an intent to purchase. Next, looking at the lease term, a lease spanning most of the asset's usable life signals that it's closer to owning the asset. And finally, present value of lease payments. If the discounted value of lease payments closely aligns with the asset's worth, it's economically similar to a purchase. We'll look at the concept of present value later in this session. If a lease meets any one of these four criteria, it's classified as a capital lease. This means both an asset and a liability are recorded on the company's balance sheet. The decision of whether a lease is operating or capital has a profound impact on a company's financial statements. Hence, before we examine the journal entries, let's clarify the fundamental difference that dictates whether a lease is classified as operating or capital. Think of operating leases like an extended rental agreement. The company does not obtain substantial ownership rights over the asset. As such, operating leases don't appear on the balance sheet as assets or liabilities, impacting only the income statement through lease expenses. Hence, you would debit your corresponding expense account and you would credit your cash account for paying for that expense. Capital leases, in contrast, function like a financed purchase. We saw that in the previous slide. Okay? The company gains most of the benefits and risks of ownership. This is why capital leases require recording both an asset and a liability on the balance sheet. Now, a key issue is, how do we determine the value to put on that leased asset? That's our next important step. Determining the value will involve a concept called present value, which we'll explore now in depth. Present value is a fundamental concept in finance that allows us to assess the value of future cash flows in today's terms. The idea behind present value is based on the principle that money available today is worth more than the same amount of money in the future. Why is that? This can be for a variety of reasons. First, for example, inflation. Over time, prices generally rise, so the same amount buys less in the future. Or it can be due to opportunity cost. If you have the money today, you can invest it to earn a return. Waiting for a future payment means you miss out on all those potential earnings. Or finally, it could also be due to risk. There's a degree of risk in waiting for future cash flows. Things might change and the payment might be delayed or reduced. In the context of the example on the slide, where there is a future cash flow of $100 in year 4, calculating the present value involves discounting this future cash flow back to its equivalent value in today's dollars. This is necessary because receiving $100 in year 4 is not as valuable as having $100 today. Present value is essentially working the investment process backwards. What amount would I need to invest today at a certain interest rate to receive $100 in year 4? The formula shown here allows us to precisely calculate this amount, taking into account both the discount rate and the time period. The discount rate represents the rate of return that could be earned on an alternative investment of similar risk. It reflects the time value of money and accounts for factors such as inflation and opportunity cost of capital. By discounting future cash flows back to their present value, we can make better informed decisions about investment opportunities, financing choices, and project valuations. In the context of capital leases, which we've just seen in the previous slides, we'll use present value to determine what the stream of lease payments is equivalent to in today's dollars. Let's further examine the concept of present value with a real-world example. On the 1st of January, Joe bought a new equipment and signed a note agreeing to pay $30,000 in 2 years, that is, on the 31st of December in year 2. This amount equals the cash equivalent price today plus interest for 2 years. The market interest rate for this note is 12%. Show the appropriate journal entries for this liability. That $30,000 isn't the true cost today. This amount represents the cash equivalent price today plus interest for 2 years. To accurately record this on his financial statements, we need to calculate the present value. Using our present value formula, we discount the $30,000 by an interest rate of 12% over 2 years. This results in a present value of $23,915.82. This means if Joe invested $23,915.82 today at 12% interest, he'd have exactly $30,000 in 2 years to pay off the note. Using this present value, let's calculate the interest expense for the 2 years because we'll be using this in our journal entries. So interest expense for year 1 is the present value, which is 23,915.82 multiplied by 12%. So that would give you the interest expense for the first year. But when we have to calculate the interest expense for year 2, we have to add the interest expense from year 1 to our present value before we take 12% of the total. Why do we do that? Because that's how compounding works, right? Okay. And hence, interest expense for year 2 is higher than the interest expense for year 1. Okay, let's look at how to do the journal entries now. On January 1, in the first year, okay, we debit the plant property equipment account for 23,915.82, the present value. And then we credit the note payable account for the same amount, reflecting the obligation. And on the 31st of December for year 1, because interest accrues over time, we debit interest expense for 2,869.90, okay, as we calculated in the previous slide. And we also increase the note payable liability by the same amount, okay. So now at the end of year 1, the total note payable liability would be the sum of 23,915 and the 2,869. And finally, as of the 31st December on year 2, because another year has passed, okay, we've accrued another year of interest. In this case, the interest expense is 3,214, which we've also calculated here in the previous slide. But Joe pays $30,000. Hence, we debit the note payable account by $26,785.72, okay, which is the sum of these two numbers, in order to eliminate it or reverse these journal entries. And we also credit cash because we paid cash for $30,000. Previously, we looked at finding the present value of a single future payment. But what if we have a series of equal payments over time? That's an annuity, right? Understanding the present value of an annuity is crucial for evaluating things like lease agreements, loan payments, or retirement income streams. Let's explore how to calculate the present value of such an annuity. Our graphic here depicts an annuity of $100 received at the end of each year for 3 years. We can't simply add $100 3 times. We must account for the time value of money using the present value concepts we've just learned. We could calculate the present value of each payment separately using the formula we just learned and add them all together. However, that's very time consuming. Imagine the annuity is for a longer time period. Thankfully, there is a formula that simplifies this process. This formula calculates the combined present value of all the payments in an annuity. Even that can be considered a bit cumbersome because you'll have to remember a formula, right? Okay, so we'll take it a step further. Spreadsheets like Microsoft Excel or Google Sheets have a built-in present value function. The syntax of the function is shown here in this slide. The present value function takes the following arguments. The first argument is the interest rate or the discount rate. The next one is the number of time periods. And next, payment amount represents the constant payment in the annuity. And next, future value is an optional argument. Okay, this represents a lump sum transaction at the end. This can be a cash inflow or a cash outflow. But if there is no such transaction at the end, you can simply ignore this argument because this is optional. And finally, there's one more optional argument, end or beginning, which represents whether the annuity payment is made at the beginning or end of each time period. By default, if you don't provide this argument, payments are assumed to be made at the end of each time period. Remember that lease payments often form an annuity. So this is exactly the tool we need to determine the lease asset value and liability. The present value of an annuity concept extends far beyond leases, making it a very valuable financial tool. Let's explore an example of calculating the present value of an annuity and the corresponding journal entries. On the 1st of January, Joe bought a new equipment and signed a note agreeing to pay $10,000 in annual installments for 3 years. Each installment includes the principal plus interest of 12% on unpaid balance. Show the appropriate journal entries for this liability. Joe purchases equipment and agrees to annual installment payments. These payments include both principal repayment and interest. To record this equipment and liability accurately, we can't simply focus on the $10,000 annual payments. We need their present value. The PV function in the spreadsheets makes calculating the present value of this annuity quick and easy. But let's discuss how all the calculations are made without using the spreadsheet formula. Let's walk through this table. The annuity of $10,000 is the amount that is being paid at the end of each year. So in order to calculate the present value, we'll have to discount each of those annuity payments back to today. Okay, so for example, the first $10,000 which is paid at the end of year 1, in order to calculate the present value of that $10,000, we take the $10,000, we divide it by 1 plus 12%, which is the interest rate, to the power of 1, which signifies that we'll have to discount it back by one time period. We repeat for the $10,000 at the end of year 2. Now we'll divide $10,000 by 1 plus 12% to the power of 2. Now we'll have to discount it backwards for 2 time periods, hence the power of 2. Okay, and we do the same for the third annuity payment. Once we've calculated the present value of each of these $10,000, we can simply add them together to find the present value of the whole annuity. Okay, so that's $24,018.31. From past experience, we know that we also need to calculate the interest expense because we'll be using that in the journal entries. Okay, so how do we calculate that? Interest expense for year 1 is the present value, which is $24,018.31 times 12%. That's straightforward. But what happens at the end of year 1 is that we make a $10,000 payment. Okay, so this $10,000 covers a bit of the principal and also covers a bit of the interest expense which we've accrued so far. So the interest for year 1 is deducted from the $10,000 in order to calculate what portion of the principal has been repaid. And then in order to calculate the interest expense for year 2, we deduct the principal which has already been repaid from the present value. So now the outstanding debt is $24,018 minus $7,117. Okay, so we only paid 12% interest on this outstanding amount. Okay, and hence the new interest expense is a bit reduced. Okay, and we repeat the same process. We see that the principal that has been repaid at the end of year 2 is $10,000 minus the interest expense accrued for year 2. Okay, and for year 3 we repeat the same process. Okay, now the outstanding debt is even further reduced, right? So 24,018, which is the PV, minus 15,089, which is the sum of the principal that has been repaid in year 1 and 2. Okay, so the interest expense for year 3 is only 1,071. The principal that is being repaid at year 3 is $10,000 minus the interest expense. That gives you 8,928. Okay, if you add these three numbers, you can see that the total principal repaid amounts to exactly the present value. Notice how the present value of each payment decreases over time, reflecting the time value of money. Focus on how the portion of each payment representing the interest expense decreases while the principal repayment increases over the loan term. The calculated total present value, 24,018.31, is the amount we'll use for our initial journal entries. On the 1st of January for year 1, we debit PPE for 24,018.31 and credit note payable for the same amount, representing the present value of the liability. Okay, so 24,018 is the present value of the annuity of $10,000, which is at the end of year 1, year 2, and year 3. And for each of the subsequent year ends, we record interest expense based on the outstanding balance and reduce the note payable by the principal that has been repaid. Hence, we debit both interest expense and note payable accounts and credit cash by 10,000 to reflect the cash payment for each year. So for example, at the end of year 1, note payable has to be debited by 7,117, which reflects the fact that the outstanding debt is no longer 24,018, but that has to be reduced by the 7,117 we calculated in the previous slide. Okay, and the interest expense will be debited by 2,882, which we also shown here in the previous slide. Okay, and cash payment of $10,000 at the end of year 1, year 2, and year 3 is also recorded by crediting the cash account. And the same process is repeated for the end of year 2 and year 3. You'll simply have to look at the previous slide to obtain the numbers for the note payable and interest expense accounts that have to be debited. Okay, we're almost done. We've covered a great deal of ground in understanding liabilities, from their definitions and classifications to concepts like contingent liabilities, leases, and present value calculations. Remember, accurately accounting for liabilities is crucial for presenting a true picture of a company's financial health and decision making. The concepts we learned in this session, especially around present value and annuities, will be directly applicable to our exploration of bonds, which we will discuss in a lot more detail in the next session. Thank you for watching. See you in the next one. Hello there. Thank you for joining me for this session on accounting for bonds. In our previous session, we delved into the fundamental concepts of accounting for liabilities. Today, we'll build on that knowledge by specifically discussing a crucial type of liability called bonds. By the end of the session, you'll have a solid grasp of the unique characteristics of bonds, how the bond issuance process works, and the accounting treatment for bonds issued at varying prices. Let's outline the core topics we'll be covering in this bond accounting session. We'll start by defining bonds, exploring their characteristics, and understanding the different types available in the market. Then we'll learn how accounting treatments differ depending on whether a bond is issued at par, at a discount, or at a premium. Finally, we'll also address specific scenarios like zero coupon bonds and the early retirement of bond-related debt. My goal for this session is to simplify the complexities of bond accounting and give you the tools to confidently record and report bond transactions accurately. Let's begin by revisiting the key characteristics that distinguish bonds from other financial instruments like stocks. Companies raise long-term capital through both stocks and bonds. However, bonds offer certain advantages that make them appealing under specific circumstances. One such advantage is maintaining control. Bondholders, unlike stockholders, do not gain voting rights or ownership in the company. This allows existing owners to retain decision-making control. The next advantage is tax benefits. A significant benefit of bonds is that the interest paid to bondholders is tax deductible. This reduces the overall cost of borrowing, while dividends paid to stockholders are not tax deductible. Finally, companies can strategically use bonds to amplify their returns. If the expected return on investments exceeds the bond interest rate, borrowing funds can boost profitability for existing shareholders. It's also important to acknowledge the risks associated with bonds. Unlike equity, bonds create fixed obligations, so there's always bankruptcy risk. Interest payments must be made regardless of company performance. Failure to pay leads to bankruptcy. Then there's also cash flow pressure. Bonds require repayment of principal at maturity, putting pressure on the company's cash flow management. Bonds are a valuable financing tool when used strategically. The decision between bonds and equity depends on a company's specific goals, risk tolerance, and financial situation. Now let's break down the key vocabulary you'll encounter when working with bonds. These terms are essential for understanding the mechanics of these securities. First, principal or par value or face value or maturity value. These terms all refer to the same thing: the amount the bond issuer must repay to the bondholder when the bond reaches its maturity date. It's important to be familiar with these synonyms as they will be used interchangeably a lot. Next, stated interest rate or coupon rate. This predetermined rate, stated as a percentage, is used to calculate the periodic interest payments made to bondholders. This rate is set when the bond is issued. Remember, regardless of a bond's selling price, the periodic interest payment is always based on the principal or par value multiplied by the stated interest rate. The world of bonds isn't one size fits all. Bonds come in various forms, each with distinct features designed to cater to the diverse needs and risk appetites of the investors. Just as car buyers seek specific qualities, bond investors have their own preferences. Some prioritize security over high returns, while others may be willing to take on more risk for the potential of greater yield or conversion options. Companies strategically tailor bond characteristics to appeal to different investor segments. Let's look at some of the key bond types here. First, secured bonds. These bonds offer investors added security by pledging specific assets as collateral. A prime example is a mortgage bond where the collateral is the house itself. Next, unsecured bonds, or also known as debentures. These bonds don't offer asset-backed security. Investors primarily rely on the issuer's creditworthiness. Next, callable bonds. These give the issuer the flexibility to retire the bond before maturity, potentially to their advantage if interest rates decline. Then convertible bonds are a favorite with some investors because they offer the option to convert the bond into common stock of the issuing company, providing potential for capital gains. And finally, zero coupon bonds. These bonds are unique. They don't pay periodic interest. Instead, they are sold at a deep discount to their par value. The investor's return comes from the difference between the purchase price and the repayment at maturity. By understanding these bond types, you'll gain a better grasp of how companies creatively structure debt offerings to attract capital and how investors can select bonds that align with their investment goals. Let's examine the core components that come into play when a company decides to raise capital by issuing bonds. The bedrock of this process is the bond indenture. Think of this as the legal blueprint, the rule book governing the relationship between the company and its future bondholders. This contract specifies all the important details: the lifespan of the bond, the interest rate paid to investors, when those payments will happen, and if there are any special features like the ability to convert the bond to stock. Covenants within the indenture provide an extra layer of protection for investors. These are requirements that might somewhat limit the company's future actions, aiming to reduce the risk for bondholders. Naturally, there's always a bit of negotiation here. Companies desire flexibility while investors seek security. To attract these investors, companies create a prospectus. This is a thorough legal document designed as a sales pitch for the bond. It gives potential investors a clear view of the company's background, the specific bonds on offer, and how the money raised will be used. Upon purchase, a bondholder receives a bond certificate, their official proof of ownership. This document highlights all the key terms of the bond. Each certificate for a given bond issue is the same. Further, a trustee acts as a watchdog for the bondholders. This independent party's primary role is to make sure the issuing company lives up to all the promises made in the bond indenture. Finally, understanding risk is key for investors. This is where rating agencies like Moody's and Standard & Poor's come in. They analyze bonds and assign ratings that signal how likely it is that an issuer might not be able to fulfill their obligations. This concept of default risk is something investors pay close attention to. Let's dive into how bond transactions are reported. When a company issues bonds, the bond contract specifies two key types of future cash payments. The principal, which is a single payment made when the bond reaches maturity, and regular cash interest payments, which are computed using the contract interest rate. It's important to note that the company doesn't directly control the selling price of a bond. Instead, the market determines the price using present value concepts. To calculate this, we consider the present value of both the principal and the interest payments. Let's understand the two crucial interest rates that drive bond pricing. Think of this seesaw graphic. On one side, we have the coupon rate. This is the bond's fixed sticker price for interest, which is set when the bond is issued. It dictates the regular cash payments investors receive. On the other side of the seesaw is the market rate. This rate is dynamic, reflecting what investors currently demand based on the bond's risk and overall market conditions. The market rate is essential for determining the bond's actual selling price. Now picture this. If the seesaw is balanced, meaning the market rate equals the coupon rate, the bond sells at par value. If the market rate dips higher than the coupon rate, the bond's price drops, selling at a discount. Conversely, if the market rate dips below the coupon rate, the bond becomes more attractive, selling at a premium. You don't really have to memorize any of this. Here's how you can remember this comparison. If the coupon rate is less attractive than what the market expects, the only way to make the bond competitive is to offer a discount on its price. Conversely, if the bond offers a higher interest rate than the market standard, investors are willing to pay a premium to secure these better returns. Remember, regardless of whether a bond sells at par, premium, or discount, it's ultimately priced to provide the market rate of interest. In our upcoming slides, we'll delve into the specific accounting treatments for bonds issued under each of these scenarios. Okay, now let's first focus on bonds issued at par before tackling discount and premium scenarios. When a bond is issued at par, it means that the bond's selling price equals its face value, in this case $1,000. This occurs when the bond's coupon rate matches the prevailing market interest rate. Let's assume that the coupon rate and the market rate are both 10% in this case. Let's visualize the cash flows for our example bond. The company receives the $1,000 face value upfront from the investors when the bond is issued. The bond has a 10% coupon rate. Since payments are usually semi-annual, investors receive $50 in interest every 6 months for 2 years. This aligns with the market rate for similar bonds. At the bond's maturity, after 2 years, the company repays the $1,000 principal amount to its bondholders, completing the bond contract. Let's confirm that the bond's selling price at par is indeed the present value of its future cash flows. Recall that our bond has a $1,000 face value, a 10% coupon rate paid semi-annually, a market rate of 10%, and matures in 2 years. This table demonstrates the calculation. Remember, since interest is semi-annual, the market rate per period is only 5%, which is half of 10%. We calculate present value factors using this market rate. So for example, 1 over 1 plus 5% to the power of 1 is 0.95. And the rest of the present value factors are calculated by just changing the power to 2, 3, and 4 to denote the number of periods you'll have to wait to receive this cash payment. Each interest payment's present value is determined along with the present value of the principal repayment. So you simply multiply the cash flow with the present value factor in order to get the present values. Summing these values gives us $1,000, which verifies that the bond's price does in fact represent the present value of its future cash flows discounted at the market interest rate. Alternatively, we can also use a PV formula using a spreadsheet application like Microsoft Excel or Google Sheets and calculate the present value or price. Now let's translate these cash flows into journal entries. When the bond is issued at par, the company receives cash equivalent to bond's face value. We record a debit to cash for $1,000. The liability created is represented by a credit to bonds payable for $1,000, reflecting the company's obligation to repay this amount in the future. Each semi-annual interest payment involves recognizing the cost of borrowing. We debit interest expense for $50 and we credit cash for $50, showing the actual outflow of cash. At maturity, the company eliminates the bond liability by debiting bonds payable for $1,000. Simultaneously, the company credits cash for $1,000, representing the principal repayment to bondholders. Now let's explore bonds issued at a discount. This occurs when the market rate is higher than the bond's coupon rate. In our example, the bond has a 10% coupon, but the market rate is considered to be 12% semi-annual. But how do we obtain the price of the bond issued at a discount? Again, we calculate the present value of each cash flow using the market rate, which is 12% now. So 6% per 6-month period should be used as our discount rate. Notice that the sum of the present values is now only $965.35, which is less than the face value of $1,000. This is why the bond will be sold at a discount to reflect the lower cash flows relative to the market rate. Let's look at the journal entry specifically for when the bond is issued at a discount. We debit cash for $965.35, reflecting the actual proceeds received from selling the bond at a discount. On the other hand, we credit bonds payable for the full face of $1,000. This represents the company's ultimate obligation to bondholders. The difference between these two amounts is $34.65. This is debited to discount on bonds payable. This account reflects the discount we provide to investors in exchange for a lower coupon rate compared to the market rate. Let's focus on the discount on bonds payable account. This is a contra liability account, which means it reduces the total liability amount presented on the balance sheet. In essence, the bonds payable account reflects the face value of the bond, which is $1,000 in our example, while the discount on bonds payable account represents the difference between the face value and the issuance price, which is $34.65. Subtracting this discount gives us the actual cash proceeds received, which is $965.35. We've seen how a bond issued at a discount results in a lower amount of cash received compared to the bond's face value. But how do we account for this difference over the bond's life? This is where amortization comes in. Now let's explore why we need to use amortization methods like straight line or effective interest. The core principle is matching. The matching principle states that expenses should be recognized in the same period as the related revenue is earned. In this case, the discount represents an upfront cost of borrowing associated with the lower coupon rate. By amortizing this discount, we gradually spread this cost over the life of the bond, matching it with the interest income received by the bondholder. There's another important reason. Our balance sheet should accurately depict the company's liabilities. The discount initially reduces the bonds payable account, but through amortization, we gradually increase this account towards the face value, reflecting the true obligation as we approach maturity. We've established the importance of amortizing the discount on a bond issued at discount. Now, let's see how the straight line method works in practice using the example from the previous slides. This table shows the breakdown for each of the 4 semi-annual periods over the bond's life. The interest paid column represents the fixed cash coupon payment of $50 made every 6 months to the bondholders. The amortization column, this shows the portion of the discount recognized as expense in each period using the straight line method. We calculated the discount as $34.65, which is $1,000 face value minus $965.35, which is the issue price. With 4 payment periods, the amortization per period is $8.66, which is $34.65 divided by 4 periods. Next is interest expense. This crucial column shows the total interest expense recognized in each period. We add the interest paid, which is the coupon payment, to the amortization amount. Here, the interest expense for each period is $58.66, which is $50 interest paid plus $8.66, which is the amortization. And the last column shows the book value of the bond. This column tracks the bond liability on the balance sheet over time. It starts at the issuance price of $965.35 and increases by the amortization amount each period. Here we can see that $965.35 plus $8.66 gives $974.01, which is the book value of the debt at the end of period 1. And then you add a further $8.66 to get the book value of debt at the end of period 2, and so on. At the end of 4 periods, you should end up with $1,000. With the straight line method, the amortization gradually reduces the discount while the book value of the bond increases. Over the 4 periods, the entire discount is amortized and the book value reaches $1,000, which is the face value upon maturity. Straight line provides a straightforward way to distribute the discount expense. Later, we'll examine the effective interest method, a more complex but precise approach that considers the time value of money. Okay, we've explored how the straight line method allocates the discount on a bond issued at discount. Now, let's look at the corresponding journal entries. Recall that we've already seen the entry at the time of issuance where we record the cash received, the bond payable liability, and the initial discount. For each semi-annual period, we recognize the interest expense. We debit interest expense for $58.66, which includes the $50 coupon payment and the $8.66 of discount amortization. Simultaneously, we decrease the discount by crediting the discount on bonds payable account by $8.66, and we credit cash for the $50 coupon payment. Upon maturity, first we remove the bond liability by debiting bonds payable for its face value of $1,000, and then we credit cash for the $1,000 paid to the bondholder, representing the principal repayment. Let's quickly look at an alternative way to account for a bond issued at a discount without using a separate discount on bonds payable account. At issuance, we directly record the bonds payable at the amount of cash received, which is lower than the face value in a discount scenario. In our example, we debit cash for $965.35 and we credit bonds payable account for the same amount. With each semi-annual period, we recognize the interest expense using the straight line amortization method. As before, we debit interest expense for $58.66, whereas instead of crediting a discount on bonds payable account, we now credit bonds payable directly for the amortization amount of $8.66. This gradually increases the bonds payable balance on our balance sheet. At maturity, the final entry includes a debit to bonds payable for the remaining amount of the discount, which is $34.65, and another debit to bonds payable for the full face value, which is $965.35. So together, a total of $1,000 in debits. We credit cash for the $1,000 paid, representing the principal repayment. This method achieves the same goal of recognizing both the bond's interest and the discount amortization. Instead of a contra liability account, it directly adjusts the bond payable liability on the balance sheet. So far, we've explored the straight line method for amortizing the discount on a bond issued at discount. Now, let's introduce the effective interest method, which is a more precise approach. Straight line allocates the discount equally over a bond's life, regardless of the interest rate or the changing book value of the bond. The effective interest method considers the time value of money and calculates the interest expense based on the bond's carrying value or book value at the beginning of each period. This results in an increasing amortization amount over time as the book value of the bond increases. This table shows the breakdown for each semi-annual period using the effective interest rate method on our discount bond example. The interest paid column, as earlier, represents the fixed cash coupon payment made every 6 months. The interest expense column shows the total interest expense recognized in each period using the effective interest rate. It is calculated as 12% times half, in order to represent half a year, times the book value at the beginning of each period. The amortization column will reflect the portion of the discount recognized as expense in each period. This can be calculated by subtracting the interest paid from the interest expense in each time period. And finally, book value of bond. This column will track the changing book value of the bond throughout its life. It starts at the issuance price and will be updated each period based on the interest expense and amortization. In this case, we can see that the book value of debt is increasing by the amortization, which is calculated in this column. And finally, at the end of 4 periods, we are left with a book value of $1,000. Unlike the straight line method with fixed amortization, the effective interest method provides a more dynamic calculation that reflects the changing value of the bond over time. It's important to note that the structure of the journal entries remains similar to the straight line method. We will record interest expense, amortization of the discount, and the cash coupon payment. However, the key difference is that the amounts for interest expense and discount amortization will vary in each period under the effective interest method because the amortization is not constant. The specific amounts can be obtained from the table as calculated. Additionally, remember that the alternative way of recording these transactions still exists. We can always avoid using a separate discount on bonds payable account and instead directly adjust the bonds payable liability on the balance sheet. Now, let's switch gears and explore what happens when a bond is issued at a premium. This occurs when the bond's coupon rate is higher than the prevailing market rate. For our example, the bond has a 10% coupon rate paid semi-annually, but the market expects an 8% return for similar investments. This makes our bond attractive to investors. Visualizing the cash flows, we see the regular $50 interest payments for 4 periods, followed by the $1,000 principal repayment at maturity. However, since this bond is attractive, the investors are willing to pay more than the face value upfront. Our next step is to calculate the actual issue price of this bond, which will definitely be higher than $1,000. Now let's calculate the price at which this premium bond will sell. Since the coupon rate is higher than the market rate, it will trade at a price above its face value. Recall that we calculate the present value of each cash flow using the market rate. Because interest payments are paid semi-annually, we'll again use 4%, which is half of 8% as our discount rate. Notice that the sum of the present values is now $1036.30. This represents the bond's selling price at a premium. Now that we understand how to calculate the price of a bond issued at a premium, let's explore how we account for that premium over the bond's life. We'll use the straight line amortization method with some key differences from bonds issued at a discount. The concept of amortization remains the same. We gradually spread the premium amount over the life of the bond. We use the straight line method, meaning we will amortize equal portions of the premium in each period. With the discount, we amortize it to increase the bond's carrying value towards the face value. With the premium, we amortize it to decrease the bond's carrying value down to the face value by maturity. Let's look at the calculations in this table. Notice that the book value starts at the issuing price of $1036.30 and gradually decreases over time. Let's break down the calculations in this table. First, we determine the total premium by subtracting the face value $1,000 from the issuer price of $1036.30. This gives us a premium of $36.3. Next, we divide the total premium by the number of payment periods, which is 4, and find the amortization per period, which comes down to $9.08. In each period, the interest paid remains constant at $50. The interest expense is calculated by subtracting the amortization amount from the interest paid, resulting in $40.92. Notice the amortization amount is subtracted here since it reduces the premium on the bond. Finally, we adjust the book value of the bond each period. We start with the issue price and then subtract the amortization amount every time period. The book value gradually decreases until it reaches the face value of $1,000 upon maturity. Here are the journal entries for a bond issued at a premium using the straight line amortization method. Let's focus on the key differences from bonds issued at a discount. Similar to the discount scenario, we record the cash received and the bonds payable liability. However, unlike a discount where we have a separate contra liability account, for a premium, we have a premium on bonds payable account with a credit balance. This represents the excess amount paid over the face value. The interest expense is then calculated considering both the coupon payment and the amortization of the premium. However, unlike the discount scenario where amortization increased the expense, here amortization decreases the expense by debiting the premium on bonds payable account. Overall, the structure of the entries is very similar, but the key difference lies in how the premium on bonds payable account is used. It reflects the gradual reduction in the bond's carrying value to reach its face value upon maturity. Finally, remember, as we discussed when accounting for bonds issued at a discount, there's always an alternative method where instead of using a separate premium on bonds payable account, you can directly adjust the bonds payable liability on the balance sheet. Similar to the case of discounts, the effective interest method can also be used for a bond issued at a premium. It's a more precise approach compared to the straight line method. The straight line method allocates the premium equally over the life of the bond. In contrast, the effective interest method considers the time value of money and calculates interest expense based on the bond's carrying value, which changes each period. This calculation uses the bond's market interest rate at the time it was issued. Let's look at this table, which shows the breakdown for each semi-annual period using the effective interest method on our premium bond example. So the first interest expense, for example, is calculated by dividing 50 over 1 plus 4%, which is the interest rate for half a year, to the power of 1. So that gives you the present value of this $50 at the end of time period 1. Okay, and we repeat the process for all the time periods, just changing the power to the power of 2, to the power of 3, and to the power of 4. And amortization is calculated as the difference between the two. And once you've calculated amortization, you simply have to use it to subtract from the book value of debt consistently in order to reach 1000 after 4 time periods. The effective interest method offers a more dynamic picture of how the premium affects the bond's value over time. The structure of the journal entries under the effective interest method for bonds issued at a premium is similar to the straight line method. We will record interest expense, amortization, and the cash payment in each period. However, the key difference lies in the calculated amounts for expense and amortization, which will change based on the effective interest rate and the book value. As in the straight line scenario, remember that you can opt to avoid using a separate premium on bonds payable account. Instead, just adjust the bonds payable liability on the balance sheet directly to reflect the amortization. Finally, this chart offers a helpful visual representation of how the book value of a bond changes over time under different conditions. It uses the straight line method, but let's explore what we are seeing here and how it helps us understand the big picture. Let's start with the bond issued at discount. Notice how the book value begins below the face value and gradually increases through amortization. As we approach maturity, the book value and the face value, they converge. Now consider a bond issued at par. In this case, the book value remains constant as the face value throughout the life of the bond. This stability occurs because there is no premium or discount to gradually adjust. Finally, observe the line representing a bond issued at a premium. The book value starts above the face value and through amortization steadily declines until it reaches the face value at maturity. Visualizing these trends using a chart like this helps put together the concepts of amortization, premiums, and discounts. It reinforces our understanding of how a bond's carrying value on the balance sheet evolves throughout its life. It's important to remember that if we were to use the effective interest method instead of the straight line method, the general trends would remain similar. However, the lines would exhibit slight curves due to the way effective interest method considers the time value of money. The rate at which the book value changes would slightly vary, reflecting the more precise calculation method. So far, we've explored traditional bonds that pay regular coupon interest payments. Now let's introduce a unique type of bond, zero coupon bonds. What makes these bonds unusual? As the name suggests, they don't make periodic interest payments. This would make you wonder why anyone would invest in them. Recall our discussions on bond discounts. The key lies in the deeply discounted price at which these bonds are sold. Even without coupon payments, investors can still earn a return because the bond is purchased well below its face value. When a zero coupon bond matures, instead of receiving regular interest, the investor receives the full face value. The difference between the purchase price and the face value represents the investor's return. Let's understand how zero coupon bonds are priced. Remember, investors still aim to earn the market rate of return, which in our example is 10%. With no coupon payments, their entire return comes from the difference between the price they pay for the bond and its face value of $1,000. In essence, this difference acts as the interest. The key is calculating the present value. If an investor wants to earn a 10% return over 2 years, they need to determine how much should they pay today in order to receive $1,000 at maturity. We use a present value calculation here. For this bond, the present value or the price the investor should pay comes out to be $826.45. By purchasing this bond at $826.45 and receiving $1,000 upon maturity, the investor earns a return that's effectively equivalent to a 10% interest rate over a period of 2 years. Bonds are usually issued with long-term maturities. Investors who need cash before the bond reaches maturity always have the option to sell those bonds on the open market. Keep in mind that this type of transaction doesn't directly affect the financial records of the company that issued the bond. However, under certain circumstances, a company might decide to retire bonds before their scheduled maturity. One way to do this is with callable bonds. These bonds include a call feature giving the issuer the right to retire the debt early. Typically, callable bonds come with a call premium, a percentage of the par value added as compensation for the bondholders. Let's consider our example of a $1,000 bond issued at par with a 10% coupon rate and a 2-year maturity. If the company decides to call the bond at 102% of the par, they would then pay $1,020 to retire it. This $20 difference represents the call premium. When recording this transaction, we would debit the bonds payable account to remove the liability. Then we would debit a loss on the bond call account as this represents an expense for the company. This loss would also be reflected on the income statement. Finally, we credit the cash account for the total amount paid. Sometimes a company might choose to retire bonds without a call feature by purchasing them on the open market. This could be an attractive option if the market conditions cause the bond's price to fall below the price that would be paid with the call premium. Remember, interest rates and bond prices have an inverse relationship. If interest rates rise, the value of the existing bonds fall, potentially offering a cost-effective way to retire the debt early. This session explored the accounting treatment of bonds, focusing on how companies issue and record bonds at par, at a premium, and at a discount. We discussed the concepts of amortization, coupon payments, and how the book value of a bond evolves over time. We also delved into zero coupon bonds and how they are priced to deliver a return to investors despite the absence of periodic interest payments. Finally, we covered early retirement of debt and the accounting considerations for callable bonds and open market repurchases. In the next session, we'll shift our focus to equity, the other main source of financing for corporations. We'll explore how companies account for the issuance of common stock, stock dividends, and stock buybacks. Thank you for watching. See you in the next one. Hi there. Welcome to session 9 of our financial accounting course. In this session, we are shifting our focus to a crucial section of the balance sheet, that is equity. Up until now, we spent a lot of time discussing assets, what a company owns, and liabilities, what a company owes. But equity is what's left over. It represents the owner's stake in the company. It's the residual interest in the assets of the entity after deducting the liabilities. So in this session, we'll be diving into the various components of equity, how they are accounted for, and why they're so important for understanding a company's financial health. We'll cover topics like common stock, preferred stock, retained earnings, and treasury stock, among others. Alright, let's take a quick look at what we'll be covering in this session on accounting for equity. We'll start by talking about the types of owners of a company. This might seem obvious, but it's important to understand the different forms ownership can take, especially in corporations. We'll briefly touch on sole proprietorships and partnerships for context, but our main focus will be on shareholders in a corporation. Then we'll dive into everything about shares. This is the core of our discussion on equity, right? We'll explore what shares represent, the rights and responsibilities of shareholders, and the key terminology associated with shares like authorized, issued, and outstanding shares. Okay. Finally, we'll get into the types of shares and we'll focus on the two main categories, common stock and preferred stock. Let's get started. Alright, so before we dive into the specifics of accounting for equity, it's important to understand the different types of business ownership structures. First, we have the simplest form, that is sole proprietorship. This is a business owned and operated by a single individual. Okay? The owner directly receives all the profits and is personally liable for all the business debts. Okay? It's easy to set up, but there's no separation between the owner and business legally. Okay? Moving on, we have partnership. This is a business owned by two or more individuals who agree to share in the management and profits or losses. Okay? Like a sole proprietorship, the partners are personally liable for the debts of the business. Okay? Then we have a limited liability company. Okay? This structure offers a bit more flexibility. It combines some of the pass-through taxation advantages of partnerships with the limited liability of corporations. This means the owners, who can also be called as members, are generally not personally liable for the company's debts. And finally, we have the corporation. A corporation is a separate legal entity from its owners who are called shareholders. Okay? Corporations offer limited liability, meaning shareholders are generally not personally liable for the corporation's debts. Okay? Corporations can also raise capital more easily by issuing stock, but they have a more complex management structure and face more regulations. For our purposes in this session, we'll be focusing primarily on the corporation. Okay? This is because corporations are the ones that issue stock, which is the main component of equity that we'll be discussing. While the other forms of ownership are important, understanding corporate equity is the key to financial accounting. Now let's take a closer look at the typical ownership structure of a corporation. This organizational chart helps illustrate the relationships between the different parties. At the top, we have the shareholders. These are the owners of the corporation, right? They own shares or stock which represent ownership in the company. And importantly, stockholders who own voting shares have the right to elect the next level. Okay, the stockholders elect the board of directors. The board of directors is responsible for overseeing the corporation's activities. Okay, it sets the overall strategy and makes major decisions. The board can consist of both internal managers who are employees of the company and also external non-managers. Okay, the board of directors then appoint the president or CEO, the chief executive officer, right? The CEO is responsible for the day-to-day operations of the company and implementing the strategy that has been set by the board. Okay. Finally, the president or CEO employs various vice presidents or managers to head different departments such as finance, sales, operations, human resources, etc. Okay. These managers are responsible for the specific functions within their departments. This structure highlights the separation of ownership and management in a corporation. The owners, who are the stockholders, don't directly run the company. They elect the board, who then appoints a management team. This is a key characteristic of corporations and has important implications for accounting and governance. So we've established that corporations have owners, also known as stockholders, right? But what exactly does it mean to own stock? Well, first and foremost, a stock is an ownership unit in a corporation. When you buy a share of stock, you're buying a small piece of ownership in that company. You become one of the owners, sharing in the company's fortunes and misfortunes. It's also important to know that there are different types of stocks. The two main types of stock are common stock and preferred stock, which we'll discuss in a lot more detail later. Okay? And finally, owning stock comes with certain benefits for shareholders. These can include dividends, for example. These are distributions of the company's profits to shareholders. They also have potentially voting rights. Common stockholders typically have the right to vote on certain company matters, such as electing the board of directors, for example. Okay, and also they benefit from capital gains. So if the company performs really well and the stock price increases, shareholders can sell their shares for a profit. All right, let's talk about how companies categorize their shares. It's important to understand these classifications as they have different implications for both the company and the shareholders. First, we have authorized shares. These are the maximum number of shares that a company is legally allowed to issue as specified in its corporate charter or articles of incorporation. It's like the upper limit of how many ownership units the company can create. The company needs approval to increase this number. Then we have issued shares. These are the portion of the authorized shares that the company has actually sold to investors. When a company needs to raise capital, it may issue shares to the public or to private investors. So issued shares represent the shares that have been born and given to shareholders in exchange for money or other assets. Okay. Finally, we have outstanding shares. These are the issued shares that are currently being held by shareholders. Okay. This is the most important number for investors because it represents the actual number of shares that are trading in the market and that gives shareholders ownership rights. Okay. Finally, there's one important distinction to make here: treasury shares. These are shares that the company has issued and then later repurchased from shareholders. Treasury shares are not considered as outstanding. They're held by the company itself and don't carry voting rights or dividend rights. Alright, so we've established what a common stock represents. Now let's look at a key distinction here: the difference between common stock with par value and common stock with no par value. Okay, par value stock is a stock with a nominal or face value stated in the company's charter. For example, this could be $1 per share. Okay, historically, par value was used to set a minimum issuance price to protect creditors. Okay, when a company issues par value stock, the proceeds are split. The par value of the shares is credited to the common stock account, and any amount received above the par value is credited to an additional paid-in capital account. Okay, par value stock is less common in modern practice due to complexity and limitations. On the other hand, no par value stock is the stock that does not have a face value stated in the company's charter. Okay, it provides flexibility in pricing shares and reduces administrative burden. Okay, when a company issues no par value stock, the entire proceeds are credited to common stock or stated capital. Okay, no par value stock is more common among newer companies, mainly for their simplicity and flexibility. Alright, so we've talked about what stock is, and now let's see how it's issued. A key event is the initial public offering or IPO. Okay, this is when a private company first offers shares of its stock to the public in order to raise capital. It's how many companies fund their growth. This slide shows the journal entries for issuing stock. First, let's look at an example for par value stock. Company ABC sold 1,000 shares of its stock. Each share has a par value of $1, okay, but they sold it for $20 per share. The journal entry shows that we debit cash for 20,000, okay, which is the total amount received, 1,000 multiplied by 20, okay. We credit $1,000 to the common stock account, which is the total par value, okay. We credit the rest, which is $19,000, to the additional paid-in capital account. Okay, this is the amount that is received above the par value. Okay, additional paid-in capital may also be sometimes referred to as capital in excess of par or share premium, for example. Okay, these are all terms used to describe the amount of money raised from the sale of stock that exceeds the par value. Okay, next, let's look at an example for no par value stock. Company XYZ sold 1,000 shares of its no par value stock, okay, for $20 per share. The journal entry is much simpler now. Okay, we debit cash for $20,000 and we credit common stock for $20,000. That's it, right? The entire proceeds go to the common stock account. As you can see, no par value stock simplifies the accounting because there's no need to split the proceeds. Okay, now it's crucial to distinguish IPOs from secondary market transactions. IPOs, as we just discussed, involve the company issuing new shares to raise capital. The company receives this money. Okay. Secondary market transactions occur when the investors buy and sell shares among themselves after the IPO. For example, if you buy shares of Apple on the stock exchange, you're participating in a secondary market transaction. Apple does not receive any money from that transaction. Therefore, secondary market transactions do not affect the company's equity accounts, and the company does not record any journal entries for these transactions. The accounting entries we just covered are only for the initial issuance of stock by the company. Alright, so let's talk about something interesting that companies sometimes do. They buy back their own stock. This is called a stock repurchase, and when a company does this, the stock they buy back is also called as treasury stock. Now, why would a company do this? Why would they spend money to buy their own shares? Well, there are a few key reasons. One reason is that it can actually increase earnings per share or EPS. Okay, think about it. If a company's profits stay the same, but there are fewer shares of stock floating around, then each remaining share gets a bigger slice of the profit pie. Okay, another reason is that it can boost the stock price. When a company buys back shares, it reduces the supply of those shares in the market, and that can drive up the price. Companies also repurchase stock to have shares available for things like employee stock option plans. And sometimes it can even be a strategy to prevent a hostile takeover. If someone's trying to buy up a lot of the company's shares to take control, buying back stock can make that a lot harder. Okay, this slide shows us how we account for a stock repurchase. Here's a scenario. Company ABC, okay, decided to buy 200 shares of its own stock, and they paid $30 per share to purchase them. Okay, that means the total cost of this repurchase is 200 shares times the $30, which comes out to $6,000. Okay, so how does that look in a journal entry? Well, we debit the treasury stock account by $6,000. Now here's a tricky point. Treasury stock is what we call a contra equity account. Okay, it's a bit unusual. It has a debit balance and it actually reduces overall stockholders' equity. So we treat it like a negative equity account. And then of course we credit or decrease cash by $6,000 because the company paid out that money to buy back stock. Okay, so this journal entry shows us how the company's purchase of its own stock reduces both its cash on hand and its overall equity. So we've talked about how companies sometimes buy back their own stock and that becomes treasury stock. Now let's say the company decides to sell some of that treasury stock again. Okay, this slide looks at what happens when the company resells the treasury stock for more than what they originally paid for it. Here's the situation. Remember company ABC from the previous slide? They bought back some of that stock earlier, right? Okay, now they are reselling 100 of those shares and they are selling them now for $35 per share. Okay, because the price has changed in the meantime. Now, it's important to remember how we handle treasury stock. It's a contra equity account, right? That means it reduces the company's overall equity. It's like negative equity. Okay, so when we get rid of some treasury stock by reselling it, we are actually increasing the company's equity. Okay, here's how we record this. First, the obvious part is we are getting cash, so we debit cash by 3,500, which is 35 times 100. Okay, then we credit or decrease the treasury stock account. But remember, it's a contra equity account, so decreasing it is like increasing your equity. Okay, we're going to credit it for $3,000. That's the original cost of those 100 shares when the company bought them back. Okay, we always use the original cost for treasury stock transactions. And finally, we have a little bit of extra money coming in here, right? Okay, we sold the stock for more than what we paid for. That difference, the $500, goes into the additional paid in capital account. Okay, that's an equity account. Okay, so to sum up, when a company sells treasury stock for more than it cost them, it increases their cash, it increases their equity, and the extra cash goes into additional paid in capital. Alright, so we've seen what happens when treasury stock is resold for more than the purchase price. But what about the opposite situation? What if the company resells its treasury stock for less than what it originally cost them? Okay, in this slide, we can see that company ABC, now they're reselling treasury stock, but this time the price has fallen to $24 per share. Okay, again, we have to remember that treasury stock is a contra equity account. Okay, so when we reissue it, we are increasing equity. Here's the journal entry. We still get cash, okay, 24 times 100. So cash would be debited $2,400. Okay, we credit or decrease treasury stock for $3,000. Why? Again, we use the original cost of repurchase. Okay, finally, additional paid in capital, we have to settle the difference here, right? We are getting less cash than the original cost of the stock. That difference, the $600, reduces the additional paid in capital. That's why we debit or decrease the additional paid in capital account. An important note here, what if the additional paid in capital account doesn't have enough money in it to absorb that difference? What if it's not enough to take that $600 hit? In that case, we would debit retained earnings. Okay, retained earnings is another equity account that represents the company's accumulated profits, right? So we take the hit against those accumulated profits. Okay, so to sum it up, when a company sells treasury stock for less than it cost them, it increases their cash, but it decreases equity. And that decrease in equity usually hits the additional paid in capital account first, and then the retained earnings account if necessary. Alright, let's move on to another important aspect of equity, especially in the context of employee compensation. We're going to talk about stock options. Stock options give employees the right to purchase company stock at a predetermined price called the exercise price within a specified period. Okay, they're often used as an incentive to align employee interests with the company's success. Okay, if the company does well and the stock price goes up, the employee can buy shares at the lower exercise price and potentially make a profit from that. Okay, in this slide, we can see a typical timeline of stock options. It starts when options are granted to the employee. Okay, the company gives the employee the option to buy its stock. Then begins the vesting period. Okay, this is a specified time period during which the employee has to work for the company before they are allowed to exercise their options. It's like a waiting period. It encourages employees to stay with the company, right? Okay. At the end of this vesting period, the employee has fulfilled the requirements and the options become exercisable. Okay. After the vesting period, the employee enters the exercise window. This is the period during which the employee can actually buy the company's stock at the exercise price. And of course, this comes with an expiration date, right? This is the last possible date the employee can exercise their options. After this date, the options are completely worthless. Okay, so stock options are a form of equity compensation that can be a powerful tool for motivating employees and aligning their interests with those of a company's shareholders. All right, so we've talked about how shareholders can benefit from stock ownership through capital gains. Another key way is through dividends. These are distributions of a company's profit to its shareholders. Okay, in this slide, we outline the accounting entries for cash dividends on common stock. Okay, it's important to understand that there are three key dates involved in the dividend process and each has specific accounting implications. Okay, first is the declaration date. Okay, this is the date when the company's board of directors officially announce that a dividend will be paid. Okay, this is when the company legally incurs a liability to pay the dividend. Okay, so the journal entry on the declaration date is that we debit retained earnings for the amount of the dividend. Okay, retained earnings is an equity account representing the company's accumulated profits, right? Okay, dividends reduce these accumulated profits. We credit dividends payable, okay, for the amount of the dividend. Dividends payable is a liability account here, right? Okay, representing the company's obligation to pay the dividend to the shareholders. Then comes the date of record. This is the date the company determines who will receive the dividend. Essentially, it's a snapshot of who owns the stock on that particular day. No journal entry is recorded on the date of record. Okay, this is simply an administrative date to determine eligibility. Okay, finally, the date of payment. This is the date the company actually distributes the cash to shareholders. Okay, the journal entry on the date of payment is that we debit dividends payable for the amount of the dividend. Okay, this removes the liability we created on the declaration date. Okay, we credit cash for the amount of the dividend. Okay, this reflects the cash outflow from the company. However, before a company can distribute these dividends, they must ensure that they are in compliance with any existing loan covenants. Okay, for example, if the company's loan agreement includes a minimum retained earnings requirement, the dividend payout cannot cause retained earnings to fall below that minimum. Okay. Additionally, covenants regarding debt to equity ratios or current ratios can also restrict dividend payments. Okay. Even if the math shows that the company has cash, the loan agreements can prevent the distribution of this money. It is vital that a company reviews all its loan documents prior to the distribution of dividends. Alright, so we've covered cash dividends, which are distributions of cash to shareholders. Okay, now let's discuss another type of dividend, the stock dividend. A stock dividend is a distribution of additional shares of the company's own stock to its shareholders. The company essentially gives shareholders more shares instead of cash. Now, why would a company do this? Well, first of all, it doesn't affect the company's cash. It can be used to lower the stock price, making it more affordable to investors. It can also signal to investors that the company is confident in its future prospects. Okay, in this slide, let's see a journal entry example for this. Okay, company ABC issued a large stock dividend of 200,000 shares of its $1 par value common stock. We debit retained earnings for $200,000. Okay, just like we would do with cash dividends. Okay, stock dividends reduces retained earnings. We credit common stock for $200,000. This reflects the increase in the number of shares outstanding. Okay, it's important to note that the impact of a stock dividend is different from a cash dividend. Okay, a cash dividend reduces the company's assets and also equity. But a stock dividend, on the other hand, does not affect the company's assets. It simply redistributes the equity by decreasing retained earnings and increasing common stock. Alright, so we've just discussed stock dividends. Now let's introduce another concept that's often confused with them. Stock splits. A stock split is a corporate action where a company increases the number of outstanding shares while proportionally reducing the par value per share. Okay, it's like cutting a pizza into simply more slices, but the total size of the pizza stays the same. Okay, this slide provides a helpful comparison between stock dividends and stock splits to clarify their differences. Okay, let's start with a scenario here where a company has 10,000 shares outstanding. Okay, a par value of $1 per share, which means the total par value outstanding is $10,000. Let's assume that the company has a retained earnings of $25,000. Okay, and a total stockholders equity of $100,000. Okay, now let's see what happens after a 100% stock dividend. Because of the 100% stock dividend, the number of shares outstanding doubles to 20,000. Okay, 100% stock dividend means that for every share you own, you get one additional share. Okay, the par value per share remains the same at $1. Okay, the total par value outstanding doubles to $20,000. Okay, retained earnings now has to decrease by $10,000. Okay, so from 25,000 it goes to 15,000. However, the key takeaway is that the total stockholders' equity remains unchanged at $100,000. Okay, a stock dividend simply redistributes equity from retained earnings to contributed capital. Okay, now let's see what happens after a 2-for-1 stock split. Okay, the number of shares outstanding doubles to 20,000. Okay, a 2-for-1 split means that for every one share you own, you get 2 shares now. Okay, the par value per share is half to 50 cents. Okay, this is the key difference from a stock dividend. The total par value outstanding, it remains the same at $10,000. Okay, 20,000 times 0.5 is $10,000. Retained earnings remains unchanged now at $25,000. Okay, and again, total stockholders' equity also remains unchanged at $100,000. Okay, a stock split does not affect any equity accounts. So what's the difference? Both stock dividends and stock splits increase the number of shares outstanding and can also reduce the price per share. This can make the stock more affordable and increase its liquidity. Okay. However, a stock dividend affects retained earnings while a stock split does not. Okay. A stock split changes the par value per share while a stock dividend does not. Now, when might a company prefer one over the other? Companies might use a stock dividend to signal confidence in their future earnings. Okay, because it involves a reduction in retained earnings, it suggests the company has enough profits to distribute. Okay, companies might use a stock split simply to make their stock more affordable and increase trading activity without wanting to affect their retained earnings. Ultimately, both are tools companies use to manage their stock and appeal to investors. Alright, so we've spent a good bit of time on common stock now. Okay, let's talk about the other main type of stock a company can issue, preferred stock. Preferred stock is a bit different from common stock. It has some unique features that make it appealing to certain investors. Okay, here are some key characteristics. Okay, fixed dividends and dividend preference. One of the most important features of preferred stock is that it typically pays fixed dividends. Okay, this means the amount of the dividend is usually set at a specific percentage of the stock's par value or a fixed dollar amount. Okay. Also, preferred stockholders have a preference over common stockholders when it comes to receiving dividends. Okay. The company must pay the promised dividends to the preferred stockholders before it can pay any dividends to common stockholders. This makes preferred stock less risky than common stock in terms of income. Okay. Then we are looking at liquidation preference. In the event of a company's liquidation, preferred stockholders also have a preference over common stockholders here. Okay, when it comes to receiving the company's assets. They get their investment back before common stockholders receive anything at all. Okay, this also makes preferred stock less risky than common stock. Okay, and then preferred stockholders receive no voting rights. Okay, in contrast to common stock, preferred stockholders usually do not have any voting rights. Preferred stockholders generally do not get a say in how the company should be run, and this is a very significant difference. And finally, preferred stock can sometimes have a callable or a convertible feature. Okay, when I say callable, this means that the company has the right to buy back the preferred stock from the shareholders at a specified price. Okay, when I say convertible, this means that the preferred shareholders have the right to convert their preferred stock into common stock, usually at a predetermined ratio. Okay, so preferred stock is like a hybrid security, right? It has some characteristics of stock, okay, like ownership, and some characteristics of debt, like fixed income, right? Okay, it offers investors less risk than common stock, but also less potential for upside gain and usually no voting rights. Okay, let's look at a specific example of how dividends are allocated between preferred and common stock. Remember, preferred stock has that dividend preference, okay, meaning they get paid first. Okay, let's say company ABC has two types of stock outstanding. Okay, first they have 2000 shares of preferred stock. Okay, the preferred stock has a 5% dividend rate and a par value of $50. Okay, the total par value of the preferred stock hence would be $100,000. Okay, 2000 times 50. Okay, they also have 50,000 shares of common stock with a par value of $10. Okay, so the total par value of the common stock would be $500,000. Okay, now imagine the company declares a total dividend of, let's say, $17,000. Okay, how will this $17,000 be split between the preferred and common stockholders? Okay, the preferred stockholders are entitled to a 5% dividend based on the par value. Okay, so the total preferred dividend is calculated as 5%, okay, multiplied by 50, okay, which is the par value, multiplied by 2000, which is the number of preferred shares. This gives us $5,000. Okay, that means $5,000 of the total dividend will go to the preferred stockholders. Okay, the remaining amount will go to the common stockholders. So the common stockholders will receive $12,000, okay, which is 17,000 minus the $5,000. Okay. In this case, you see how the preferred stockholders get their fixed dividend first, and then whatever is left over goes to the common stockholders. Okay, assuming that the company is legally allowed to pay dividends, okay, due to all the loan covenants. Okay, remember preferred stock has a preference for dividends. Okay, if dividends are declared, they get paid to preferred stockholders first before the common stockholders. Okay, but with cumulative preferred stock, for example, if the company misses a dividend payment in 1 year, that unpaid dividend accumulates and must be paid in future years before any dividend can be paid to common stockholders. Okay, these unpaid dividends are said to be in arrears. Okay, of course, if the preferred stock is non-cumulative, dividends can never be in arrears. Okay, any preferred dividends that are not declared are permanently lost. Because preferred stockholders are unwilling to accept this unfavorable feature, preferred stock is usually cumulative. Okay, let's revisit our earlier example. Okay, company ABC, it has preferred stock, 2000 shares, 5% dividend rate, $50 par value. Okay, total par value is $100,000. Okay, common stock, 50,000 shares with a $10 par value. Okay, totally $500,000 in par value. Okay, but here's the key difference. Dividends have been in arrears for 2 years, let's say. Okay, this means the company hasn't paid the preferred stockholders their dividends for the previous 2 years. Okay, now imagine the company declares the same dividend of $17,000 this year. Okay, let's see how that would be split. Okay, first for preferred dividend, okay, we calculate the annual preferred dividend, okay, which is 5% times 50 times the 2000. Okay, that's $5,000 per year. Okay, since the dividends are in arrears for the past 2 years, okay, we multiply the annual dividend by 3 because 1 for the current year and 2 for the past 2 years. Okay, hence the preferred dividend would be $15,000. Okay, so the preferred stockholders are entitled to $15,000 out of the total $17,000. Okay, the remaining amount goes to the common stockholders, which is a mere $2,000. Okay, in this case, because of the cumulative feature, the preferred stockholders get a much larger portion of the dividend to make up for the unpaid dividends from the previous years. Alright, so we've been deep diving into the complexities of corporate equity with its various share classes, treasury stock, and dividends. Okay, now let's take a step back and look at the simplest form of business ownership, which is the sole proprietorship. Okay, in a sole proprietorship, the business is owned by a single individual. Okay, there's no separation between the owner and the business, which makes the accounting for equity much more straightforward. Okay, let's look at this example involving Joe. Okay, first, Joe starts his business by investing $100,000 of his personal savings. Okay, this increases the business's cash, which is an asset, by $100,000. Okay, on the other side of the accounting equation, this investment increases Joe's capital, which is the owner's equity, okay, by the same amount. Okay, notice how we directly use Joe's name in the equity account. Okay, this highlights that there's no distinction between Joe and his business financially. Okay, next, Joe withdraws $2,000 for personal expenses. This reduces the business's cash by $2,000, and it also reduces Joe's equity through a drawings account. Okay, Drawings represent the owner's withdrawals of cash or other assets from the business for personal use. Okay, it's important to note that these withdrawals are not expenses of the business, they are distributions of equity. Okay, the key takeaway here is the direct connection between the owner's personal financial activities and the business's equity. Okay, unlike corporations where equity is divided among numerous shareholders and managed through complex accounts, a sole proprietorship's equity is directly tied to the individual owner. This makes it simpler but also means that the owner bears all the risks and rewards of the business. Building on the previous example, let's look at how Joe's equity changes over the course of a year and how it's presented on the balance sheet. Okay, remember, in a sole proprietorship, the owner's equity is directly linked to the owner's capital account. So at the beginning of the year, on January 1st, Joe's capital was $100,000, representing his initial investment. Okay, throughout the year, the business generated a net income of, let's say, $50,000. Okay, this net income increases Joe's capital. Okay, think of it as the business's profits flowing directly to the owner. Okay, it's a key difference from corporations where profits are retained within the company unless distributed as dividends. Okay, however, let's say Joe also withdrew $12,000 for personal expenses during the year. These withdrawals, as we discussed earlier, they reduce Joe's capital. They're not expenses of the business and rather a distribution of the owner's equity. Okay, to calculate Joe's capital at the end of the year on December 31st, we take the beginning capital, we add the net income, and we subtract the withdrawals. Okay, so that equals $138,000 here. And this represents Joe's total equity in the business at the end of the year. Okay, it's the residual interest in the assets of the business after deducting the liabilities. Okay, this is what would be reported on the balance sheet under the owner's equity section. The simplicity here is very striking, right? In a sole proprietorship, the owner's equity is directly affected by the business profits and the owner's personal withdrawals. Okay, there's no complex share structure or dividend payments to consider. It's a direct reflection of the owner's investment and the business performance. Finally, let's briefly touch on partnerships, which are another common business structure. Okay, while we won't go into as much detail as we did with corporations, it's important to understand how equity works in this context. Okay, in a partnership, the business is owned by two or more individuals. Okay, the key difference from a sole proprietorship is that the equity is divided among the partners. Okay, each partner has a capital account that reflects their ownership stake. Okay, in this slide, we'll see a very simplified example. Okay, let's say we have a partnership with two partners, partner A and partner B. And let's say at the beginning of the year, on January 1st, their combined equity was $100,000, which is split between them. Okay, $60,000 for partner A and $40,000 for partner B. Okay, throughout the year, let's say they made additional investments, earned net income, and made withdrawals. Okay, these activities are similar to what we saw in the sole proprietorship example, right? Okay, however, the key difference is that these activities are now allocated between the partners according to their partnership agreement. For instance, partner A made an additional $20,000 investment. Okay, the business generated a net income of $50,000, which was allocated between the partners. Okay, this must have been specified in the partnership agreement as to how they would split this. Okay, they also made withdrawals of $12,000. Again, the partnership agreement should have specified something about how this would be accounted. Okay, at the end of the year, on December 31st, their combined equity now is $158,000. Okay, and each partner would also have their own individual equity balance. This is what would be reported on the balance sheet under the partner's equity section, okay, which is the owner's equity. Okay, the main takeaway here is that while partnerships are more complex than sole proprietorships, they're still simpler than corporations in terms of equity accounting. Okay, the equity is divided among the partners, but there's no complex share structure or stock transactions to consider. Okay. Well, this brings us to the end of our session on accounting for equity. In our next session, we'll be shifting our focus to a related area, accounting for investments in other corporations. We'll explore how companies account for their ownership stakes in other businesses, which can sometimes be a significant part of their assets and financial strategy. Thank you for watching. See you in the next one. Cheers. Hi there. Welcome to part 10 of our financial accounting course. In this session, we'll be diving into the world of accounting for investments in other corporations. This topic is crucial because it goes beyond just looking at a company's internal operations. It helps us understand how a company's strategic decisions, like investing in or even acquiring other businesses, impact its financial position and performance. By the end of the session, you'll be able to identify different types of investments and understand the specific accounting rules that apply to each one. Let's go. To begin with, let's take a look at our agenda for this session. First, we'll discuss the strategic reasons why companies choose to invest in other firms. Following that, we will dive into the core of the session, which is the different types of investments and their specific accounting treatments. We'll break down investments into two main categories, debt and equity. For debt, we'll differentiate between investments held for the long term versus those not held to maturity. For equity, we'll look at three key levels of ownership from a minority stake to a controlling interest. This roadmap will guide us through the rest of our session on investment accounting. Before we get into the accounting specifics, let's address the fundamental question. Why do companies invest in other firms? There are three primary strategic reasons, and the accounting treatment we'll discuss directly corresponds to these reasons. First, a company might have passive investments. This is when a firm has extra cash and simply wants to earn a return on these idle funds. The goal is not to influence the other company, and this can be for either short-term or long-term purposes. Second, a company may invest with the goal of influencing policies. This is more active and is done to have a significant impact on the policies and activities of the other company. Finally, a company may want to control another company. This is the highest level of investment where the goal is to become the majority shareholder or to acquire the company directly. We'll discuss how the financial reports of both companies are combined in this scenario. Now let's look at the roadmap for investment accounting. This chart is a great way to see how we determine the correct accounting method. It all starts with the type of investment, right? Whether it's debt or equity. If it's a debt investment, the next question is about management's intent. Do they plan to hold it until it matures or not? This intent determines if we use the amortized cost method or the fair value method. If it's an equity investment, the deciding factor is the level of ownership, which corresponds to the level of influence a company has over the investee. Okay, as you can see, a minority stake of less than 20% ownership is considered a passive investment, and it also uses the fair value method. Okay, however, if a company has a significant stake of 20 to 50%, they are presumed to have a significant influence and must use the equity method. Finally, if a company has a controlling interest of more than 50%, it must use consolidation or acquisition accounting. We'll be returning to this overview at the end of the session to tie everything together. For now, let's start with the first branch of this tree, which is passive investments in debt. Okay, let's begin with the first investment type, which is debt held to maturity. Okay, this refers to a situation where a company purchases a debt security, such as a bond, with the intent and ability to hold it until it matures. The accounting method used here is the amortized cost method, which means the investment is reported at its original cost, adjusted over time for any premium or discount. On this slide, you can see a simple example. Okay, company ABC pays the par value of 100,000 for a bond and plans to hold it until maturity. Okay, the journal entry to record this purchase is straightforward. Okay, we debit the asset account, which is held to maturity investments, okay, in order to increase it, and we credit the cash account to show the cash outflow. As a side note, if you need a refresher on accounting for bonds that are purchased at a premium or a discount rather than at par, you can revisit session 8 of our course, okay, which covers this topic in detail. Now that we've seen the journal entry to purchase the bond, let's look at the subsequent entries for the interest earned and the receipt of the principal at maturity. Okay. First, for interest earned, we record the cash received from the interest payment and the corresponding interest revenue. Okay. In this example, the annual interest on the 100,000 bond at a 10% rate is 10,000. Okay. Since interest is paid semi-annually, the company receives $5,000 every 6 months. Okay. To record this, we debit the cash account for $5,000 and we credit the interest revenue account for $5,000. Okay. And as you can see, this entry is made 10 times over the 5-year life of the bond. Okay. Finally, on maturity, the company receives the original principal amount back. Okay. The bond matures and the investment is now cashed out. Okay. So we debit the cash account to show the $100,000 inflow. Okay. And we credit the held to maturity investments account to remove the investment from our balance sheet. Okay. Now let's move on to the next branch of our decision tree, which is passive investments that are valued using the fair value method. Okay. We use this method for all passive investments in marketable securities, which includes both debt securities that are not held to maturity and equity securities where we own less than 20% of the other company. Okay. There are two main reasons for using fair value. The first is relevance. Analysts want to know what a company's securities are actually worth today so they can better understand future cash flows if those securities are sold. Okay. The second reason is measurability. Okay. For actively traded stocks and bonds, it's very easy to get an objective, verifiable market price from an exchange, unlike a building or other assets that aren't actively traded. Okay. Further, when the value of a passive investment changes, we must record unrealized gains and losses. Okay. These are unrealized because no sale has taken place. Okay. The value has simply changed while the company is holding the security. Finally, we'll see that how we account for these unrealized gains and losses depends on our investment classification. Okay. The two primary classifications are trading securities and securities available for sale. Okay. Let's elaborate on the difference between these two. Trading securities are investments that a company actively trades with the goal of generating profits from short-term price changes. Okay. These are classified as current assets on the balance sheet. In contrast, securities available for sale are investments held to earn a return on funds that may be needed for future use. Okay. Most corporations use this classification. These can be classified as either current or non-current assets depending on when the management intends to sell them. All right. Let's look at how we record the initial transactions for both trading securities and securities available for sale. Okay. The accounting for the purchase of securities is the same for both classifications. Okay. We acquire 10,000 shares of company XYZ, okay, at $10 per share, okay, which costs $100,000. Okay. To record this, we debit the investments in TS or SAS depending on the type to show an increase in our investment, and we credit cash for the outflow of funds. Okay. The same logic applies to the receipt of dividends. Okay. Company ABC receives a cash dividend of 50 cents per share, which means they get a cash dividend of $5,000 in total. Okay. To record this, we debit cash for the inflow, okay, and we credit dividend revenue to show that we have earned revenue from this investment. These initial entries are identical regardless of whether the investment is classified as TS or SAS. Okay. The differences will become apparent at the end of the accounting period. Now we start seeing some crucial differences between trading securities and securities available for sale. Okay. In year one, the fair value of the stock falls from $10 to $8 per share, okay, which is a $2 loss per share or a $20,000 unrealized loss for our total investment. Okay. For a trading security, this unrealized loss is reported directly on the income statement. Okay. We debit unrealized loss to reflect the expense, and we credit investments in TS to reduce the asset's value to its new fair value, which is $80,000. Okay. In contrast, for a security available for sale, this loss is not included in the net income. Instead, it bypasses the income statement and goes directly to the balance sheet. Okay. We debit net unrealized losses, which is a separate component of other comprehensive income, okay, within the stockholders' equity section. Okay. And we credit investments in SAS in order to reduce the assets value. Okay. So the most important distinction between the two classifications here is the effect it has on net income. Now let's look at what happens in year 2 when the market moves upward. Okay, after the loss in year 1, the stock's fair value rises from $8 to $11 per share. Okay, this represents a $30,000 increase in the value of our investment. For a trading security, we again adjust the book value to its new fair value. Okay, we debit investments in TS to increase the asset's value, and we credit unrealized gain to reflect the gain on the income statement. In contrast, for a security available for sale, the process is similar, but the impact on the financial statements is different. We still debit investments in SAS to increase the asset's value, but we credit net unrealized gains, which again is a component of other comprehensive income. This gain does not impact net income for the year. Okay, this slide really reinforces the core difference we discussed earlier. The fair value change for a TS directly hits the income statement, while for an SAS, it bypasses the income statement and goes to stockholders' equity. Okay, we've tracked the investment for 2 years, and now let's look at the journal entry for when the stock is sold in year 3. Okay, let's assume that the company sells the stock when its fair value is $12 per share for a total of $120,000 in cash. While both classifications receive the same amount of cash, the entries for the rest of the transaction are different. First, let's understand why the current book value of the investment is $110,000. Okay, the investment was originally purchased for $100,000. Okay, at the end of year 1, its value dropped by $20,000, bringing the book value to $80,000. Okay, then in year 2, its value rose by $30,000, which brought the book value to its current fair value of $110,000. Okay, this is the amount we need to remove from the books for both classifications. Okay, for the trading security, we debit cash for the full $120,000. Okay, we then credit investments in TS for its current book value of $110,000. Okay, the difference, or the realized gain on sale, is $10,000, which we credit to the gain on sale account. Okay, this gain is reported on the income statement. Now for the security available for sale, the entry is a bit more complex because we have to clear out the unrealized gain or loss account that we've been building on the balance sheet. Okay, we debit cash for $120,000, that's straightforward. Okay, we also debit net unrealized losses or gains for $10,000 to clear the balance from our stockholders' equity section. Okay, why did we have a balance of $10,000? Because we had a negative $20,000 in year 1 and a positive $30,000 in year 2. Okay, so there was a net unrealized gain of $10,000. We need to remove that. Okay, we then credit investments in SAS for its book value of $110,000. Okay, this leaves a realized gain on sale of $20,000. Okay, which is the difference between the original cost of the investment, $100,000, and the sale price of $120,000. Okay, this gain also goes to the income statement. Notice that for the TS, the realized gain is just the change in value since the last balance sheet date. Okay, whereas for SAS, the realized gain is the total change in value from the original purchase date. Okay, we'll reflect on what we've learned so far by checking their impact on the different financial statements. Let's start by looking at how these transactions affect the balance sheet over the 3-year period. Okay, this table is an excellent way to visualize the difference in reporting. The top row shows the book value of the investments under the assets section for both classifications. As you can see, the book value is identical for both TS and SAS each year, okay, reflecting the fact that both are adjusted to their current fair value. Okay, the value is $80,000 in year 1, $110,000 in year 2, and $0 in year 3 after the sale. Okay, the key difference is in the bottom row, which shows the impact on stockholders' equity. Okay, for trading securities, the unrealized gain or loss is closed to retained earnings at the end of each year. Okay, it is close to retained earnings, and that goes to the net income in the income statement. Okay, so the balance sheet always shows $0 for this account. For securities available for sale, however, the unrealized gains and losses accumulate in a separate account under other comprehensive income. Okay, In year 1, we had a $20,000 loss shown as a negative. In year 2, the gain of 30,000 brought the cumulative balance to a positive 10,000. In year 3, the account is zeroed out when the security is sold. Okay, this table makes it very clear that while the asset value is the same, the reporting of unrealized gains and losses is fundamentally different on the balance sheet for these two classifications. Now let's compare the income statement reporting for each method over the 3 years. Okay, as you can see, the reporting here is where the classifications differ most dramatically. For trading securities, both the dividend revenue and the unrealized gains and losses from each year's adjustment are reported on the income statement. Okay, this leads to a volatile impact on net income. In year 1, we show a loss of $15,000, okay, which is 5,000 plus a negative 20,000. Okay, but in year 2, a gain of 30,000, and in year 3, a gain of 10,000 from the sale. Okay, for securities available for sale, the income statement is much more stable. Only the dividend revenue in year 1 and the gain on sale in year 3 are reported. The unrealized gains and losses for year 1 and year 2 never hit the income statement. Okay, this is a key point here. A company's choice of classification can have a major effect on how its reported net income looks from year to year, even if its investments have the same performance. Okay, and as we've highlighted at the bottom of the slide, while the timing of the gains and losses is completely different, the total impact on net income over the 3-year period is exactly the same for both methods. Okay, for both TS and SAS, the total impact on net income is $25,000. This shows that the accounting method primarily affects the timing of when gains and losses are recognized, but not the total amount. Alright, let's look at the next category of investment accounting, the equity method. Okay, this method applies when a company has significant influence over another, okay, which is typically the case when it owns between 20% to 50% of the other company's stock. The accounting starts with the purchase of stock. Okay, here company ABC buys a 30% stake in company XYZ for $300,000. Okay, we record this by debiting investments in affiliates to increase the asset and credit cash for the payment. Okay, the most important part of the equity method is how we account for the affiliates' earnings. Okay, since we have significant influence, we are a part owner and must recognize our share of their income as they earn it. Okay, as you can see, company XYZ reports a net income of $150,000. Okay, our share is 30% of that, which equals $45,000. Okay, to record this, we debit investments in affiliates for $45,000 to increase the book value of our investment. Okay, and we credit equity in affiliate earnings to recognize our share of the income on our own income statement. Now that we've seen how earnings are accounted for, let's look at what happens when dividends are received. Under the equity method, dividends are not considered revenue, okay, because we've already recognized our share of the affiliate's earnings on our income statement. Receiving a dividend is simply a portion of that equity being returned to us in the form of cash. So when company ABC receives $30,000 in dividends, okay, we debit cash to show an inflow, obviously, okay, but we credit investments in affiliates to reduce the book value of our investment. The table at the bottom shows the overall impact on the investments in affiliates account. Okay, we started with a $300,000 purchase. We then added a $45,000 share of the affiliates' earnings. Okay, finally we subtract the $30,000 in dividends received. Okay, this brings the final book value of our investment to $315,000. Okay, which is the amount that would be reported on the balance sheet at the end of the period. Now let's move to the final category from our overview, which is controlling interests. Okay, when a company acquires control of another, we use the purchase method or acquisition method, which is the required accounting method for mergers and acquisitions. This method requires us to record the acquired company's assets and liabilities at their fair value. Okay, however, what happens if the purchase price is more than the fair value of the assets we acquired? That excess amount is recorded as an intangible asset called goodwill. Okay, as you can see in this example, Company ABC acquires company XYZ for $900,000 in cash. Okay, the fair value of the assets acquired is $500,000 for equipment and $450,000 for patents. Okay, which gives us a total of $950,000. Okay, however, company XYZ also had liabilities amounting to $150,000. Okay, so the fair value of the net assets is $800,000. Okay, the difference between the purchase price of $900,000 and the fair value of $800,000 is $100,000. Okay, this excess amount is recorded as goodwill. Now let's look at the journal entry for a merger or acquisition. Okay, this entry records the acquisition of a controlling interest using the purchase method. Okay, we are debiting each of the assets acquired at their fair value and crediting the liabilities assumed. Okay, in our example, company ABC debits the equipment for $500,000 and patents for $450,000, as these are the fair values of the acquired assets. Okay, we then also record goodwill for $100,000, which represents the excess of the purchase price over the fair value of the net assets. Okay, remember, net assets are the assets minus the liabilities. Okay, on the credit side, we record the liabilities assumed, which in this case is the note payable of $150,000, and we credit cash for the total purchase price of $900,000. Okay, this entry removes the individual assets and liabilities of the acquired company from their books and places them on the acquiring company's books at their fair value. Okay, a final point on goodwill. Unlike other intangible assets, goodwill is considered to have an indefinite life. Okay, so it is not amortized. Instead, it must be reviewed for impairment of value on a regular basis. Okay, also in situations where one company acquires another, but both maintain their separate legal existence, consolidated financial statements are required. Okay, the company gaining control is referred to as the parent company. Okay, while the company that is acquired is the subsidiary company. If the parent purchases 100% of the subsidiary, the resulting consolidated financial statements will appear the same as if companies had been combined in a simple merger. We've covered a lot of ground in this session. Let's return to our decision tree to review all the investment categories and their corresponding accounting methods. Okay, as you can see, the correct accounting method depends on two key factors: whether the investment is in debt or equity, and management's intent or the level of influence the company has over the other firm. Okay, for debt investments, if the intent is to hold the security until maturity, we use the amortized cost method. If not, we use the fair value method. Okay, for equity investments, the accounting is determined by the level of ownership. Okay, a passive stake of less than 20% uses the fair value method. A significant influence stake of 20 to 50% uses the equity method, and a controlling interest of more than 50% uses acquisition accounting and consolidation. We've gone through the journal entries and financial statement reporting for each of these methods, giving you a comprehensive overview of investment accounting. Thank you for watching this video. In our next session, which is session 11, we'll cover the statement of cash flows, a crucial financial statement that provides a different perspective on a company's financial health. See you there. Cheers. Hi there. Welcome to session 11 of this financial accounting course, where we'll be focusing entirely on the statement of cash flows. This statement is crucial because it answers the critical question: where did the company's actual cash really come from and where did it go? Net income is important, but as some Wall Street analysts say, cash flow is king. By the end of this session, you'll be able to classify cash flows into the three main activities and master the reconciliation process of the indirect method. Our roadmap for this session is clear. First, we'll cover the three main sections of the statement, which is operating, investing, and financing activities. Okay, we'll focus heavily on the operating activities section as it's the most complex, and we'll concentrate on the indirect method used by most companies. Finally, we'll look at how to complete the full statement and review the required additional disclosures that accompany it. This session will ensure that you can not only classify cash flows, but also understand the core logic behind the entire financial statement. All right, this slide illustrates the fundamental conflict that makes the statement of cash flows necessary. Okay, the figure on the left is the basis for your net income. Okay, the accrual basis of accounting. Revenues are recorded when they are earned, and expenses are recorded when they are incurred or matched to those revenues. Okay, the figure on the right represents cash basis. Okay, recording revenues only when cash is received and expenses only when cash is paid. Because of this timing difference, net income rarely equals to net cash flow. As a consequence, analysts must consider the information provided in the cash flow statement in addition to the income statement and the balance sheet. The entire purpose of the statement of cash flows is to bridge this gap and reconcile the accrual-based net income back to the true net cash flow. All right, we'll begin by looking at the fundamental structure of the statement of cash flows. The entire report is organized around three broad categories of business activity: operating, investing, and financing. The first section is cash flows from operating activities. Okay, these are the inflows and outflows directly related to earning income from the company's normal business operations. This is our most critical section as it reveals the cash generated internally. The second section is the cash flow from investing activities. This tracks cash related to the purchase or sale of long-lived productive assets like property, plant, and equipment, and also investments in other companies. Okay. The third section is cash flows from financing activities. Okay. This includes cash exchanges with external providers of capital, our creditors and our owners. Okay. We total these three sections to get the net change in cash. When we add this net change to the cash balance from the beginning of the year, the sum must equal to the cash at the end of the year. Alright, now that we've established the overall structure, let's zoom in on the cash flows from operating activities section. Okay, as you can see, this is the most involved section because it's where the indirect method reconciliation takes place. We start with net income and then make various adjustments for non-cash items and changes in operating assets and liabilities. We also see the components of the direct method, which reports actual cash receipts from customers and interest, and gross cash payments for suppliers, wages, and other expenses. Both of these methods ultimately arrive at the same final number, but the indirect method's reconciliation is what we'll focus on, okay, as it's used by almost all US-based companies. Okay, our goal in this session is not just to know the final number, okay, but to understand the logic of the adjustments used in the indirect method. All right, let's move on to the second section of the statement of cash flows, investing activities. Okay, this section tracks cash related to the acquisition and disposal of two main types of assets: long-lived productive assets, okay, and investments in the securities of other companies. Look at the inflows on the left. Okay, these are generated primarily from the sale of plant, property, and equipment, and the sale or maturity of investment securities. Okay. On the right, the outflows are generated by purchases. Okay, these include cash paid for the purchase of new PPE or plant, property, and equipment, and the purchase of investment securities. Okay, investing cash flows show management's strategy regarding capital expenditures and portfolio allocation, answering the question, is the company adequately investing in its future productive capacity? All right, let's move to the final of the three core sections, cash flows from financing activities. Okay, this section is crucial because it tracks cash exchanges with external providers of capital, our creditors and our owners. Okay, on the left, our inflows are generated from borrowing cash by issuing bonds, notes, or mortgages, and from issuing stock to owners. Okay, on the right, the outflows show the cash used to service or adjust our capital structure. Okay, these include repayment of loan principal to creditors, or repurchasing the company's stock, and paying dividends to our owners. Okay, the primary purpose of this section is to show analysts how management has elected to fund its growth and how it manages the balance of debt and equity. Alright, before we look at the three core sections in detail, let's establish the crucial mathematical link between the balance sheet and the statement of cash flows. Okay, understanding this is the groundwork for why the indirect method works. Okay, we begin with the fundamental accounting equation, which is assets is equal to liabilities and stockholders' equity. Okay, this is the balance sheet equation. Okay, We then logically split the assets into two parts. Okay, we're just trying to separate cash. So we separate it into cash and non-cash assets. Okay, everything other than cash. Okay, if we rearrange the equation, we can isolate cash on one side. Okay, so cash is equal to liabilities plus stockholders' equity minus non-cash assets. Okay, the final step and the most important is recognizing that this relationship holds true for any change that occurs over a period of time. Okay, a change in cash for a period in time should equal to a change in liabilities plus a change in stockholders' equity minus a change in non-cash assets. Okay, this equation proves that any change in cash must be explained by a corresponding change in the other balance sheet accounts. Okay, this is the exact logic the indirect method follows to reconcile net income, which is already reflected in retained earnings, with the final cash balance. Alright, we're building on the foundation we established in the previous slide. We know that any change in cash must be explained by a change in the other balance sheet accounts. Okay, this slide shows a comparative balance sheet and how every non-cash account is categorized for the statement of cash flows. Okay, on the left, under related cash flow section, you can see these classifications. Okay, O stands for operating, I for investing, and F for financing. Okay, notice that all working capital accounts like accounts receivable, inventories, accounts payable, okay, are marked with an O. Okay, we use the change in these accounts to reconcile net income to cash flow from operations. Okay, investing activities, or I, okay, relates to long-term assets, primarily plant, property and equipment, and short-term investments. Okay, note that for net PPE, its primary cash flows, purchases and sales, or investing, but the depreciation component is used in the operating calculation, and therefore it links to both sections. Okay, financing activities, or F in our column, okay, relates to external capital, contributed capital, and retained earnings, specifically for the dividends paid. Okay, retained earnings is also impacted by operating activities through net income. Okay, this classification is essential. Okay, once you know which section a change belongs to, you're halfway to solving the statement. All right, we're now shifting our focus entirely to the cash flows from operating activities section. Okay, this section is without a doubt the most important section of the entire statement, as it details the cash inflows and outflows directly related to earning income from the company's core business operations. As we established, we will be focusing on the indirect method, okay, the required method for reconciliation, which converts that accrual figure of net income back into a true cash flow figure. Okay, since this section is the most critical and complex, okay, we're going to be spending quite some time on this to understand its inner workings and the logic behind every single adjustment. Now that we know the indirect method is a reconciliation, let's look at the step-by-step roadmap we'll follow to convert net income into cash flow. Think of the slide as a checklist for any problem you solve. Okay, we begin logically with step 1. Okay, you start with net income from the income statement. This is our starting point for the entire reconciliation. Next, we handle the non-cash timing issues. Step 2 involves adjusting for non-cash expenses like depreciation and amortization. We'll soon see in detail why we add them back. Step 3 is adjusting for non-operating gains and losses, specifically those related to selling long-term assets. Okay, we'll break down the logic of adding or subtracting to ensure we don't double count cash flow that actually belongs in the cash flow from investing activities section. Okay, finally, the bulk of the work is in adjusting for changes in working capital accounts. Step 4 is where we apply the inverse rule to all changes in operating assets. And step 5 is where we apply the direct rule to all changes in operating liabilities. After performing all 5 adjustments, the final result is our net cash flow from operating activities. Let's now walk through the steps and look at them in detail. We are now beginning our reconciliation process, starting with the first 2 actions on our roadmap. Okay, step 1 is simple. We start with net income, shown here as our bottom line, right? This figure should be converted to a cash flow number. Okay, step 2 is our first critical adjustment, dealing with non-cash expenses like depreciation and amortization. Okay, look at the income statement snippet here. Okay, we subtracted $10,000 for depreciation. along the way in our calculation of net income, right? Okay, this reduction is what we need to reverse now. Okay, the logic behind this is the following, right? This depreciation expense reduced our net income, but it did not reduce our cash. The cash was spent years ago when the asset was actually purchased. Okay, to reverse the non-cash reduction and find the true cash flow, we must add it back to net income. Okay, a quick side note on taxes if you're concerned. While depreciation did reduce our taxable income and therefore reduce the cash we paid for taxes, okay, that effect is already accounted for within the income tax expense line. Okay, for the purpose of this simple adjustment, we just focus on the non-cash nature of the depreciation itself and perform the full add back. Okay, the simple rule remains that if it was a non-cash expense, you add it back. Okay, our next adjustment, which is step 3, deals with gains and losses on the sale of long-term assets. Okay, let's use a numerical example again to figure out the why. Okay, we make these adjustments primarily to prevent double counting the cash flow. If a machine with a book value of $6,000 is sold for $8,000, let's say, we recognize a $2,000 gain. Okay, this gain increased our net income, which is our starting point, right? Okay, since the $8,000 in cash is already counted in the cash flow from investing activities section, and only $2,000 of that is inflating our net income, we must subtract the $2,000 gain from the net income in the operating section, okay, in the cash flow from operating activities section. This removes the non-operating revenue. Okay, the opposite logic applies to a loss on a sale. Okay, if the machine had sold for less than $6,000, then the resulting loss would have decreased net income. To reverse that negative non-operating effect, we would add the loss back. Okay, we are essentially ensuring that net income only reflects operating items before we move to the final adjustments. Now we move on to steps 4 and 5, which is where we deal with changes in our current operating assets and liabilities, also known as working capital accounts. Okay, step 4 of our roadmap deals with adjusting for changes in our operating assets. Let's jump straight into an example using accounts receivable to figure out the rule. Okay, this is the logic behind the inverse adjustment. Imagine our accounts receivable started the year at $1,500 and ended at $1,000. Okay, our income statement reported $40,000 in sales revenue. Okay, our accounts receivable decreased by $500. Now ask yourself, if accounts receivable went down, did we collect more or less cash than the revenue we reported? A decrease in accounts receivable signals that we collected $500 more cash from customers than the sales revenue we reported on the income statement. Okay, since net income already includes the $40,000 revenue, okay, we only need to account for that $500 difference. Okay, because we collected more cash, that $500 must be an increase in cash flow. Therefore, we add the $500 decrease in accounts receivable to the net income. This leads us to the fundamental rule for all operating assets. The relationship is inverse. Okay, if an asset balance increases, we subtract that amount from net income. And if an asset balance decreases, we add that amount back. This inverse rule applies to all key operating assets: accounts receivable, inventory, and prepaid expenses. Okay, now take a moment to apply the same thought process to the other items. If inventory increases, does that mean we paid more cash or less cash than the cost of goods sold reported? Think about that as we look at the next set of adjustments. Now we look at the final part of our reconciliation, step 5, dealing with operating liabilities. The relationship here is the opposite of assets. The rule is direct. Okay, let's jump into the accounts payable example to understand why this relationship is direct. Imagine our accounts payables started the year at $1,500 and ended at $1,000. Okay, the relevant accrual expense, let's say, was $20,000. So our accounts payable decreased by $500. A decrease in accounts payable signals that we used $500 more cash to pay down our balances than the new expenses we incurred during this period. Okay, essentially we had an extra cash outflow. Since net income has already been reduced by that $20,000 expense and we paid $500 extra cash now that wasn't reflected in that expense, we must subtract the $500 decrease in accounts payable from net income. This leads us to the fundamental rule for all operating liabilities. The relationship is direct. If a liability balance increases, we add that increase back to net income. And if a liability balance decreases, we subtract that decrease. This direct rule applies to key operating liabilities like accounts payable and accrued expenses. We have reached the end of the reconciliation process. This slide brings together everything we've covered into one powerful summary table that you can use as a reference tool. Okay, as you look at the table, notice the clear logic. The entire method boils down to reversing the distortions caused by accrual accounting. The non-cash items like depreciation and losses on sale are added back because they reduce net income but not cash. The non-operating items like gains on sale are subtracted because the cash is counted elsewhere. And most importantly, look at the working capital accounts. Remember the two rules: assets are inverse and liabilities are direct. Okay, if an asset increases, you subtract that increase because an asset increase means you recorded more revenue than you collected in cash. If a liability increases, you add that increase because a liability increase means you recorded an expense but paid less cash than that expense. On a side note, instead of looking at individual assets and liabilities, you can also view this process through the lens of working capital. Okay, remember that working capital equals current assets minus current liabilities. Okay, you can calculate the change in working capital first and then apply a single simple rule. If working capital increases, which happens when assets increase or liabilities decrease, it means cash was used or tied up. Therefore, you subtract the increase from net income. If working capitals decrease, which happens when assets decrease or liabilities increase, it means cash was freed up. Therefore, you add the decrease back to net income. This working capital approach is an advanced analytical technique, but it confirms the logic of our individual rules, right? So when you approach a cash flow statement problem with this mindset, understanding the why, you won't have to memorize a single rule. Okay, you can derive the adjustment every single time. This final result, the net cash flow from operating activities, is the one true cash figure derived from your core business operations. It is the same number the direct method would have produced too. Okay, the entire indirect method is simply a logical, systematic way to move from the accrual-based net income to the true cash generated by your operations. Alright, we've completed the most analytically challenging section of the statement, cash flows from operating activities. Okay, we can now transition to the second major section, which is cash flows from investing activities. Okay, while the operating section focuses on a company's day-to-day operations and working capital management, okay, the investing section focuses on the management's long-term strategy for growth and capital expenditure. Okay, this section answers the crucial question: is the company adequately investing in new productive capacity to sustain future growth? We'll see that classifying these cash flows is much more straightforward as they track the acquisition and disposal of a firm's long-lived assets and non-operating investments. Alright, we're diving into the first core component of investing, which is plant, property and equipment, or PPE. Okay, we use the balance sheet account net PPE to reconcile the investing cash flows. The change in this single net account must be explained by three different things that happen during the period as shown in this slide. Okay, first, purchasing of new assets causes an investing outflow of cash. Okay, this is a deliberate strategic spending decision by management. Okay, second, the sale or disposal of old assets generates an investing inflow of cash. Okay, and third, depreciation expense also affects the net PPE balance. However, this is a non-cash expense, which is why we added it back in the cash flow from operating activities section. Okay, when preparing the statement, we must find the individual cash amounts for the purchases, which is the outflow, and sales, which is the inflow, to report them separately in the investing activities section. Alright, this slide provides the mathematical formulas we use to reconcile the change in the net PPE balance when preparing the investing activities section. Okay, the top box shows the basic reconciliation. Okay, it starts with the beginning net PPE and adds purchases, which is our cash outflow. Okay, it then subtracts the book value of the sold assets and the depreciation expense to arrive at the ending net PPE balance. Okay. The book value of the sold assets is the number you would have to probably solve for if the cash sale amount was the missing piece. Okay. The bottom box shows the same reconciliation but written in terms of cash flow components. Okay. Here, instead of subtracting the book value of sold assets, okay, we subtract the cash sale proceeds, which is our investing inflow, adjusted for any gain or loss on sale. Okay. Remember, the cash sale plus or minus the gain loss is simply the book value of the asset. Okay, so both formulas are mathematically identical. These equations are essential because they allow us to use the depreciation expense and the change in the net PPE account to solve for any missing cash flow items. Okay, the purchases or outflow or the cash proceeds from sale, which is the inflow. Okay, which must be reported separately in the statement. All right. We are finishing the investing activities section by looking at the investments in securities. Okay, these investments include both short and long-term stocks and bonds of other companies. The accounting here is very straightforward. Okay, when a company makes a purchase of investment securities, cash is paid out, which is reported as an investing outflow. Okay, conversely, when a company receives cash from the sale or maturity of investment securities, it's recorded as an investing inflow. Okay, this section is crucial because it shows how a company is using its funds to earn returns or manage liquidity in its non-operating portfolio. Okay, all right, we've covered the first two sections and we can now move on to the final piece, which is cash flow from financing activities. Okay, this section tracks all cash flows related to external sources of financing for the enterprise. Okay, in other words, this shows the cash exchanges with our creditors or debt holders and our owners or stockholders. Okay, this section is vital for analysts because it reveals how management has chosen to fund the company's growth and what kind of capital structure the firm maintains. Okay, we will break down these exchanges into two categories, debt and equity. All right, we'll begin with exchanges with creditors or our debt holders. Okay, the first two lines are straightforward. Cash received from issuing new debt like notes, bonds or mortgages is a financing inflow, okay, because it provides external capital. Okay. Conversely, cash paid to repay the principal amount of that debt is a financing outflow. Okay. The last line is a crucial distinction under US GAAP. While interest payments are related to debt, they are usually classified as an operating activity under US GAAP. Okay, this is because the corresponding interest expense is reported on the income statement. Okay, however, be aware that IFRS allows alternative classifications. Okay, interest paid can be classified as either operating or financing. Interest received, on the other hand, can be classified as either operating or investing. Okay, this IFRS flexibility recognizes that interest received results from investing activities and interest paid is a payment to providers of financing. Okay, but it can be confusing to financial statement readers. Therefore, when we prepare the financing section under US GAAP, you must look at the change in debt principal and completely ignore the interest portion. All right, we are concluding the financing section by looking at exchanges with owners or the shareholders. Okay, these activities affect the equity accounts on the balance sheet. Cash inflows here are generated by issuing new stock. Okay, whether common or preferred, it doesn't matter. This increases our contributed capital and is recorded as a financing inflow. The outflows, on the other hand, include repurchasing the company's own stock, which is recorded as treasury stock, and paying cash dividends to owners. Okay, remember that dividends are classified as financing outflows. They are a distribution of income to owners and are not reported on the income statement, distinguishing them from operating expenses. Okay, in the bottom of the slide, we see a reconciliation for the retained earnings account. Okay, this is important because change in retained earnings is explained by net income, okay, from operating activities, and dividends from our financing outflow. Okay, if the dividends paid amount isn't provided, you can use this formula to solve for it, right? Okay. All right, we're at the final slide now, bringing the entire statement of cash flows into focus. Okay, this is the finished product that summarizes all the work we've done in this session. The statement is a simple mathematical reconciliation. Okay, once you calculate the net cash flow from operating, investing, and financing activities, the sum of these three figures gives you the net increase or decrease in cash for that period. Okay, the final step is the most important one to check. When you add that net change to the cash at the beginning of the period, it must perfectly equal the cash at the end of the period, which is reported in the balance sheet. Okay, but what about non-cash investing and financing activities? These are significant transactions like acquiring equipment by issuing a long-term note payable that do not involve any cash. Okay, because they are important, they must be reported in a supplemental schedule or narrative outside of the three main sections. Okay, finally, companies must also provide supplemental disclosures for the cash paid as interest and the cash paid for income taxes. Okay, we have reached the end of this session. With the completion of this final statement structure, I hope that you have mastered all the components of the statement of cash flows. Thank you for watching this video. In our next and final session, session 12, we'll shift our focus to analyzing financial statements. Okay, concentrating primarily on using financial ratios to assess a company's performance, risk, and profitability. See you there. Cheers. Hey there. Welcome to session 12, and we are moving into the final and most practical part of financial accounting, analyzing financial statements. We spent the entire course learning how to prepare the income statement, the balance sheet, and the statement of cash flows. Okay, now we learn how to actually use those statements to make economic decisions. Our goal in the session is to go beyond just looking at the final numbers and learn the analytical tools, primarily financial ratios, that help us assess a company's profitability, liquidity, and long-term solvency. This knowledge is vital whether you're a potential investor, a creditor, or a manager. Okay? Alright, here's our roadmap for the session on analyzing financial statements. We'll start by establishing the context of the investment decision and look at how a company's business strategy directly affects which financial ratios are most important. Next, we'll cover the analytical framework that includes defining component percentages and laying out the essential rule for ratio calculation, the need to use average balances when comparing different statements. Then we dive into the main part of the chapter, the 5 categories of analysis. Okay, we'll cover profitability, liquidity, solvency, efficiency, and market tests. Okay, before we start calculating any ratios, we must establish the context of our analysis. Financial analysis is often described as part art and part science. A good analyst doesn't just crunch numbers, they look beyond the financial statements. As an investor, you should evaluate a company's future income and growth potential based on 3 broad factors. First, economy-wide factors, the overall health of the economy. Things like the unemployment rate, general inflation, and changes in interest rates has a direct impact on individual business performance. Okay, for example, rising interest rates can negatively impact sales in the home improvement industry. Second, industry factors. Certain events like a decline in housing turnover will have a major impact on every competitor within that specific industry, but only a minor impact on companies outside of it. Okay. Third, individual company factors. These are the unique elements not always quantified in the financial reports, such as the quality of the management team or the effectiveness of their products. Okay. You need to assess the quality of a company's balance sheet and the quality of its core offering. Understanding these external and internal factors provides the necessary framework for interpreting the financial data we are about to compute. Alright, our next topic is vital. Before you calculate a single ratio, you need to know what you're looking for. A company's performance is best evaluated by comparing its financial results to the objectives management was trying to achieve. The relationship is direct. Okay, strategy leads to operating decisions, which leads to transactions, and those become the financial statements. Okay, there are 2 fundamental strategies a business can follow. Product differentiation strategy focuses on unique benefits like quality or features allowing the company to charge higher prices and achieving a higher profit margin. Okay, think of brands like Lululemon, Mercedes, Apple, and Starbucks. Okay, the second is the cost differentiation strategy, where companies operate efficiently to offer lower prices and maximize sales volume. Okay, think of brands like Walmart and McDonald's. Okay, the DuPont model is a key analytical tool here. Okay, as it shows precisely how these strategies drive profitability. Okay, the model breaks down return on equity into three components. Okay, if a company pursues the product differentiation strategy, they rely on a high net margin to drive ROE. Okay, if they pursue the cost strategy, they rely on a rapid asset turnover. Okay, understanding the company's strategy tells you which part of the model to prioritize in your analysis. All right, we've established the overall strategy. Now we look at the analytical methods used to evaluate financial performance. Okay, the most fundamental rule is that financial results cannot be evaluated in isolation. Okay, a company's profit is meaningless unless you develop appropriate comparisons. Financial analysis requires judgment, not just mechanical calculation. Okay, analysts use two primary methods for comparison. Okay, on the left we have time series analysis. This involves looking at a single company's performance, like its sales growth for example, over several years. Okay, this line graph visually illustrates the importance of examining trends and identifying progressive deterioration or improvement in performance. On the right, we have comparison with similar companies. Okay, since industry and economy-wide factors affect everyone, comparing a company with another in the same line of business gives better insight into its performance. Okay, the bar chart shown here compares key measures across competitors, and this helps to filter out general market effects. Okay, these two frameworks, looking at a company's past and looking at its peers, are essential for all subsequent ratio analysis. All right, we are transitioning now to the analytical tools that financial professionals use every day: ratio and percentage analysis. At its core, a ratio simply expresses the proportional relationship between two different amounts. This simple act of comparison is what allows for a meaningful analysis. Okay, for example, just knowing a company earned $500,000 in net income isn't enough. But comparing that $500,000 to its $5 million in stockholders' equity tells you that the company achieved a 10% return on its investment. This provides a vital insight into performance that the raw dollar figures simply hide. Okay? Ratios offer flexibility as they can be calculated using numbers all from one statement or by combining numbers across the income statement and balance sheet. However, analysts only compute the ratios that are relevant, ignoring any ratios where the amounts have no natural relationship. Okay, this is the foundation for all the categories we'll cover, starting with component percentages in the next slide. Okay. All right, the first practical tool we'll look at is component percentages. Okay, this method is foundational because it expresses every item on a financial statement as a percentage of a single base amount, which immediately eliminates the problem of a company's size. Okay, look at the tables on the slide. On the income statement on the left, the base is always the net revenue or sales, okay, which is set to 100%. Every expense is shown as a piece of that sales dollar. Okay, for example, this company's cost of sales is 65% of the revenue and its net income is 5% of the revenue. Okay, on the balance sheet on the right, this base is total assets, okay, which is also set to 100%. Okay, here 70% of the company's growth is funded by liabilities and 30% is funded by stockholders' equity. Okay, the real value lies in the analysis. This tool helps us find trends. If the selling, general and administrative expense percentage were to suddenly rise from 20% to 25% over time, that immediately signals that the management is failing to keep costs in line with the level of sales activity. Okay, it allows for easy efficiency comparison with competitors regardless of their scale. All right, we've compared component percentages, which are the start of our analysis. Okay, now we dive into the 5 essential categories of financial ratios that analysts use. Okay, We group these ratios because each answers a distinct fundamental question about a company's health, risk, and performance. Okay. Category 1, which is tests of profitability, these measure the overall success and sustainability of a company's income, asking if a company is generating adequate income relative to its investments and sales. Category 2, which is tests of liquidity. Okay. Liquidity measures a company's ability to meet its currently maturing debts or short-term obligations, asking, can the company pay its short-term bills? Okay. Category 3, tests of solvency. Okay. Solvency measures a company's ability to meet its long-term obligations. Okay. This is a long-term survival check, asking if the company can withstand financial stress. Okay. Category 4, market tests. Okay. These relate to the company's financial performance to the current market price of its stock, showing how the market values company's return and future potential. Okay. Category 5, which is efficiency measures. Okay. These ratios assess how effectively management utilizes assets like inventory and fixed assets to generate maximum sales volume from the resources they control. Alright, before we start calculating, we must establish one crucial non-negotiable rule that governs ratio computation. Okay, look at the diagram here. The core issue is time. Okay, the income statement covers the entirety of a period, like year 2 for example, okay, flowing across the timeline. Okay, but the balance sheet is a snapshot taken at a single moment in time, like the 31st of December, okay, on the end of year 1 or the end of year 2. Okay, when a ratio compares an income statement figure from year 2 to a balance sheet figure, using a single static balance sheet number would be inconsistent and potentially inaccurate. Okay, therefore, the rule is the balance sheet amount in the denominator must be expressed as an average of the beginning and ending balances of the period covered by the income statement. Okay, we calculate the average by summing the beginning and ending balances and dividing by 2. Okay, while some analysts may use the ending balance as a shortcut, especially if the change is small, using the average is the standard approach for consistency and accuracy. Okay, always check the methodology when reviewing ratios calculated by others. Alright, we've covered the foundational rules for financial analysis. Now we start diving into the 5 categories of ratios, beginning with category 1, that is tests of profitability. Okay, profitability is the most vital measure of a company's overall success and is absolutely necessary for its survival. Okay, these ratios measure the adequacy of income by comparing it to other key items like sales revenue or the total investment made by owners. We'll cover 6 key profitability ratios starting in the next slide that help us determine if a company is earning an appropriate return for the risk and resources involved. Okay? Alright, our first measure is return on equity or ROE. Okay? This ratio directly relates the income earned to the investment made by the owners, the stockholders. Okay? It reflects the simple fact that investors expect a higher return if they commit more capital. The formula is net income divided by average stockholders' equity. Okay, we use the average equity because net income covers the entire period, making the average balance a more consistent denominator. Okay, ROE is compared to the return for similar companies and to the company's own historical performance to determine if the return is adequate. Okay, our second measure is return on assets or ROA. Okay, this compares income to the total assets used to earn that income, essentially measuring the return on the total investment in the company. Okay, analysts often consider ROA a better measure of management's ability to utilize assets effectively because it's not affected by how these assets are financed, whether with debt or equity. Okay, notice the numerator here. We take net income and add back interest expense net of tax. Okay, why do we do this? Because the denominator, average total assets, includes resources provided by both owners and creditors. Okay, by adding back the interest, we are ensuring the numerator reflects the return available to both groups of investors, giving us a clean look at operating effectiveness. Okay. All right, building on ROE and ROA, the financial leverage percentage is our third profitability measure. This is an extremely insightful metric because it measures the advantage or disadvantage a company gains from using debt to finance its operations. Okay, the formula is simple. It's return on equity minus return on assets. Okay, we call it positive leverage when the result is positive, meaning ROE is greater than ROA. Okay, this occurs when the company is earning a higher rate of return on its total assets than the after-tax interest rate it's paying on its debt. Okay, the difference, that extra profit, accrues entirely to the benefit of the owners. Okay, positive financial leverage is the primary reason most companies obtain resources from creditors rather than just selling more stock. Okay, they effectively borrow at one rate and invest at a higher rate of return. Okay, if ROE is lower than ROA, the company has negative leverage, meaning the cost of the debt is eroding value for the shareholders. Alright, we are now covering the third set of profitability measures, focusing on earnings per share and the quality of income. First, earnings per share or EPS. This is likely the single most widely watched ratio in the market. Okay, it measures the return on investment based on the number of shares outstanding. While simple to calculate, net income divided by the average shares outstanding, its impact on stock price is huge as it's the primary benchmark for corporate performance. Okay. Next, the quality of income ratio. Analysts are deeply concerned about the quality of earnings because different accounting procedures can be used to report higher income. Okay. This ratio acts as a check. The formula is cash flows from operating activities divided by net income. A ratio higher than 1 indicates high quality earnings, meaning every dollar of reported income is backed by cash. A ratio below 1 suggests lower quality or potentially less reliable earnings. Alright, we are concluding our section on tests of profitability by focusing on our sixth measure, profit margin. Okay. Profit margin measures the percentage of each sales dollar on average that actually represents profit. The formula is straightforward: net income divided by net sales revenue. Okay, a company's profit margin is a key indicator of its operational efficiency. For example, knowing a company generated 5 cents of profit for every dollar of sales is a much better measure of efficiency than looking at raw income figures. Okay, however, you must exercise caution when analyzing this ratio. It's very difficult to compare profit margins across different industries. Why? Because the amount of resources, the total investment needed to earn that income is not considered here. Okay, this leads to the crucial trade-off. A high sales volume can compensate for a low profit margin. For instance, grocery stores have low profit margins but generate a high sales volume from relatively inexpensive stores and inventory. Conversely, a high fashion jewelry store has a very high profit margin but a low sales volume. A larger profit margin isn't always better. What matters is the balance between margin and sales volume. Alright, we've completed our tests of profitability. We've established how successfully the company is earning money. Okay, now we move to category 2, tests of liquidity. Liquidity refers to a company's ability to meet its current maturing debts. Okay, these tests focus on the relationship between current assets and current liabilities. Okay, the ability to pay these short-term liabilities is crucial. A company, even a profitable one, can fail if it doesn't have sufficient cash on hand to pay its obligations on time. This can lead to losing cash discounts and running the risk of having credit discontinued by vendors. Okay. In this section, we'll cover the core liquidity ratios that assess a company's short-term financial strength, the cash ratio, the quick ratio, and the current ratio. Alright, we begin with the cash ratio. This is the most stringent liquidity test because its numerator includes only cash and cash equivalents, okay, comparing them directly against current liabilities. This tells you if a company can meet its current debts with immediately available funds. Okay, However, while financial safety is good, most analysts believe this ratio shouldn't be too high. Okay, holding excess cash is usually uneconomical. Okay, companies should invest cash in productive assets or use it to reduce debt. So a high cash ratio can signal inefficient cash management. Okay, next is the quick ratio or acid test. Okay, this is the next level of stringency. The numerator uses quick assets, which specifically excludes inventory and prepaid expenses. Why exclude them? Because of the uncertainty regarding the timing of their conversion to cash. Inventory especially can take a long time to sell. Okay, this ratio measures the immediate safety margin available to meet debts using assets that are already cash or can be converted to cash very quickly. Okay, it's considered a better measure than the cash ratio because it's less sensitive to the timing of small cash transactions. Okay, finally, we have the current ratio. This is the least stringent because its numerator includes all current assets, including inventory and prepaids. Okay, this measures the overall cushion of working capital available to cover short-term debts. Okay, while a ratio of 2:1 is often cited as financially conservative, the optimal level depends entirely on the company's business environment and industry. Okay, for example, a retailer often has a high current ratio because they must carry large inventories, while a company with very stable cash flows, like a utility company, can operate efficiently with a much lower ratio. Okay? Alright, we've covered profitability and liquidity. We now move to category 3, tests of solvency. While liquidity measures a company's ability to meet its short-term debts, solvency measures a company's ability to meet its long-term obligations. Okay? Solvency is essentially a test of a company's financial structure and its ability to survive over the long term, especially under financial stress. Okay? These tests focus on the adequacy of a company's earnings and cash flows to cover fixed obligations like interest and principal repayment. Okay? We will look at three crucial ratios here: times interest earned, cash coverage, and debt to equity ratio. Okay? Alright, our first measure is the times interest earned ratio. Okay, this is a safety ratio that measures the amount of income generated to cover the fixed interest payment obligation. The higher the ratio, the greater the margin of protection for creditors. Okay, notice the numerator, we add back interest expense and income tax expense to net income. This calculates the income available before these mandatory fixed charges were subtracted. Okay. Our second measure is the cash coverage ratio. Some analysts argue that the times interest earned ratio is flawed because interest is paid with cash, not with net income. Okay. The cash coverage ratio solves this by comparing the cash flow from operating activities before interest and taxes are paid to the actual cash paid for interest. This ratio gives a stronger cash-based assessment of a company's ability to service its debt. Alright, we are wrapping up our tests of solvency with the debt to equity ratio. This ratio is a fundamental check on a company's financial structure, showing how much debt it uses relative to the funds provided by its owners. The formula is simple: total liabilities divided by stockholders' equity. This ratio is essential because it highlights the risk-return trade-off. Okay? Debt is riskier than equity because interest payments are legally fixed and enforceable even if the company is unprofitable. Okay? Equity capital, where dividends are discretionary, is much less risky. However, most companies obtain a significant amount of resources from debt because of the benefits of financial leverage and the tax deductibility of interest expense. A high ratio means higher risk but also higher potential returns if management invests effectively. Okay? This ratio is a key part of any company evaluation because it reveals the balance management has struck between higher returns and higher risk. Alright, we've covered the internal financial health of a company with profitability, liquidity, and solvency. Okay? We now move to category 4, which is market tests. Okay? These ratios are unique because they relate the company's financial performance, specifically its earnings, to the current market price of its stock. They measure the market worth of a share of stock and reflect the stock market's collective assessment of the company's future performance and growth potential. Okay, we'll cover the two most popular market tests here: the price to earnings ratio or PE ratio and the dividend yield ratio. Alright, the first market test is the price earnings ratio, or more commonly known as PE ratio. Okay, this is a measure that compares the current market price of the stock to the earnings per share. It reflects the stock market's assessment of a company's future performance. Okay, a high PE ratio suggests that the market expects rapid earnings growth. A company that expects to increase its earnings in the future is generally worth more. Okay. Second is the dividend yield ratio. This ratio measures the return provided by dividend income relative to the stock's market price. Okay. Investors who buy stock expect two types of returns. Okay. Dividend income and also price appreciation. Growth stocks, where investors expect a large increase in the share price, often have a low dividend yield. Conversely, stocks with low growth potential often offer a much higher dividend yield to attract investors seeking current income. Alright, we've covered profitability, liquidity, solvency, and also market performance. Okay, now we introduce our final set of ratios, which is category 5, efficiency measures, which we also call turnover ratios. Okay, this category directly measures management's operational competence. It asks the question, is the company generating maximum sales volume from the resources they control? Okay, we will cover critical ratios here that focus on how well assets are used. Companies that can quickly turn assets into cash have good liquidity and do not needlessly tie up funds in unproductive assets. Alright, we are now covering the first ratio in our final category, efficiency measures, which is the receivable turnover ratio. This ratio is important because accounts receivable are closely related to both liquidity and operating efficiency. A company that can quickly collect cash does not needlessly tie up funds in unproductive assets. Okay, the formula divides net credit sales by the average net receivables. Okay, a high turnover ratio suggests that a company is effective in its credit granting and collection activities. Conversely, a low ratio suggests problems with credit risk or collection efforts. Okay, we then convert this ratio into a time basis, the average age of receivables, or days to collect, or days sales outstanding, DSO. Okay, this tells us the average number of days the company waits to get paid. Okay, keep in mind the caution here: analysts must evaluate the results based on their understanding of the business. Okay, for example, retailers who use total sales as a proxy for credit sales can lead to a meaningless ratio, since most credit sales use bank credit cards, meaning the cash is collected almost immediately from the credit card company. Okay. Alright, we are continuing our efficiency analysis with the inventory turnover ratio. Like receivable turnover, this is a measure of both liquidity and operating efficiency. The formula divides cost of goods sold by average inventory. Since a company realizes profit every time inventory is sold, an increase in this ratio is generally favorable, right? However, caution is needed. A ratio that is too high can signal that sales were lost because the company was out of stock. Okay, the cost of a lost sale can be high, potentially losing the customer's future business. We then convert this ratio into the time measure, average days supply in inventory, or days inventory outstanding, or DIO. Okay, this tells us how many days on average the inventory sits on the shelf. Okay, this time measure is critical for efficiency. For instance, the food industry has a high turnover because inventory deteriorates quickly, while the automobile industry has low turnover. Effective inventory management, as measured by a healthy turnover, means the company ties up less money and operates more efficiently. Alright, we are now going to synthesize the time measures we've been discussing to understand the complete operating cycle. Okay, the operating cycle measures the time it takes for a company to go from purchasing inventory to selling it and finally collecting the cash from the customer. Okay, analysts are keenly interested in this because it helps them evaluate a company's cash needs and management efficiency. Look at this diagram. The cycle starts when you purchase inventory and ends when you receive cash from the customer. Okay, the top half of the diagram shows the traditional operating cycle measured as days inventory outstanding plus days sales outstanding, or the average age of receivables. Okay, the DIO, which is the days supply of inventory, okay, is the time the inventory sits on the shelf. Okay, the DSO, which is the days supply of receivables, is the time until the cash is collected. However, the key is the cash conversion cycle. Okay, this is the time cash is actually tied up in the business. Okay, this period starts when the company pays the supplier, okay, which is DPO, or days payable outstanding, and ends when the company receives the cash. Okay, the ultimate goal is to minimize this time between paying vendors and collecting from our customers. Okay, minimizing the cash conversion cycle frees up cash for other productive purposes, demonstrating top management efficiency. All right, we are continuing our efficiency analysis with the fixed asset turnover ratio. This ratio measures management's ability to utilize its investment in long-term tangible assets like equipment, buildings to generate sales. Okay, it's calculated by dividing net sales revenue by the average net fixed assets. Okay, we use average net fixed assets because fixed assets are a balance sheet account requiring consistency with the income statement. A high ratio is favorable, indicating the company has a competitive advantage in utilizing its fixed assets to earn revenue. The asset turnover ratio is a more broader measure. Okay, it compares net sales to average total assets. Okay, analysts often prefer this ratio when analyzing companies like retailers who hold large amounts of inventory and accounts receivable. Okay, both turnover ratios are key indicators of operating efficiency. As the DuPont model shows, if you remember, high asset turnover is essential for companies that follow a low margin cost differentiation strategy. We've covered all 17 ratios across the 5 major categories. Okay, this slide summarizes the interpretive direction for every ratio we studied. Look at the column titled Interpretation. Most ratios fall under the higher the better category, right? This generally applies to measures of return like ROE and ROA, solvency coverage like times interest earned, and efficiency like fixed asset turnover, right? The primary ratio that is generally lower the better is the debt to equity ratio, as a low ratio signals less risk from external debt financing. Okay, crucially, focus on the nuances. Measures like the cash ratio and turnover ratios should be high but not too high. A very high cash ratio can be bad because it means the company is holding too much idle cash, which is uneconomical. Okay, a very high inventory turnover ratio can be detrimental, suggesting that the company is running out of stock and losing sales. Similarly, the current ratio's ideal level is context dependent. Its function is to provide a working capital cushion, and the optimal level changes based on the industry and predictability of cash flows. The dividend yield ratio is also context dependent. A high yield appeals to investors seeking current income, while a low yield is common for growth stocks where investors expect high price appreciation. Use this table to build your analytical judgment, always asking what is the company's strategy and what is this ratio telling me about its execution. Alright, I promise this is our final analysis slide addressing the necessary cautions and limitations that all professional analysts must keep in mind. Ratios are a powerful tool, but they are not the final word. Okay. First, remember that ratios are not standardized. Except for earnings per share, analysts often compute ratios differently. You must always determine the exact computational approach used before relying on a ratio provided by another source. Second, comparisons are tricky. Ratios are only meaningful when comparing firms that are comparable in terms of their industry, size, operations, and accounting policies. An optimal ratio for one business may be inappropriate for another. Okay. Ratios are based on aggregated data, and this aggregation can obscure underlying problems. For instance, a high current ratio for a consolidated parent company might hide a severe liquidity problem in one of its subsidiaries. Okay. The averaging effect of the consolidation obscures the risk. Companies rarely use the exact same accounting policies. Differences like using LIFO versus FIFO or accelerated versus straight line depreciation can significantly change reported profitability. An analyst must understand these effects to interpret results correctly and make valid comparisons. Ultimately, financial analysis is a judgmental process. You must look beyond the reports as vital information about a company's strategy, management quality, and competitive standing, like checking pricing at a competitor store, is often not contained in the annual report. Alright, we have reached the end of session 12 and the conclusion of our course on financial accounting. This final session brought everything together, right? Remember that financial analysis starts with context, understanding a company's strategy and the economic factors affecting it, as this dictates which ratios are most important. We learned that comprehensive analysis relies on examining 5 core categories of ratios to assess risk and return. Most importantly, remember the lesson that analysis is part art and part science. Your final judgment must go beyond the computed numbers. You must account for differences in accounting policies and ensure your comparisons are valid between similar companies. Thank you for completing this comprehensive journey through financial accounting. You've successfully mastered the preparation and analysis of all major financial statements. And finally, if you want to expand your knowledge of accounting, finance, economics, math, statistics, and other related areas, I invite you to subscribe to my channel. You can also visit my website, which is jofessor.com, for additional resources and materials. Thank you again for your time, and I hope to see you in future videos or on my website. Cheers!